shift in the way the energy there could be the ingredients of a pivot point of a kind that we've only seen a couple of times previously in history.
But let's ask what the driving forces will be. The world is propelled forward and has been for thousands of years by great power competition. That is the thing that drives innovation right now across the board. It is a competition which is intensifying between two superpowers, the United States and a communist-led superpower. Now, is this starting to sound familiar?
It does.
So what is really significant about this historical moment is that we are in the first inning, the early phase of Cold War II.
Right.
And that is going to drive all the things that we've talked about, and it will not necessarily drive these changes in directions that are benign. That the big technological advance of Cold War I was, of course, nuclear weapons. And the arms race with nuclear weapons was an extremely dangerous one that very nearly blew the world up, particularly in 1962, at the time of the Cuban Missile Crisis. Yeah. I don't believe for a minute that we can have a Cold War II without a similar risk.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
This is Bloomberg Surveillance Early Edition, and here is what you need to know. China's economy shows more signs of stabilizing thanks to a summer travel boom and a heftier stimulus push. And Bloomberg speaks exclusively with Spain's economy minister as ECB officials fight over further rate hikes. And U.S. auto workers go on strike, setting up for a showdown over wages and job security. I'm Sonali Basak in New York with Danny Berger in London. Danny, let's take a look at the European markets this morning.
Yeah, Sonali, I was about to say, you know, this is kind of the market you think would have happened after the ECB hiked 25 basis points. But instead, yesterday, it was the polar opposite after we had that ECB hike. It was the euro weakening, and it was bonds that were bid. Now, we're getting the inverse of that today. It isn't completely undoing itself in the euro because it did move to its weakest since March. Maybe not unsurprising. We're getting some bids coming here to end the week. Duration, though, that's completely undoing yesterday's move. 10-year yields had moved lower in Germany by 5 basis points yesterday. Now they're higher by 5 basis points. Maybe those 75 basis points of cuts we've priced into the market aren't quite right if we have hawks telling the FT that there could be another hike come December. Finally, just worth pointing out, European stocks, they are up 0.7%. It's hard to see this as anything, Sonali, than China showing through. It's LVMH, it's Richemont, it's all those luxury good names, all the China-sensitive names that are really fueling this rally at the moment. We had positive China data coming out. Standard Chartered says that the peak pessimism is in when it comes to China. How about the U.S., Sonali?
China is flying through Europe and dipping into the United States. You are also watching S&P futures up ever so slightly. However, we are ending on a high note. The S&P this week is up well over 1%, and it is ending the month also on a good note if we keep up this trajectory. Now, the 2-year yield, this is where the interesting story for me is because 503 handle. Remember, we were well below 5 yesterday. We have come back up above 5. This has been flirting with 5% all week long. This is about a 2 basis point move you're seeing today. It has been moving just ever so slightly pre-market as well. We were looking at 504 a little bit earlier. Now, the Bloomberg U.S. dollar index down ever so slightly as well, off of last week's high. The dollar story has been fascinating when you look at the relative stories in interest rates around the world. That story will continue very strongly next week. Brent crude, 93, right under 94. Just a stunning move this week. We had seen it hit 90 last week. WTI also now above 90. This oil story, as we watch that economic data strength across the world, is getting pretty fascinating when you overlay that with the supply constraints, now up about 0.2% or so. I also want to take a look at another thing that's trading quite strongly. That is ARM. Pre-market, you're watching just the gains keep going. You're watching nearly a 10% move now pre-market at $69.76. Wednesday night, this is a stock that priced at $51 a share with doubts about valuation, now worth more than $70 billion when you look look at the pre-market price. I also want to take a look at a softer story in the market. That is GM, Ford, and Stellantis. Remember, U.S. auto workers go on strike as the United Auto Workers contract falls through. You have each of these companies really coming out with statements, fighting strong, still a way away from an agreement here. You have General Motors pre-market down nearly 2%, Ford down more than 2%, Stellantis still on the rise, about 0.1%. We'll keep an eye on that, Danny, all day.
All right, from public markets, Shanali, to private. And private credit's popularity has surged in the era of higher rates. It's now a $1.5 trillion industry. But of course, higher yields also bring higher risk. UBS sees defaults surging to as much as 10% in the first half of next year, which would be more than other kinds of risky corporate debt. Joining us now is a man who knows this market very well. It is Robin Dumar, managing partner of Park Square Capital. Robin, look, we've been talking for many years now, and you've always had more of a defensive kind of tilt anyway. When we're in an environment where the ECB delivers another hike, it's already hard out there for borrowers. Does that figure sound right to you, a 10% level of defaults come next year?
I think something along those lines thematically is probably closer to right than wrong, which is a massive step up in defaults. And I think they're likely to be concentrated in some of the businesses which, as a lender, we know to avoid historically. And that is things like consumer-facing businesses, retailers, et cetera. We know there's a lot of pain coming, and I think for people who've been selective and disciplined within the credit management space, this is going to be just fine.
I feel like you know where I'm going with this, because you said lenders historically know to avoid, but have they been? Have your peers done a good job of setting themselves up for a default cycle?
I think the people who've been in business for a long time and are very experienced and disciplined are probably going to be in very good shape. We've been around for 20 years. Through the global financial crisis, we've seen a lot of ups and downs in markets, and I think we really try to focus on some core industries like healthcare, business services, software, high margin industrials. We have literally no brick and mortar retail exposure in the portfolio, no chemical manufacturers, no airlines, no hospitality, no restaurants, et cetera. And I think it's that discipline within credit investing that I think is so critical. And I think the industry is going to be okay. People who are forced to diversify, people who are forced to buy the market, and I think importantly, people whose funds are so big that they have no choice but to buy the market, I think they're going to face some issues.
It's funny that you're talking about funds that are being big, surviving this market, because there's this funny little bank named Goldman Sachs that you used to work at that is not only big in credit markets, syndicated markets, but also big now in private credit as well. They join a host of banks that are trying to get bigger into private markets at a time, Robin, where people are very worried about the froth in private markets already. Do you think that there's going to be, like there had been in private equity, too much money chasing not enough good deals?
It's a very interesting question. I would say structurally, increasingly what we see is a growing need for private credit. And so I think private credit as an industry really has come of age. It's very well positioned. And banks broadly continue to lose market share. There's some exceptions. There are banking firms that have big private businesses. But in general, we see continued decline of the banks within credit markets. And that's creating an opportunity. Interestingly, though, Sonali, right now what we're seeing is a very limited supply of new transactions. And as a result, the secondary market levels, trading levels, have moved up dramatically. And I think actually it's a very good time to be cautious, particularly within the senior debt space, because there's just a limited supply of new deals, and there's a lot of capital chasing them at the moment.
It's pretty fascinating, because I appreciate your dose of reality about the default cycle. A lot of folks in the private credit market, you're talking about the safe stuff. A lot of people are ready to step up and start to finance the risky stuff as bankruptcies more broadly start to rise. What do you think about all of these people who want to step up with all this rescue financing? Do they make it out safe?
So, rescue financing, I think, is going to be one of the more interesting spaces. And I would probably not use the term rescue financing, because I think what's going to be more interesting is providing solutions to some of these very large, well-capitalized leveraged buyouts where they simply can't service the cash interest burden of their debt. With floating rate debt and rates having moved up by almost 5%, many borrowers are going to face challenges. Now, I think that's an enormous opportunity for private credit, especially for the creative side of private credit, for example, with non-cash pay, junior securities, et cetera, to step in and solve problems. So I actually think for creative junior capital within the credit space, it's perhaps the most interesting time in the last 20 years. I think it's very exciting. There are a lot of solutions required out there.
Right. Robin Dumar, staying with us. Now, up next, we are going to go to Spain, where EU finance ministers are holding an informal meeting, and Bloomberg's Maria Tadeo is standing by with an exclusive interview. Maria.
Yes, indeed. Good morning. And we're now joined by the Spanish finance minister and deputy prime minister of Spain in this beautiful setup that we're here in what is also your home region, by the way. But beyond the setup, I do want to ask you yesterday, of course, the European Central Bank obviously hiked again. In your view, should this be it? This should be the final one.
Well, of course, I have to be absolutely respectful of the ECB decisions. Reading between the lines, I understand they have focused on two elements: level of interest rates and time. So I'm sure that they will be deciding on both in a coherent manner. I always say I hope they get it right, because it's not so easy when you have so heterogeneous inflation rates around Europe. Spain, for example, has the lowest inflation rate right now at 2.4%, but other countries are proving to be much more resistant to lowering inflation. So I hope they get it right, and from the national perspective, I also hope they stop now, because our inflation rate is already quite low.
From a national perspective, what you say is a country like Spain does not need rates going above 4%. That's basically what you say.
Well, I think that this is a good summary of.
And you said two interesting things there. You said that there's a conversation about duration and the level of it. But I wonder if there was another hike, and the market does not believe that for the time being there will be another hike, but is there now a real risk that if you were to go tighter, this is now really going to send this economy into a recession? You're suffocating the European economy.
Well, again, it varies very much between the different countries. We were just starting our Eurogroup meeting here, as you said, in Spain, in Galicia, in my region of origin. And what we see is that the situation of the different economies is very different and very heterogeneous. Again, Spain is the strongest growing economy in the EU. It is projected to be the strongest growing large economy in the Eurozone next year again. The forecast is for 2.2% GDP growth year on year this year, after very strong growth in 2021 and 22. So in the case of the Spanish economy, the prospect and the forecast is quite positive. But indeed, there are some other countries that are slowing down or even having a recession, and that has an impact overall.
And yet, as a finance minister, you also know, however, you say your projections were upgraded on that. It's very fair, but when you look at the indicators, it seems there's a loss in momentum, and there is some kind of pessimistic take on the economy now, where some say we're heading into stagflation. Is that something that you say not so fast?
Well, absolutely not. I mean, when we're talking about 2.2 GDP growth in the case of Spain, after above 5.5% last year and the previous year, I don't think that would be an accurate word, to describe the situation. We're having quite resilient growth, strong growth in our economy, and inflation has gone down by 8 percentage points in 1 year. So I'd say that would not be a good description of the Spanish economy.
And the question is whether Europe, maybe Germany, and of course the German finance minister is here, but that maybe is a separate conversation. As you say, the economies are very different. The other big story this week, of course, was the European Commission with this probe into the Chinese electric vehicles. And what they say is that China has flooded the market now with very cheap subsidies. I wonder if you agree with that step taken by the Commission. And do you wonder, in a country like this, where you're into renewables, you have wind, you have solar potentially, is there a case to say, let's also look into other areas? China may be not playing fairly, not just in the cars, but in many other areas.
Well, I think trade policy has driven growth and prosperity in Europe for decades. The EU is a world trade powerhouse. And so we have every interest to strike the right balance between ensuring a level playing field at the global level, but of course supporting international trade. The European economy has proven to be very competitive and very resilient, and we should continue to build on that basis. And I'm sure the European Commission will get it right on that front. e-vehicles are a focal point of interest right now because of the technology competition which is taking place across the different superpowers at world level. But definitely we have to preserve the level playing field in all areas, particularly those that have to do with the new green and digital economy.
And then that takes me, should there be other areas where potentially you say, I'm not saying right now China's abusing this position, but there could be a case to just look at this and say, is this a level playing field? As you say, this is the biggest trading bloc in the world.
Well, again, Maria, I really wouldn't like to comment on that because I think that the European Commission has got trade policy right until now. I think they should go. I am quite convinced and quite confident that they will continue to get it right. But talking about trade policy, let me mention another highlight of these meetings. I mean, we're gathering here, it's an unprecedented event, an extraordinary setting and an extraordinary event because for the first time in history, we're gathering here EU finance ministers and Latin American and Caribbean finance ministers.
Which is exceptional.
Absolutely. For the first time in history, we want to deepen our cooperation with our friends and families on the other side of the Atlantic. And I'm sure that trade negotiations is one of the issues that will be touched upon. At the corridors, maybe, but it's a key issue for all of us also.
And you mentioned Latin America, and I wonder, in this context of change in geopolitical, areas, of course, and is there a case now where you say we need to reach out to South America increasingly, not just in trade, but also politically, and that takes me to the Mercosur trade deal. Is this something that you say, let's just get it done and sign this trade deal?
Well, absolutely. The Spanish position on this is very clear that we should, we support this trade deal as soon as possible, as well as the Chile negotiations to conclude them and the Mexico negotiations. I mean, all these trade agreements are win-win for both sides of the Atlantic, and from the perspective of Spain, we have strongly supported them. But beyond trade and beyond numbers, cold numbers, actually, I think that it's of the essence that we make Latin America a top priority for the EU from a strategic point of view. This is a very tight partnership that has been going on for decades. We have every interest in bringing them along and building on this strategic partnership, particularly in the current turbulent geopolitical context.
And it is absolutely turbulent. And we've seen this played out by the Commission this year, saying we also need to reach out to partners that perhaps we have not forgotten about, but maybe didn't dedicate enough time as this trade relationships change across the world. But I wonder, as a future, well, maybe not a future, but I wonder, it's your future aspiration. There's a European Investment Bank. You want to lead it. Obviously, your CV speaks for itself. Your colleagues here, I'm sure, have already an idea of who you are and your reputation. So you must know whether or not you're going to get this job. Are you going to get this job?
Come on, Maria. I mean, until things are done, they're not done. And I am a very, very prudent person, so I have got very important supports, and people are extremely kind. I think I'm well appreciated and respected by all colleagues around the table.
I mean, you're working to the last minute, to be fair.
Well, I mean, I am not discussing this in these meetings anyway, because I'm chairing the meetings. I wouldn't think it would be appropriate for me to lobby. No, I'm not campaigning. I'm not lobbying. I am chairing the ECOFIN meeting. It's a historical occasion. I want to make the most of it, deepen our cooperation with Latin America, and make progress on other files.
Well, and of course, there's a lot on your plate today in this meeting. Thank you so much, of course, for hosting us here. Always very good to see you. And that was Nadia Calviño, who is the Spanish finance minister and also deputy prime minister of the Kingdom of Spain. And of course, I happen to be Spanish too, so I'm very glad to be here today.
Maria, thank you so much. I was half expecting you to do the whole interview in Spanish. I'm kind of sad we were denied that. Maria Tadeo there. And of course, later today, another exclusive interview with the French economy minister, Bruno Le Maire. That's at 10:40 a.m. Eastern. Still with us here in studio is Robin Dumar, managing partner of Park Square Capital. Look, fitting that they just had that conversation about macro, about the European economy at a time where we're kind of worried. And also fitting, we're just talking about this. You happen to be joining on the 15-year anniversary of Lehman. Now, in the past 15 years up to today, as we finally got into this higher rate environment, how structurally different are deals that are being put together now? How big of a sea change has there been?
You know, Danny, it's an excellent point. If I wind the clock back to the Lehman days, the typical leverage buyout had about 25% equity in a deal. It was a true bootstrap acquisition, basically. More recently, over the last couple of years, the theme that we've seen in private equity is 60% or more equity in transactions. I think we have to come up with a new name. It's not a leveraged buyout anymore. It's not that levered a buyout. But the important theme in that is, unlike in commercial real estate, where landlords are, owners are handing back the keys to lenders, I think that's very unlikely to happen in large cap private equity today because the firms have so much of their own capital invested in the deals. I think they're going to work very hard to create solutions for high quality businesses, and we're certainly excited about helping them do that. I think it's going to be an interesting opportunity.
Yeah, not so leveraged buyout though. I'm afraid just isn't that catchy, Robin.
Yes.
Okay, so in that case, because one of the issues also during COVID times was the issue of cov-lite deals, of covenants that were particularly weak. Has that changed at all? If we're also talking about less keys being handed back.
So it hasn't changed dramatically. I think the last 18 months we've seen some improvements in structure, terms, and pricing. And interestingly, as a senior lender, which we are as well, we hate covenant-light deals. We just hate it. From the perspective of a junior lender, however, cov-lite's great because it means you're very unlikely to lose a company to the senior lenders. And so I think there's a longer runway associated with a lot of the liquid senior debt today. The broadly syndicated loan market is generally covenant light today, and I think it means that private equity firms have a long runway.
Speaking of runways, something that's been fascinating me, Danny had mentioned Lehman Brothers, but it's also the 25th anniversary since the collapse of LTCM. And you think about the leverage still being taken on by big multi-strat funds. We had the story we reported yesterday about Vista Equity tapping a credit line to back private equity stakes to finance a cash injection for Finastra. And you think about this rise, the surge in interest rates, and how comfortable people still are in taking on fresh debt. Do you think that has ramifications at the end? Is this a signal that we've stabilized, or is this not yet firms catching up with the reality of higher rates?
Look, I think it's a little bit of both. I think that higher rates are going to be a very large headwind in general for private equity. 20 or 30 basis point move in rates is very significant, but what we've seen is a 500 basis point move in interest rates. And I think this is going to impact virtually all leveraged buyouts because the vast majority of them are funded with largely floating rate debt. So I think it's a big deal. In terms of the rescue financing that we're likely to see, and you've just mentioned some names, I think there are going to be many more. I think there are going to be many transactions that are going to require some fine-tuning. And I think it's going to be a very exciting theme that will play its way out in credit markets over the next several years.
Robin, I'm afraid we're going to have to leave it there. I also know you've got Paris to prep for. We're both going to be at the IPEM conference.
Yes.
I will see you there. Enjoy your weekend. In the meantime, Robin, thank you so much for joining. That's Robin Dumar. All right, coming up, we're going to have a look at some of the market-moving events for you to watch throughout the day. This is Bloomberg.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He taught himself, self-made day trader. Yes. And so he's on the bus after a game in New England, and he's day trading on the bus. And Bill Belichick sees him and cuts him on the spot.
In many ways, it's convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, our fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London alongside Sonali Pasek in New York. All right, let's get you set up for your Friday. A look at what's ahead today. There's going to be U.S. Empire manufacturing data that will hit at 8:30 a.m. Eastern. We're also going to get industrial production. That's at 9:15. The key data today, though, is UMich consumer sentiment. That comes at 10 a.m. That has a tendency to also have the Fed rethink a thing or two. Plus, don't miss our exclusive interview with the French economy minister, Bruno Le Maire. That will be at 10:30 a.m. Eastern. Sonali.
Yeah, let's take a look at some of the stocks we're watching in pre-market trading in the United States. We have to take a look at those big three automakers, GM, Ford, Stellantis. They are falling largely as the U.S. union workers start strikes. I also want to take a quick look here at Carvana because you were watching it also come off of its highs yesterday, still up about 0.5%. But this is a stock, Danny, that took a 13% leg higher yesterday coming in to the strike deadline because the movement to used cars would be significant. Two of the big three are down about 2%. Stellantis is the only one still seeing some gain.
Yeah, there's some data out from J.D. Power. They estimated that if the strike persists for about 2 weeks, then new vehicle prices would see an increase of less than 2%. If that's new cars, though, used cars, I'm sure would have that type of even more increase, Sonali. And again, we're all living with the memory and the fear of that inflationary force during COVID.
Speaking of inflationary force, you are seeing some inflation in ARM stock because you are seeing another 9% gain in the morning today, or 7%, but gains have paired ever so slightly here. $68 a share. Remember, this priced its IPO at $51 a share. ARM is setting the stage for massive roadshows. Birkenstock filed for IPO just this week. Instacart, Klaviyo, we will watch them speaking with investors next week. Let's see if they can get the same kind of warm reception. Of course, they are very different companies, technology, but not the same type of technology, yet profitable. So some things to be watching out for.
Yeah, and you know what else to watch out for? First of all, Sonali, I want to say it's been an absolute pleasure anchoring this show with you over the past 2 weeks. I am going to miss you, but just got to give a little tease. Next week, I'm going to be launching a new show with Manus Cranny. The Bloomberg Brief will be speaking with Nouriel Roubini, the Blackstone CEO, and Seema Shah, among others. That's it.
you consider to be the biggest challenge?
Infrastructure that supports trade is the biggest challenge. Our senior brother, President Adesina of the AFDB, estimates the annual deficit, infrastructure deficit in Africa to be over $100 billion. But that over $100 billion is actually also an opportunity for investment. So it is a massive, a significant challenge that we are confronting. And my fear is that we may succeed in establishing a very effective legal construct and a very effective legal foundation for trade liberalization and investment liberalization in Africa. But all of that will come to naught if the infrastructure deficit is not addressed, because you will need the goods to move somehow, and you will need to have good trade corridor connectivity, ports, trade corridors that connect countries that are landlocked to the ports.
Markets count down in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
Context around European growth has changed.
There are really across the board weakness in the euro area to a lesser or greater extent.
Recessionary risks do linger as we move into next year.
I think it's harder to see higher inflation if growth is weakening in the euro area.
I think the Fed so far has done a pretty good job. I think the ECB isn't quite there yet.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Tonight, for the first time in our history, we will strike all three of the big three at once. Strikes in America, live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. Your equity market just about positive on the S&P 500. TK, UAW, no deal.
Not your mother's strike, not your father's strike. When I saw it, Lisa nailed it about the 10 p.m. shock. And the basic idea here is this is an original strike going back over to UAW history, back to 1958, into some real challenges, John, before World War II. It's an original strike, a selective strike. That's what's new.
We've heard from Stellantis. They're extremely disappointed. From GM, they said they offered an unprecedented package. From Ford, the union made little movement. The elephant in the room, Bramo, we have not heard from this White House yet, have we? We're waiting for a statement from the President of the United States.
Especially because reportedly he did speak with both the union workers, the union leaders, as well as the auto manufacturers. What did he tell them at a time where his policy is contradictory? On one hand, he's pushing for electric vehicles that a lot of the workers, the rank and file of the UAW, are pushing back on, and yet they are helping some of the auto manufacturing with those. On the other hand, it's the most pro-union president in history. That's what he wants to advertise himself as.
I learned a lot yesterday from our labor experts. I know Craig Trudell's scheduled to come up with us with all of his experience of his childhood in Michigan. But to me, what's so interesting here, John, you used to go on strike against all of Chrysler, all of Studebaker. We had a Studebaker, John. And the answer is this is different. You get a map out. There's 3 states involved. There's 3 models. We'll talk about that with Craig. It's highly unusual for you, me, Lisa, and the president. This is unusual for Biden.
So, Tom, as you indicate, it's 3 plants, 12,700 workers. Let's talk about the plants that are protected. TK, the Ford F-150, the Chevy Silverado, Ram pickups. If they want to ramp this up and escalate things, there's space to do that.
Well, they can do it, but they got to spread out the strike payments. And I'm sorry, I hope we have this here. I was going to use it with Craig. Let's use it now. The Bronco, Colorado Wrangler strike. Now, my up to speed, Matt Miller's our expert here on is a Colorado Cool, the GM Colorado pickup truck. I have no clue.
The Bronco's pretty cool.
The Bronco's big time cool. Like we had the CFO on sitting right here, 6 weeks ago, and he said basically they can't make them fast enough.
Well, now they're not making them at all, Tom.
Yeah.
Based on these strikes. From New York, if you are just tuning in, let's get you some price action. Equity futures on the S&P 500, positive by 0.1%. In the bond market, the data in America, pretty decent. Yields higher again this morning by 3 basis points, 4.32 on a 10-year. At the epicenter of everything we discussed yesterday, Tom, retail sales, PPI, the ECB, the downgrades to the outlook of the airlines, this right here, $90 crude in America. Tom, WTI, positive here by a third of 1%.
You got $94.63 intraday Brent crude. Javier Blas has beaten me over the head about Saudi light extrapolating out to $100 a barrel. I'm sorry, it's moving fast, and you're dead on. It colors every conversation, including Blumhout as GM of the Red Sox.
It colored the ECB conversation too. We'll talk about that later, Tom.
Yeah.
The euro looks like this.
The Red Sox.
106 on euro dollar currently, 106.64. And Bramo potentially heading towards a 9th week of weakness against the US dollar.
The longest potential streak of weakness since the joint currency was created, just raising the specter of whether these higher oil prices are a good thing on the heels of better Chinese data or a bad thing in terms of disinflationary and stagflationary kinds of ideas. Today, 8:30 a.m., September Empire manufacturing data, followed by 9:15 a.m. industrial production. Messy. It's getting really messy. But if we start to see a plateauing, does it really mean anything, especially after you do see input prices increase and on the heels of the strike? It's just a messy moment. 10 a.m. adding to the mess, the University of Michigan Consumer Sentiment Survey, which both of you love and really hinge on and really try to determine the sentiment going forward. Honestly, how much does this really reflect what we're seeing with respect to higher oil prices?
The rate of change of oil prices.
Exactly.
I mean, John, I was doing that math yesterday in the blur. I can't remember the numbers from July or June. And come on, we're on the edge of moonshot.
It's always amazing how spot crude prices and where gas is right now can shape perceptions of where inflation will be later, and no doubt we might get a sense of that a little bit later.
And how much people are willing to spend. And at 10 o'clock, we do hear from the France Economy Minister, Bruno Le Maire, with Bloomberg's Maria Tadeo. But this comes as EU financial ministers meet in Spain. Christine Lagarde will be there, the EU Economy Commissioner Gentiloni, Spain Economy Minister Nadia Calvino. This is going to be awkward because they really disagree. You heard from the German finance minister. This is a good thing.
What's the outcome of this meeting, Bramo?
Well, they're going to be talking about what the region needs and what the specific countries need to foster some growth at a time of really stagflationary headwinds and a controversial rate hike yesterday among some of those officials. And so we've already heard that pushback.
Calvino already complained on Bloomberg TV in the last 20
She was
minutes.
with us. I
done.
loved it.
She
I
hopes they're
loved
done.
when she was here. I mean, they're really living between climate change and an inflation of the agricultural complex known as Spain. Spain is getting hammered.
Big time.
Yeah.
Europe, many parts of Europe, including Germany for that matter, getting
They
hammered
do
too.
okay there?
That was
Yeah,
wonderful.
thank you.
That's
I
enough
enjoyed that,
ECB chat. Let's get back to our top story. Strikes at the big three in Detroit. Craig Trudell joined us out of London. Craig, we've got them, all three, simultaneously at the same time. Craig, at what point did this break down? How big is the difference between GM, Stellantis, Ford, and UAW?
I think the writing honestly seems to have been on the wall. I think we've for weeks now known that the union and these three companies are far apart. In terms of the negotiations, I think on both sides you have complaining and sort of allegations that neither side is budging or going anywhere close to sort of the other's direction. So I wouldn't necessarily cast this as a breakdown, a sudden realization that we're just not going to be able to do this, because we haven't come anywhere close to these companies and this union being able to come to agreements on new contracts.
Auto guy, what is this? What is the imagery here, or the message from Bronco, Colorado Wrangler? I mean, those are all cool cars for 23-year-olds, right? Is that the message?
Yeah, I think it's both. These are cool cars. These are profitable cars. These are trucks and SUVs that these companies count on for serious revenue and profit. That being said, the UAW does have some very big, sort of arrows in its quiver to sort of, use some imagery here. They do have the F-150 pickups, the Silverados, the Rams, as mentioned earlier. And just generally, they have quite a few plants to add to these three facilities that they're walking out from. it's really interesting to see the companies, not know sort of what's next. The union is explicitly talking about sort of keeping these companies on their toes. And also, I think, the union is being strategic about, striking every one of these companies, but also doing it in the selective fashion means that they could draw this out and not deplete their strike fund, too quickly.
An index that the government uses is the Welch-Trudell We Run Out of Money Index. Craig Trudell, when does the union run out of strike funds?
That, of course, will depend on, just how much additional pressure they want to exert on these
give
companies.
me a date. Christmas?
I mean, what we saw with GM, right, is months long a few years back. And so, I do think that this is absolutely the case, that the union could drag this out for weeks, potentially months. Now, whether we see, the union be able to reach an agreement with one of the companies and go back to, pattern bargaining like we've been used to it in the past, I think, the unfortunate answer is we have no idea what the union strategy is, and that is very much their intent at this point.
Craig, do you get a sense of what the line in the sand is at this point, of what will get it done?
I honestly don't have any clue of sort of what could possibly get us to a point where either side is talking about what we feel like we're closer. And the problem here is that there is so much going into these negotiations. We don't just have a simple issue of one side wanting a certain amount per hour and another side wanting a higher or lower wage than that. We're talking about cost of living adjustments. We're talking about representation of battery factory workers or whether or not those stay non-union. We're talking about pensions. And so there is so much that's going into these negotiations. They're so complex and multifaceted that it's really difficult to sort of, game out what is it that's going to sort of, get the union comfortable with what these companies are willing to offer.
Craig, stay close. We've got a lot to talk about. Craig Trudell there out of London on the latest. TK, where is the most pro-union president in the history of this country?
He's got to get up and he's got to get his Wheaties here this morning. But can you imagine the conversations of how to explain to this is not the strike that young Joe Biden knew, or frankly, young Tom Keene knew.
He has to come out on their side, doesn't he?
New.
He can't sit on the fence here.
That's a really important question. I mean, very importantly, Anne-Marie Horton and Joe Matthew have the former vice president of Indiana tonight. You wonder does Mike Pence stay on the fence? I mean, does he talk to the UAW in Indianapolis here? I don't know if they're not in strike yet, but maybe they will be.
Sure.
Do these guys stay on the fence given a strike? That's
the former president. I think everyone's after the vote of this particular union.
Yeah.
Euron Timmer joins us now, Global Macro Director at Fidelity Investments. Euron, we're going to have some time together to talk about markets. Just wanted to get your thoughts on this strike. And a question we've asked continuously over the last couple of weeks, whether you view this as almost the dying embers of a hot labor market, or whether this is something we're going to see more of in years to come.
Well, good morning. And that, of course, is the big question. Has the labor versus capital pendulum swung for real? And I think there's some good reasons to think that maybe it has, because the last couple of decades, favored capital holders, right? Period of low inflation, low interest rates, of labor arbitrage around the world. Perhaps that trend is ending. And I think what we're seeing in the headlines today speaks to, the issue of whether inflation really has become a structural phenomenon or whether it was really just a passing thing that happened during COVID. And so if we're going to head to an inflation era of, let's say, 4% instead of 2%, then all the assumptions we make in the markets, and investing, as you know, is making real-time decisions with imperfect information. All those assumptions need to be questioned, including when the Fed will pivot, if it will pivot at all, whether it's even done tightening, whether the TIPS market is correct in pricing in 2.25% inflation as far as the eye can see, what that does to the term premium, and if the term premium, which is still negative, flips to positive, we could be at a 5 handle in the 10-year. So there's all kinds of snowball effects of whether we really are in a new inflation era.
You're into John's good question. The heart of the matter to me is a $63,000 GM Colorado Bison pickup. It's not what you and I lived was if the rich kids had a $9,000 57 Chevy. This is about the partition in America of the haves and the have-nots. They're building cars for what? 15% of America?
Yeah, I mean, it speaks to perhaps the end of this very, very long period of, what we call the Great Moderation. And, obviously the wealth equality or inequality is part of that same mechanism. And a lot of very smart people have written, a lot of very good reports about that. But if that trend of great moderation really is reversing, then that really changes a lot of the assumptions we make as investors. And so, including the valuation level in the S&P 500, maybe we're heading into not a bear market, but a period of valuation headwinds instead of tailwind.
True. Urian, you're going to stick with us. Fantastic to have you with us. Urian Timmer there at Fidelity Investments. TK, is this another story that just screams high for longer?
Well, higher for longer. It's going to disrupt everything, and it comes back, as Lisa was mentioning, on growth in Europe. I'm sorry. All of the babble we do about rates and that comes back to economic growth. And
every single time.
There was a headline yesterday that Lagarde wanted to ignore. And it's the same thing here. What does this strike do to our U.S. GDP?
Sarah Hunt of Alpine Saxon Words in the next day. Urian Timmer sticking with us, and we've got to squeeze in a little bit of a conversation about a man who was stuck at Burning Man for 2 weeks. Urian Timmer was that man. Equity futures on the S&P positive here.
Should I go to Burning Man?
Good morning. No.
On the David Rubenstein Show, peer-to-peer conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television. How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is gonna be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
Wall Street is waking up. Europe is already trading. And starting Monday, Manus Cranny and Danny Berger will make sure you have the news, data, and analysis you need to set your agenda. Micro, macro, and everything in between. Manus in New York and Danny in London follow the money around the globe. Take a daily deep dive into risk and help you make informed decisions for your trading day. Watch Bloomberg Brief, weekdays at 5 a.m. Eastern, premiering Monday, only on Bloomberg.
Still a very tight labor market. You're not creating jobs at the pace that you were. But there's absolutely no sign of that switch being flipped and for workers to start being laid off. So, I think power is still in the hand of a worker rather than the manager. I'm not worried about an organic slowdown in the US economy. There's no sign of demand falling off a cliff.
Power in the hands of the worker. Michael Shao, CEO of Market Field Asset Management. Fantastic to catch up with him. We have strikes on the big three, limited strikes, and I think that's reflected, captured in the stock price this morning. Ford is down by 1.7%, GM is down by 1.5%, Stellantis is actually positive.
It's not American. Come on, it's Chrysler.
TK, 12,700 workers across 3 plants. For now, it's limited. This is about how long it goes on for and whether it spreads.
Now, we're going to learn about this. I mean, limited till when? Friday? Next week?
Don't know.
We don't know. We're making it up as we go. The way I feel sensitive about this, John, and I mean, I guess we got to do data here, but, I believe in community, art, self-expression.
Where are you taking this?
I just, the mail's coming in. Someone named Anne Marie in Washington emails in and goes, "What would you wear at Burning Man?"
At Burning Man. Okay.
I wear what I wear. I wear this everywhere. So I took three.
You wear a bow tie.
I took 3 suitcases once to Asia. Never again. This is the uniform.
Just a bow tie, or other clothes around?
Oh no, I'd wear this. Maybe I'd
just trying to figure this out. Bramo, just trying to figure it out. Just want to know.
What's the appropriate, Lisa? What's the appropriate mud boot? There's got to be like a Farmall Greydall mud boot or whatever.
You think that I've been to Burning Man? I don't know. I normally wouldn't need a mud boot.
You say Burning Man. I can see Bramo there.
Bramo at Burning Man.
Would you like?
I can now see you at Burning Man.
Actually, you'd be your own arts installation.
That would be very cool.
Community art.
You'd just welcome and everyone would gather around the campfire and Tom would tell you stories.
Yeah.
Perfect. You can talk to Urian about it.
Bring in Urian here.
Urian Timmer, do you think Tom would fit in at Burning Man? Does that work for you?
He knows how to cook. He fits into our camp any day.
Do you know how to cook, TK?
No. I know how to boil water.
Urian, sit tight. I've got to whip through some price action just briefly. In the equity market on the S&P 500, we're shaping up as follows on the S&P futures, just about positive by 0.1%. I want to look at the euro. Positive here by 0.2% to 106.66. For the euro right now, what a tough position. The ECB didn't want to commit to a pause, but it certainly sounded like a pause. The complaints that they're getting so far this morning, we already talked about the pushback from Spain to Maria Tadeo moments ago on Bloomberg TV. This from Matteo Salvini, the Italian Deputy Prime Minister, had this to say. The ECB, which doesn't care about the economic difficulties of families and businesses, is increasing the cost of money. Lagarde is living on Mars, is the message coming out of Italy, Tom. A certain part of Italy this morning.
Oh, this is the divide of Italy, and it's like the 50 states of America, but every lesson we've learned is it is not the 50 states of America, and the fractious Europeans each have their original story. The key single word I saw yesterday, going back to Trichet, is the word transmission. These dynamics transmit through the American economic experiment way different than they do through Europe.
They transmit through the banking system in Europe
difference.
in a much more profound, pronounced way. Urian Timmer's with us, Global Macro Director of Fidelity Investments. Urian, can we get a flavour for the Federal Reserve next week from the ECB, or is the ECB just its own beast on its own planet, perhaps, as Matteo Salvini pointed out, perhaps on Mars?
I think the Fed will do what we all expect it to do, which is to pause and basically indicate they're data dependent, and the question is, when will it pivot, if ever? The market has been consistently incorrect in expecting an imminent pivot. And the market can be forgiven for that because history shows that when the Fed stops tightening, it usually starts easing very quickly after that. So maybe the forward curve, the SOFR curve, is just a math project based on history. But the big question is the market, the stock market, has been playing the soft landing scenario, and that certainly is panning out in terms of the economy. Earnings looks like it has bottomed in the second quarter, but part of that scenario was an imminent pivot back towards a 3 handle. And I think the news that we're seeing about the strikes, inflation in general, core PCE remaining pretty sticky above 4%, and what we saw in the ECB is that the higher for longer narrative is going to persist, even if the Fed is indeed done tightening rates. And that is something that the market really isn't priced for.
Well, let's talk about the price of energy. $90 crude. Does that disrupt the soft landing hopes and dreams?
It could. I mean, obviously, American consumers are spending less on energy than they used to, a few decades ago, and certainly on the core inflation measures, it's going to have a limited impact. But the base effects of the inflation data from the last few years, of course, that ran out a few months ago. So we have likely seen the most of the improvement. And I think the fact that core PCE, super core PCE, all remain at a 4 handle, even though the tips market is pretty steadfast on predicting 2.25 as far as the eye can see. I think is definitely a disconnect between the market and the reality. And it's certainly one of the assumptions that I think we all need to look at, because it will reverberate to many other aspects, right? I mean, R star at 1%, you add inflation, it tells you neutral policy is maybe 3.5. Well, maybe neutral is 5 instead of 3.5, in which case the Fed isn't even that restrictive yet. So there's a lot of, there's a snowball, a chain reaction there once you start questioning the assumptions that we have in the market today.
So you're not buying, Yuri, in this idea that we've reached the end of rate hikes, both in the ECB and the Fed, like many people think?
Well, I think we may very well be at the end of rate hikes. But again, the question is, how restrictive is the Fed, right? So if you look at the TIPS market and the Fed's at 5.25 to 5.5, the Fed is at plus 300 basis points versus inflation, which is very restrictive, right? And if you look at R star 1.25%, you add 2.5% inflation, the Fed is restrictive. But again, these are all assumptions, and that's one of the challenges that we have, is that we're all making investment decisions based on assumptions about whether a certain regime will persist or whether it will reverse, and it really does all come down to inflation. And when we look around us, to me, it looks like it's going to be a lot harder to get from 4 to 2 than it did from 9 to 4.
So, Jurien, final thoughts on what we should do as investors: park in cash, hide, take my 5% yield. Jurien, what should I do?
I think this is becoming a more tactical market, which I hate to say because I tend to not believe in tactical trading. I'm more of a long-term person. I do think, some variation of the 60-40, whether it includes cash or tips, remains a good idea. I mean, in the bond market, for instance, you're getting 4.3%. If we go to 3%, that's a 10% return. If we go from 4 to 5%, that's only like a 1% negative return. So the risk reward in the bond market, even if bond yields have not finished rising yet, remains pretty compelling in a 60-40 portfolio. So I'm still there. I'm still constructive. But when I look at all the factors that we're discussing, and I look at where we are kind of in the secular bull market, my guess is that maybe we're in the twilight phase of that secular bull, and we're going to start seeing valuation headwinds instead of tailwinds. And again, that doesn't mean the market goes down. It just means that price action has to be completely carried by earnings rather than PE expansion.
Jurien, always thoughtful. Thank you, sir. Jurien Timmer there of Fidelity Investments. A ton of multiple expansion through the year so far. These yields just aren't going anywhere, based on what we've seen over the last month. The 2-year still in and around 5%. The 10-year still at about 4.32. Had a lot of people lining up to say this move, Tom, was unsustainable. And here we are, another month, staring down the barrel of the same numbers on a 2-year, on a 10-year, on a 30-year.
Except there are singular statistics that agree with that, like Swiss franc, Euro Swissy really hasn't moved, doesn't indicate fear out there. And I got a single bullet, 93.94 on Brent crude. That's moving.
That's a big change.
I don't know how that changes the debate here, other than in a slower growth environment, that helps.
It can change, of course, but Lisa, the 30-year is back in the 440s this morning.
The change has been that the U.S. economy has withstood some of these higher energy prices and seems to keep chugging along.
Let's see if that can keep happening. Based on what we saw yesterday in retail sales, pretty decent. Supported by what's happening with gas prices. You want to talk Formula One? I know you do. I can see it on your screen. Got to wait, Tom. Neil Shearing of Capital Economics.
They drive at
It's coming up from New York. This is Bloomberg.
what's the best investment advice you've ever been given by anybody?
The compound interest, the compounding of returns is an incredible miracle of business, finance, and human existence. Everything you learn is additive every day, and if you keep at it and don't quit, it's an incredible miracle. And it's not just interest. It was always said about compound interest returns, compound business returns, compound human returns. They're all very additive because you learn every day. And if you keep at it, it's very, very helpful.
In your observation of investors, what do you think is the biggest mistake that average investors make?
Selling at the wrong time.
And they sell when the prices go down?
Yes. Yes. Not keeping. Look, people have conviction, or they invest if they invest for the right reasons, just keep at it.
skincare for men in their 70s that have a lot of wrinkles. I mean, is there any way to get rid of the wrinkles?
I have a lot of amazing things,
Really?
but maybe it'll be a little bit beyond skincare.
Heading towards a week of gains on the S&P 500. We're up on the week so far through Thursday on the S&P and on the NASDAQ too. Equity futures this morning on the S&P positive by 0.1%. On the NASDAQ 100 down by about 0.1%. In the bond market, yields higher off the back of an upside surprise on US retail sales and PPI, driven to some extent by what's happening in the commodity market. Yields up by 2 basis points on a 2-year, 5.0368%. Back in the 430s on a 10-year. Lisa, back in the 440s on a 30-year.
What happened to all the buyers out there? People who said they were going to come in and yields were going to come in softer. There is a question of what's behind this. Is it really inflation expectations, or is there something structural going on at a time where real yields on the 10-year Treasury are climbing toward the highest levels going back to March of 2009?
10-year real yield just popped 1.98%. If we go into Friday here and go into the weekend and pop over 2, that's a huge deal.
The data's better in America against expectations, and particularly relative to what's happening in Europe. President Lagarde in the news conference yesterday, very, very sluggish. The euro just about reclaiming 107 right now, positive by 0.1%. The euro just a touch stronger here, but at the moment we've been looking at 106. In fact, on my screen, I think that's wrong where the single currency is on that board. On my screen, I've still got the euro at 106, 106.56.
Well, you round it up. That's a 2-digit. There's the difference between a surveillance 4-digit analysis versus 2-digit.
Well, I always want the 4 digits, TK. It's
yeah,
foreign
I agree.
exchange.
Totally agree.
On my currency pair right now, 106.57 on the euro. Just about positive on the session, but down on the week, potentially for a 9th consecutive week. And the move in crude is where the story's at for me. Commodities, WTI, Brent. WTI at the moment, 90.65. Brent crude, new highs for the year on Brent crude at $94 a barrel, Lisa.
And this is on the heels of what we saw, which is better than expected data in China. And that's the worst thing of all worlds, because on one hand, it's going to feed into demand for oil, but not enough to juice growth. This is sort of why Europe is in the midst of a toxic
Unreal. A very, very toxic brew, Bramo. Under surveillance this morning, the United Auto Workers starting an unprecedented strike at all of the big 3 automakers. UAW President Sean Fain saying, quote, "This strategy will keep the companies guessing. It will give our national negotiators maximum leverage and flexibility in bargaining. And if we need to go all out, we will. Everything is on the table." President Biden said to address the strike later on today. Tom, no time, but from what I understand from people down in Washington, no time because they're not sure what they're going to say about this just yet.
I wonder if he's capable of stripping away the mythology that he grew up with, because the strike that I saw last night is not the mythology of the American labor economy. It is a new phenomenon we're seeing this
Muted
morning.
price action this morning. Do you think it's a coincidence, Lisa, that Tesla's having its best week of the summer, going all the way back to June?
I would guess not. And I would guess that also Tesla's been absolutely rocking it on all sides, no matter what happens. So they've had an incredible year. But this to me is really at the crux of the issue, which is the electric vehicle makers and the ones that aren't unionized are going to cash in on this. And that's the real risk for GM, Ford, and Stellantis.
Very scientific.
I can't even say it.
I see a lot of Teslas on the street.
Yeah.
That's a fact. That, small matter.
Agreed. And the stock is positive this morning in the pre-market. Our next story from ARM climbing 25% in its trading debut. The chip designer raising $4.87 billion in the year's biggest initial public offering.
Woo.
The company selling 95.5 million ADR shares at the top end of the range, 47 to 51. Do you think it's accurate, Lisa, to say they raised money off the back of this IPO, given the nature of the transaction?
Yeah, basically it was a fundraise, right? But it was also a marketing tool. I mean, you have to imagine this.
Yes.
But to put some numbers on it, they could have priced it at $52 a share. They priced it at $51 a share. Masayoshi Son came out and said, we don't want to add the extra dollar because we want it to be a big pop, big boom. Look how well SoftBank is doing. Our tech investments have been rocking it.
Okay.
They left $100 million on the table because
this is some really good research on this about how these IPOs,
That's all I think
work.
of.
But how these IPOs work out. There's been a lot of good research on this as well. Guess what? There'll be a first earnings call. That's when it starts.
To Lisa's point, they want us to talk about ARM and not WeWork and all the other things. Disney cutting its target for streaming subscribers. The company announcing it will fall tens of millions of subscribers short of its last publicly stated 2024 target for the Disney Plus franchise. This according to people familiar with the matter. Returning CEO Bob Iger saying the company will no longer provide subscriber forecasts following a similar announcement made by Netflix. It is not going well, TK, for Bob Iger this time around.
It's a broken system, but frankly, creative Iger is the one to help out financial Disney. I'm fascinated by this. I was thunderstruck by what was it, the ABC, should I say rumor or speculation of shipping out ABC to
reporting.
Nexstar?
Reporting encouraged by the man himself, I would suggest, by indicating that some of these divisions aren't core to what Disney is trying to achieve.
And I've told this to Paul Sweeney, who's expert on this. I'm just absolutely baffled by it. You know, I just don't know what they do. I look at home, at what gets used. Disney Plus doesn't get used. That's a fact.
Well, but how old are your kids? I mean, that's a key aspect.
Can you run a streaming channel off 8-year-olds?
The point. Well, I'll leave that there.
Son.
It's a good question. I think a lot of people would say, yes, you can if you look at the consumption during the pandemic. There is a question, though, going forward of whether Disney is basically kitchen sinking it right now and trying to streamline everything with the focus on the parks business and the cruise business, which I know you guys are purveyors of. But this really is going to be throwing it all at the door so they can start over.
The parents in the control room, our producers, already writing in the answers, yes, Tom. Apparently you can. Just a bit of feedback there, TK.
A little bit of constructive feedback. Tom Keene, the pinata. Joining us now amid this flow, and we're watching from the White House to see when the president will speak, is R.J. Gallo, Senior Vice President of Federated Hermes. And we're thrilled that he could join us this morning because he's got the smartest bond note of the week. R.J. Gallo knows that one of the efficacious things to do in bonds is look at the Bloomberg Total Return Index and see that for all the talk, yap about coupon credit spreads, blah, 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 bonds have gone nowhere. R.J. Gallo hypothesizes that bonds are not back. Thank you, R.J. I looked at the chart off your note, and I was thunderstruck how the blended price of bonds is really not advanced. Is it still a bond depression?
Well, in the note that you're talking about there, I made the point that when we started the year, we felt that it was going to be a favorable one for bonds, and clearly it's fallen short. The Treasury index is basically at zero. The ag is up, I think, 0.5%. So yes, it's been disappointing. I would also note glass half full. The double-digit losses of last year, recall the ag was down like 13%, are clearly behind us. And looking forward, we're much more optimistic that the time for fixed income giving you sort of low single-digit positive returns and acting as a powerful diversifier in your portfolio, that is in fact back. With yields at the highest of the last 12 to 15 years, we think value has been restored, and fixed income investors should think about extending some duration, getting out of cash, legging into fixed income will be a good move over the next 12, 24 months.
Okay, 12 to 24 months, I'm going to get going. When do I get back to the regression line that I had for 30 years? You know, the Bill Gross, great moderation, price up, 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 up. How many years is it going to take to recover from what we've seen the last 2 years?
I hate to say it, but I think that the zero lower bound, presents a significant wall to anything like the returns that we saw over the 20, 30 years leading up to the pandemic. If anything, we believe that it's quite possible that equilibrium yields are higher post-pandemic than they were for the decade plus prior. It'll be interesting to see if the Fed goes there with its long-run dot, maybe inching up in the dot plot closer to maybe 3, maybe a little higher. If you look at forward curves, you can see that the market is there. The market believes equilibrium yields are higher. And in that sense, it's going to be a while before we see big price returns from taking a fixed income, high-quality fixed income investment. Instead, I think we'll probably be looking for oscillating markets around a higher equilibrium, which will still provide a nice return and ballast for your portfolio, but it's not apt to be double-digit price returns anytime too soon.
Is this higher yield driven by inflation or driven by something else, whether it's a budget deficit that spooks investors or a changing central bank regime in Japan?
That's a great question. I think that there's been a number of factors that have shifted us towards what's probably a slightly higher equilibrium yield environment. The budget deficit's a big part of it. Sovereign debt has exploded. We've got a lot of debt to roll over. Obviously, Obviously, we have structural imbalances here in the U.S. that no one wants to deal with in Washington. So that's one factor. I think on the favorable side, a lot of talk about AI, about technological innovation. In the long run, when you have technological innovation, your potential growth rate goes up. Higher potential growth rates, higher equilibrium yields. That's actually a positive thing. That could put more people to work. Of course, you've got to talk about the issues of displacement, who gets jobs out of the new technology, who loses them. But ultimately, I think higher potential growth rates, larger budget deficits, and some pushback against internationalization, the pushback against the global trade marketplace that helped to produce low inflation and low yields prior to the pandemic. Now you're talking about onshoring. That's a big change. And I think ultimately that too is probably going to lift yields a little higher, as the disinflationary impact of globalization might not be as strong as it was in the prior 10 or 15 years.
That's in the years ahead. In the here and now, we're looking at a UAW strike that's roiling Washington, D.C., but also Detroit. Does that factor into your yield call? Does that factor into the bond space as you look out to understand the growth as well as the inflation picture?
Yes, it does. I mean, obviously it cuts in two ways. First and foremost, these workers are looking for raises. It's no surprise. We've dealt with the highest inflation in 40 years. A lot of workers are looking for raises. That makes sense as they deal with the higher cost of living. You stop there, you would think that strikes have to be inflationary. Ultimately, however, you got to consider the near-term impact of a strike is less production, less economic activity, and the multiplier effects that occur in the local economies around these three plants, and if it extends to more plants, that economic impact only grows. I think ultimately this idea of empowered labor across the country is very predictable at a point in time like this. I think it's challenging for the White House, as you guys have been saying. I think from an economic standpoint, I'm focusing a little bit more on the growth headwind that it's going to produce in the near term. It's not the case that every dollar of raises that the auto companies are going to give these workers to get them back on the job, that's going to be simply passed through one for one into higher prices at the dealership where we buy our cars.
I've got an equity question, RJ. Can I squeeze it in? Because I've only got about 30 seconds left with you. Do I want to avoid industries that are witnessing, like we see in airlines, like we see in automakers, this powerful movement from labor?
In terms of what industries you would go to avoid it?
Should I avoid the airlines? Should I avoid the automakers purely because of the evidence of labor market power? Should I avoid those industries?
Well, I do think it's clearly a margin compression story in these industries. As I was saying, the automakers won't be able to pass through to price one for one the raises that their workers are going to get. I clearly think that is a challenge. In terms of sector rotation on the equity side, I don't know if I would necessarily avoid it. That's really not my main area of expertise. I can tell you on the fixed income side, we've been relatively cautious on investment grade corporates and high yield because we think a broad-based margin compression is a story that's still out there, and we're not as optimistic on corporate profits in general. I would focus on that from a broader macro perspective.
Interesting. RJ, thank you. RJ Gallagher of Federated Hermes on some important issues. If you're just tuning into the program, welcome. Equity futures here positive by 0.1%. Lauren Goodwin of New York Life Investments joining us in about 45 minutes time. These are really, really important questions. How we think about some of these issues right now, Tom, not just margins more broadly, but the viability of some of these industries. Helene Becker on this program yesterday talked about the prospect of one of the big airlines failing, Tom, because they couldn't address these issues in a way that would be profitable for them.
I was wrong years ago. I used to believe in diversification, and Peter Lynch called it diversification. Peter Lynch correct, Tom Keene wrong. And in terms of sectors and industries, you're 100% right. The way you make money is by not losing it in value-trapped, dead sectors.
Well, the concept of diversification is changing, and I think that that's really becoming clear. It's those that are hinged to an economy more subject to some of these negotiations, and those that are newer and more divorced from it. It's almost the new and the old economies at war with one another.
Yes.
The revenge of labor market power in a big way. Geetha Raghunathan, US media analyst over at Bloomberg Intelligence, will be joining us shortly on the forecast or lack thereof from Disney+. That's next from New York. This is Bloomberg.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He taught himself, self-made day trader.
Yes.
And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, our fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
On the next episode of Hello World, meet the women driving Kyrgyzstan's tech revolution.
This is the first satellite in our country.
And some speedy horses. Watch Hello World Thursdays at 8 p.m. Eastern on Bloomberg Originals or 10 p.m. Eastern on Bloomberg TV.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
Chapek overspent on streaming. He basically was chasing subscribers, not profitability. It takes time to turn that around. You have to buy in Hulu. But I think what we would say, and I think it's fair criticism, is that the communication out of Disney since Bob has come back has been very poor, right? They basically have thrown out a ton of ideas and they tease the market without delivering on what the story actually is going to be.
Michael Nathanson, the senior research analyst at SVB, Moffett-Nathanson. More confusion this morning. Disney cutting its target for streaming subscribers. The company announcing it will fall tens of millions of subs short of its last publicly stated 24 target for Disney+. Your equity market shaping up as follows on the S&P 500. Equity futures still just about positive by 0.1%. Yields bleeding just a little bit higher by 3 basis points to 432. Crude in the 90s. Have we got to get used to that? Crude 90, wow. 61. In the FX market, the euro 106.58 and positive 0.1%, coming off the back of the worst day since July for the euro, Tom, in yesterday's session, given how decent the data was stateside and how bad things look for the ECB over in the eurozone.
Tom is wrong. Did you notice that?
That's a new one.
That's a new one. Disney Plus, Animals Up Close, Elemental. It's a Pixar movie.
Okay.
Didn't do that well.
The mail is coming in. Seth Rosen, thank you, Seth, so much for writing in this morning. He says, Tom, you're wrong. And I guess Disney Plus is a big deal. I don't buy it, but
so
I'm
you're
wrong.
surveying 8-year-olds this morning.
The 8-year-old cohort, is
the children of the parents in the control room are weighing
Disney
in.
Plus are, doing better than good. We're going to digress some huge news. And seriously, we still don't know when the president's going to speak, right?
No time just yet, no.
Yeah. Okay.
I'm not sure if the president knows what time it's going to be.
We're going to go to Disney Plus and the intractable issues that Mr. Iger faces. Geetha Raghunathan joins right now with Bloomberg Intelligence. And Geetha, to me, this is about fancy companies flying in fancy McKinsey, BCG, Bain people, the strategists to save the day. What would the strategist say this morning to Mr. Iger? Let's pick on McKinsey. McKinsey Media shows up. What do they say to the leader of Disney?
Well, they already have, so good morning, Tom, thanks for having it. So they already have a lot of things that are going on right now at Disney. So you have, on one side, you have the streaming business, which, as you just pointed out, is losing subscribers. But then the whole narrative there has really kind of shifted away from subscribers to profitability. So that somehow Bob Iger has to show that this business is going to be profitable sooner rather than later. We know Netflix has kind of already set the template in the market. There is a blueprint for streaming profitability. So they have to figure out a way to get there. But more important for Disney right now is to somehow kind of show the market that they have a plan for their linear TV networks. And And the linear TV networks have really been in the news a lot over the past few days, whether it was that dispute with Charter, and more recently, all of these news reports about them looking to kind of dispose off some of their networks and multiple bidders emerging. So there's a lot going on there, but I think as soon as Mr. Iger can kind of clarify the narrative, it's all going to become much better.
But Geetha, we had Michael Nathanson commenting earlier, and I look at Moffett Nathanson for 10 years has talked about cord cutting. And they were correct. And I believe Moffett Nathanson would say, you know what, it actually happened faster than we thought. Is Iger listening to the public? Is Iger listening to Seth Rosen?
He absolutely is, and he's been forced to. I mean, the data is staring at you, in the face. So there's no way to sugarcoat the fact that the industry is losing subscribers. We've lost roughly 25 to 30 million subscribers over the past, 5 to 10 years. So that is, the writing is on the wall. Bob Iger has said that, they are willing to take the steps. He has actually publicly said that the linear TV business is no longer core to Disney. And if you just kind of look at the Disney profitability profile for 2023, out of the $13 billion that they will generate in profits this year, 75% of that is going to come from parks. So they really know where they need to kind of focus. It has to be on the parks business and getting that to even higher profitability. And it has to be, reducing losses in the streaming business, as well as kind of keeping, the linear TV business in cruise control, because the streaming business will lose close to about $3 billion this year.
Today, it seems like stock investors are getting the message, Geetha. We are seeing a 0.9% pop in the Disney shares ahead of the open. It does seem to be like that is the narrative that's coming out of this, right? Especially not giving subscribers for Disney Plus, which is a successful platform, but not necessarily emphasizing growth. And then the news about ABC. Does this mean they're not going to be investing in content, that they're hoping to save money on that front?
They definitely, that's a great point, Lisa, and they definitely are looking to save money on content. So they had initially projected about $31 billion in content costs for 2023. They've actually taken that down to $27 billion. So there's already been some, reduction on that front. Of course, that is largely in part due to the Hollywood, the dual strikes. But even going forward, I think they are going to take a really, really disciplined approach. I mean, Bob Iger has openly said that, they're not going to be greenlighting projects left, right, and center, whether it's for the film business, whether it's for the TV business. So they're definitely taking a hard look. And remember, they haven't really performed all that well on the content front as well, especially you brought up Elemental. That's a great point. I mean, we've seen a string of misfires from the Disney studio. I mean, this is one of the best performing studios in the history of films. And so it's kind of been a little bit of a disappointment, but I think he is kind of really looking to revamp all of the content franchises right now.
At the same time, ESPN long considered a contender for a sale by Disney at a time when it was at the heart of a dispute with cable over the past couple of days. Is that still for sale? Is that still the rumor out there, or is there going to really focus on expanding and fortifying this, because sports really are the heartbeat of all of our media content?
I absolutely agree. I actually think it's the latter, that they will look to keep the ESPN network. What they're trying to get rid of is the rest of the linear network portfolio. They do realize that they have a lot of opportunity with ESPN. They're already paying about $9 billion every year in sports content costs. There's a huge advertising business there. There's a huge affiliate business, and I think there is a lot of potential. So I think they will look to keep ESPN, dispose off the rest.
Yeah, but the heart of the matter, as you led with, Geetha, and you're expert on this, is everybody needs to be Netflix. So Disney Plus picks up the Australian animation Bluey, and it's Bluey Heeler and his sister Bingo Heeler, and that's all great. Can Bluey from Australia deliver for Iger 21% EBITDA margins?
It actually can. It is going to take a little bit of time. What Netflix has achieved has been over a period of, 10, 12, 13 years. Remember, just a few years ago, we were criticizing them for burning about $3.5, $4 billion in cash. So it's taken a while. So, yes, they have kind of set the template, and Disney needs to take a page out of the Netflix playbook. So it knows exactly what it needs to hit. And I think they will. By fiscal 2025, 2026, we are going to see this business generate fairly good margins and ultimately get to that 20-25% margins. I think it's absolutely achievable, but of course a lot needs to be done before we can hit those targets.
Geetha, let me share some of my emails with you. Hi Jonathan, the price of Hulu, no ads plus live TV, Disney Plus, no ads, and ESPN Plus with ads will increase on October 12, 23 to $89.99. TK, 89.
Wow.
99.
A month?
YouTube is
89. 99.
A month.
$90, I believe, is what we call that.
Yep.
That's like a barrel of oil.
89.99.
You can get a barrel of oil in Bramo's living room.
That's where we're at.
$1,000 a year, more than that.
That is where we're at.
Bramo does the math. That's ridiculous. It's ridiculous.
Agatha, can they put up prices anymore?
I mean, it's going to be tough, but actually the recent deal that they did with Charter suggests that they are now willing to kind of rebundle all these services. I think in many ways that was kind of a landmark deal. Where we are coming, I know it sounds almost silly and ironic, but yes, there is going to be the great cable rebundling. Charter was the first step. I think we're going to see many more of those deals happen.
Geetha, thank you. Geetha Ranganathan there of Bloomberg Intelligence. Throw in the cost of broadband, TK, and we're back to where we were, aren't we? Maybe more.
We're so back to where we were. This is the one discussion, I've said this to Paul Sweeney, where the pros like Geetha Ranganathan, Michael Nathanson, Rich Greenfield, and the others, the confidence in their voices that they're going to succeed to get the income statement where it's supposed to be. I wish I could get the reach to get there. It's the one thing I can't get across the canyon, the Nathanson Canyon.
I'm glad you mentioned Michael Nathanson, because he was the one that said that the new model for sports and the new model for cable is the old model, which is bundling, and that is it
So
worked.
What are you going to do with $90?
So why stop it?
What are you going to do with $90 a month? That's stunning.
I'm looking elsewhere. I mean, what are we paying for? Peacock, Paramount. Peacock has the Premier League football. Paramount has the Italian football. Then you've got Netflix. I gave up Apple Plus.
Are you popping over $300 a month?
TV, not Apple Plus, but gave up Apple. It's expensive, let's put it that way.
It adds up.
If you want to watch all the sports, if you want all these different things, it adds up pretty quickly.
I went through 2 weeks ago and got rid of a bunch
bundle.
of them. Yeah.
It's your used car.
My streaming bundle
That's how much it costs.
is a mess. Barry Knapp is not a mess. He's from Ironsides. He joins us next here in New York. Looking forward to that conversation. Equities just about unchanged on the S&P from New York. Good morning.
They're brimming with sensors. There's several cameras that look out at your world because we're mapping your physical world so we could put the content in there. There's several cameras looking at your eyes so we know where you're looking in your physical world. And that's a lot of data. That's a lot of very personal data. There's a number of other sensors on the device that are needed to make it work in the way it does. So we feel strongly that, first of all, people should know what these devices can do. And since we're at the beginning of the curve, let's work on the right guidelines and put those guardrails in place now versus letting it out of the bag and trying to rein it in, several years from now.
So what rules would you put in place, and who should make up and enforce the rules?
I think it's definitely a public-private discussion, but it's a very complex technology. So I actually spend quite a bit of time in DC talking to folks, saying, just educating them on what it could do. But I think first and foremost, the data that it collects, there needs to be an understanding, the user needs to understand the level of data that it's collecting, and then be the one who says where that data goes.
And the markets are on the move.
The focus, of course, is on Ukraine.
The market is so hyped up about AI.
Unless we see dramatic changes, it's just going to keep getting hotter.
For further market analysis, we're going to go get straight to some breaking news. We'll have a full roundup.
Going through some of the numbers and what investors should make of them.
We have so many important conversations. Let's check in what you need to know.
So what's the best investment advice you've ever been given by anybody?
The compound interest, the compounding of returns is an incredible miracle of business, finance, and human existence. Everything you learn is additive every day, and if you keep at it and don't quit, it's an incredible miracle. And it's not just interest. It was always said about compound interest returns, compound business returns, compound human returns. They're all very additive because you learn every day. And if you keep at it, it's very, very helpful.
In your your observation of investors, what do you think is the biggest mistake that average investors make?
Selling at the wrong time.
And they sell when the prices go down?
Yes. Or yes. Not keeping. Look, people have conviction, or they invest for if they invest for the right reasons, just keep at it.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
It's not that the US is roaring, it isn't, but it isn't yet falling into recession.
Can the US recession be deeper than Europeans' recession in the first half of next year? That's certainly possible.
The risks for stagflation are certainly higher in the euro area than they are in the US.
Less hawkish policy could fuel yet more gains in the US equity market.
I'm not worried about an organic slowdown in the US economy. There's no sign of demand falling off a cliff.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene on radio, on television, across America, and it is an America with an auto strike. The president will speak, and John, the backdrop suddenly $94 a barrel oil.
The words of UAW, we will strike all three of the big three all at once. TK muted price action for the big three in the pre-market this morning, and a limited walkout across three plants. The amount of workers, TK, 12,700 people. But to your point, the president will address the nation, Detroit, and the auto workers a little bit later today. What does he say when he also says, leading into all of this, that he is the most pro-union president this country has ever seen?
His downside, and I'm sure Gene Sperling, among others, is advising him, is not to go back to the mythology of Flint, Michigan, Buick City, 80,000, 30,000, 40,000 employees. As you say, this is a contained labor action, but it could go larger.
And it's not just this industry, it's the airlines as well. And we're questioning the viability and sustainability, Tom, of some of these companies if these labor unions get what they want. What happens to Detroit's big three? How sustainable is that industry in America with the kind of labor contracts that UAW would like Ford, GM, and Stellantis to sign?
And that goes back to what we witnessed yesterday in the chaos of the ECB and all, which is suddenly we're having these discussions amid a real yield, a more normal yield environment that at least it goes back to the 90s. I mean, it is a different bond market now than 5 years ago, 6 years ago.
This conversation highlights how confusing this economic moment is, because you're seeing the crosswinds of both technological advancements, changes with deglobalization and reshoring, coming to a more inflationary moment, but a decelerating economy. How do you put those things together and get any kind of conviction whatsoever? Yes, yields are higher now. You have some people, Bob Michael over at JP Morgan Asset Management, saying it's a buy, go in, all in, they're going to come down. And you got a lot of other people, including BlackRock, saying not so fast.
I haven't talked to Emery Horton or Joe Matthew about this morning, but John, is the easy path for the president to do a photo op at the White House next week and gather together everyone, you know, to put Barr at one end of the room and the head of Ford Motor at the other end of the room, like they had Musk and Zuckerberg split.
I think boilerplate, that makes a lot of sense. Sit on the fence, bring the same sides together, be the guy that unites everybody and tries to make everybody happy. Couldn't agree more. But has he painted himself into a bit of a corner? Can he play both sides? Can you be the most pro-union president ever and sit on the fence and try and strike a deal that pleases everyone?
You mentioned this late in the last hour. Is the floor, somebody had a great quote on this yesterday, I stole. Is the floor of the union, even in these three states, these three localities, Bronco, Colorado, and Wrangler, is it a red or a blue floor? That's really what the president's speech is today.
There's still a battle for just that, Tom. You mentioned energy. Energy at the epicenter of absolutely everything we're talking about the transition away from fossil fuels to EV, how much that's going to cost. Energy at the epicenter of retail sales and PPI yesterday. Energy at the epicenter of the upgrade to the inflation outlook out of the ECB. Energy at the epicenter, Lisa, of the downgrade to the outlook from Delta, from American, from Spirit Airlines this week. The surprise of the last month is crude back in the 90s.
Yeah, what we just heard from Sarah Hunt was that maybe it's even too fast for even her oil investments, her energy investments, because it creates demand destruction. What this shows is which economy, which companies are strong enough at a time of waning demand in certain of the hottest industries, which are strong enough to sustain their growth, even in the face of the headwind of much higher crude prices.
Brent crude 93 and 95. Your equity market more broadly on the S&P 500, just about positive by 0.05%. TK WTI $90.50 this morning.
Oh, the WTI prices there, and good morning. Javier Blas over in Europe, look for his article. I'll get it out on Twitter here as he says the Saudis work out off Saudi Arab light to $100 a barrel. Let's start strong in this hour. Barry Knapp joins us, Managing Partner, Director of Research, Ironsides Macroeconomics. He drove a VW Rabbit years ago, 3 OPEC things ago, whatever it was. What does the overall stock market do with a jumble, not so much of a labor strike, but with a jumble in reality of $94 oil?
Yeah, the oil situation is fascinating. One of the things I wrote about last week that I think some have started to explore a little bit but haven't really thought all the way through is that for 5 decades, the correlation of the price of oil with the dollar was negative. The dollar was the single biggest marginal contributor to our current account deficit. It's what originally pushed us off the gold standard. If you think about decades when the dollar was decidedly weak,
off the table the way that it was back in the day.
Oh my gosh, I was in the Senate. I don't want to hear that again. I mean, not to bring it in, but Mitt Romney is retiring, so maybe we. That's terrible. But no, I don't think that there would be another bailout. I don't think that that is something that this administration or America is prepared for at this point. We passed a lot of spending bills. I don't see a sector-specific bailout occurring anytime soon.
2020, union vote, Biden 57%, Trump 40%, at the margin critically from 4 years before. Biden did way better than Hillary Clinton. Where are we now? Drag it forward 3.5 years. Does Biden still have the union vote majority?
I think that when you look at not necessarily the union vote, but all voting turnout, there are other issues that are bigger than just union issues. And we have kept all those tariffs on, which labor unions are in some cases supportive of. The administration has gone a long way towards reshoring those union votes. So I think they stay. But Trump is got a stranglehold on his party, and so none of those voters are leaving. So I wouldn't be surprised if it was exactly the same.
I'm not sure how we can have a viable auto industry in Europe or in the United States without monster tariffs protecting this industry. I'm not sure how it can be viable, given what's happening in China at the moment, the opportunity that they have to produce vehicles at much lower prices, much lower cost than the Europeans. The Europeans are already complaining about that. Isn't that the direction we're traveling in here? That Europe's about to smack tariffs even higher and basically say the same thing as America? You want to sell here, produce here?
Absolutely. I mean, tariffs, state subsidization, domestic subsidization, friendshoring, all of that is very much in the cards. And I think for the foreseeable future under this administration or in the case that Trump wins.
Have we thought this through about what this EV transition is actually going to look like and how costly it could be for governments, Europe, China, the United States?
I don't think so. And you're seeing that in a lot of the delays of these regulations coming out on clean energy, not necessarily just on electric vehicles, but the solar, the hydrogen, all of those alternative clean energy components are requiring tremendous amounts of manpower at Treasury. And one of the things I hear most frequently is we just don't have the experts to finalize these regs. We're working on it. We know that Commerce Secretary Raimondo is staffing up Commerce with 150, 200 new people to address how to roll this money out, where it should go, how slowly to phase in these changes, how tariff rates should work in conjunction, whether with the EU or with Mexico. Those clean steel tariffs, what are those really about? So they're all connected, but I think it's slow going, and industry is very keen on getting the details.
We're going to be talking about this for a while, no doubt about it. Henrietta, thank you. It's great to see you. Henrietta Trace there, Vader Partners, and thank you for the treats as well. Appreciate that too. Coming up in the next hour on Bloomberg TV, Mohammed Al-Aaron of Queen's College, Cambridge, right here in New York City. We'll be catching up with Mandy Zhu and Jim Bianco of Bianco Research. A couple of weeks ago, Jim Bianco said it. He said energy will be at the epicenter of everything we talk about. That was the last time we spoke with him. A couple of weeks later, energy is at the epicenter of everything we're talking about. Equity futures on the S&P 500 absolutely unchanged. UAW shaking up Detroit but not shaking up this market. More on that going into the opening bell from New York. This is Bloomberg.
18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1.
Right.
So it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly with just a couple people. Our average restaurant now does about over $1 million per restaurant in digital sales.
How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is going to be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
Bloomberg surveillance. There is a strike in America. There are some touches to the past. We've got images right now here at Bloomberg on radio. It is the cold blue sky of outside Detroit, Michigan. And this is images of the Michigan assembly plant, what we used to call Michigan Truck. This is where they build the Broncos, and this is part, Lisa Abramowitz, of the fabric the president will talk about. There's all this modern new mumbo-jumbo. You know what? Joe Biden wants to go back to Michigan Truck.
Well, and this is the reason why it's such a fraught moment as they do protest. This just coming out from Citi, from Andrew Hollenhorst and Veronica Clark, saying that a UAW strike would affect the auto production, the GDP. Auto production accounts for 3% of GDP, with about 2/3 of that at the big three in Detroit.
Perfect timing. We're going to go to Lauren Goodwin here, but first, Michael McKee drops by today. Do you have any economic data at 8:30?
We have a little bit of economic data. Import prices are out, and they are up for the month of August by 0.5 percentage point, but take away petroleum, and they're flat. So the oil story continues into day two. Empire Manufacturing, just quickly, comes up to 1.9 from -19. It's a tertiary indicator, but it's out there.
Yeah, the tertiary indicator. Michael McKee with a lot of experience about labor. When the president speaks to the nation today, it's not 1958 Eisenhower and Reuther of Detroit. This is a different story today.
Well, it's a different story. The automakers are much smaller part of the economy, the big three automakers in particular, because so many of the foreign car makers have located plants here, and union membership is way down. But I went back and looked at 1998 GM strike. It's very similar to this in that they struck a couple of plants, but those plants shut down GM production around the country because they made parts, and it was about as many people as if the entire UAW goes out this time. About 180,000 people went on strike at that point, and there really wasn't much of an impact. In the third quarter of 1998, industrial production of cars fell, of course, and in the third quarter, we saw the number of auto workers on payrolls fall, but then they came right back up again, and the cars were sold, and GDP was unchanged.
Mary Barra with David Weston at 10 a.m. this morning. She is the engineer from what I will always call the General Motors Institute. It's not the Kettering, whatever it is, but she actually knows what to do with a wrench in her hand. She was weaned on the manufacturing multiple. So you, me, Diane Swank, and the rest are at the National Association for Business Economics in Washington. Does that room full of economists believe in the manufacturing multiple in America?
Oh, sure. And as manufacturing grows, it adds more value to the economy than a lot of other parts of the economy these days, because so much of what we do is service industry oriented, and so much of that is also intellectual property oriented, and the manufacturing people are actually making something and
that's a mythology, Lisa, the president's going to capture.
That's the whole thing about this strike, is obviously the auto workers want a piece of the profits that the automakers have made since they gave up so much in 2008 when they went into bankruptcy, but it's also about who's going to make the products of the future. Is it going to be the guy who grew up in Lansing and knows how to do something with a wrench, or is it going to be the guy who can program the computer to make the car?
The Fed is also watching this very closely at a time where we're thinking about wage growth. We're thinking about what this means for inflation. How much does this signal that labor inflation is accelerating or becoming entrenched, and how much does this signal a certain desperation at the end of this whole cycle?
Well, it may be more desperation at the end of the cycle. Obviously, we have seen unions get some very large pay settlements. And we did see a knock-on effect in the CPI with airfares going up, which people assume is in part because the pilots got big contracts. But then it's a one-time bump. And the question is, does that have a long-term impact on inflation? Probably not. What you don't want to see is that the automakers then come back and raise their prices significantly, and then the auto workers have to ask for more money, and you get into the wage price spiral of the 1970s. But right now, the Fed isn't thinking it's going to be a major impact on the economy longer term.
Michael McKee, thank you so much. Just terrific yesterday as well, in the blur that we saw of economic data yesterday. Out on the left coast, there's an economics program which is not talked about enough. It is the University of Southern California, USC. It is a spectacular program, and one of their ace students of the recent years is Lauren Goodwin. She holds a shingle out at New York Life Investments and joins us this morning. There's no love for West Coast economics because it's all sunshine and roses and happy, and we're in, the sun of California and all that. And yet you're the gloomiest rain cloud to come in from USC going. You believe in a hard landing. How on USC? Where's our hard landing?
Look, the economy never reacts the exact same way in every cycle, but it does tend to rhyme. And when the Fed raises interest rates, you tend to see interest rate sensitive and liquidity sensitive sectors navigate first, then manufacturing, services, and then the labor market. That's exactly the way that the economic dominoes have toppled this time around. The fact that we're sitting, waiting for the consumer and the labor market as those last dominoes to topple doesn't tell me anything about where the economy is going to be in the future. That's actually very typical.
You're at New York Life. It's old, quiet money, all wrapped around this strange thing called an actuarial assumption. Now that rates are back to my ute, not your ute, and we've got an actual real rate, the 10-year right now, 1.98%, up a solid 4 beeps this morning. In the new interest rate world, do we have to lower our expected return because our economics is a new economics?
I think it's an important question, and the answer is yes in some areas and no in others. With forward-looking equity market returns, especially at valuations where we see them now and where we see the economy expect it going ahead, I do think it's challenging to expect a 7-8% return over the next year.
I was looking for 20. Come on.
Well, we've had it over the past couple of years, right? That's part of the challenge for investors. But we do see stronger yield and some structural changes in the economy as a result of pandemic-era programs as being really constructive for portfolio construction and for the yield that investors can harvest in this environment.
Basically, you're actually getting yield for the first time in a long time, and that's been the story. Bonds are back, and this whole question of how much can you capitalize on that. I love this idea from you. Cash is not a riskless asset. Sort of the missed opportunity in long duration at this moment as a risk that people aren't counting on. Why is it a screaming buy for you right now in 10-year and 30-year treasuries at a time where there's a big debate about whether those yields can go higher?
Interest rates can go up for a lot of reasons, and why they go up is just as important as how much they go up. And right now, or in the last couple of months, the run-up in interest rates, long rates in particular, has been a function of supply and demand factors, the term premium, and not so much because inflation expectations have changed meaningfully or that the expected path of the federal funds rate has changed meaningfully. And when you have changes in the term premium, that suggests that rates are likely to be more volatile moving forward. And so actually, I'm not as big of a fan of meaningfully adding duration of portfolio, though I love what we heard from Mr. Gallo earlier around taking from cash, adding to bonds. But in terms of aggregate duration exposure, we really like a neutral position with short duration in corporate credit, especially high yield, where I see some really interesting structural changes in quality. and adding longer duration in the municipal curve, actually, where curve inversion is less of a challenge and we see it better rewarded.
I'm wrapping my head around what a hard landing means. If a hard landing means what it used to mean, which is there's going to be corporate defaults, there's going to be a lot of distress, there are going to be layoffs. Hard to see why anyone would get excited about corporate credit, about equities, about even municipal areas that are going to get challenged with tax revenues.
Well, it goes back to your first point, which is that there is yield that helps compensate for some of the risk. But more importantly, in corporate credit, especially publicly traded and probably exclusively publicly traded corporate credit, government programs during the pandemic have helped companies to shore up their balance sheets, to extend their maturity walls in a way that's very different from previous economic cycles. What's not different is that spreads are likely to widen. I fully expect that. So from a price perspective, you're still taking equity-like risk in high yield. The difference is that you can harvest coupon in the meantime, and because we are not
You're
yet...
killing me. You're killing me. That's what they say at big insurance companies.
Well,
We're harvesting coupon. It's like,
you
wheat,
go out,
we're harvesting.
You call the coupon.
You call the coupon.
In
Let's
the field.
harvest. Excuse me. I
we
love
might
it.
still clip them actually in the back room.
Yeah, for sure. Yeah, I don't think that they have
And
them.
they store them through the winter continually.
The big issue here, right now, as you're talking, I'm thinking to myself, okay, this makes sense over longer term, but what a wild card oil is going to be at a time where people aren't really clear on exactly what the drivers are. Is it a bullish signal of demand, or is it a bearish signal of supply manipulation leading to higher prices? How much do increasing oil prices throw off kilter some of your investment theses?
I think that higher oil prices matter a lot, and I think it's both, to answer your question, a bullish signal of the cyclicality that we've seen in the last couple of months, but a bearish signal because higher energy prices, although many would say they're headline inflation, not core inflation, they matter less for the Fed, that's just not true for the real economy. We all pay for oil, whether we go to the pump or whether it works its way through to core prices, through PPI, which we saw yesterday, and through the way that they work their way into the real economy. And so higher energy prices are a major risk. I think it's part of why we saw a rate hike from the ECB yesterday. I think the Fed is going to be paying very close attention to the path of energy prices ahead.
Listen, I want to get back to the core New York life ability, which is to look out long term. The IMF announcement of a 5-year 2028 global growth slowdown. What's your run rate on real GDP in America out to 2028? Model that out. Is it sub 3%? Dare I say, is it a potential GDP sub 2%? What's your vision on that?
I expect that we actually may see higher than 2% GDP growth on a 5-year time horizon. And that has everything to do with the investment that's going to be required both from the public and the private sector with respect to the green energy transition and with respect to the digital transformation.
See how she ends with a USC optimism? See that? All this hard landing stuff, baloney. Dyed-in-wool USC. It's a great program. It drives me nuts how Holland Horst, the Citigroup, was at UCLA. And the two programs.
We won't hold that against him, though.
You won't. Thank you. We'll leave it at that. Lauren Goodwin going after Holland Horst this morning. She is with New York Life Investments. Lisa, my head was spinning yesterday, and I don't think it's any spinning less today. What's going on?
It's just there are a lot of crosswinds, and trying to really put them together and understand. And I feel like the UAW strikes really highlight just what a transition moment we're in. Because on one hand, you have technological advances changing the conversation, changing the policy, and you have workers with renewed power and renewed cloud to say, wait a second, we have not kept up. Where is our profits at a time where you guys just are coming off big profits? And oh yeah, to boot, maybe some of that demand is cooling down. You put these things together, it is a confusing and tumultuous moment.
I like the phrase confusing there because it's certainly the toxic brew that we're in right now. Standard & Poor's 500 down 0.1%. Looking, we got to go to ARM. Farrell got his usual 8,000 shares with the contacts he's got on the street.
Oh, yeah.
And I got to pop
Were there 8,000 shares?
51 to 61. And then, Amy in the control room said it got a little soggy here in the last hour as well.
Yeah,
profit-taking,
Masayoshi Son was looking for a win, and it still remains to be seen whether he'll get it. That, to me, is the biggest takeaway, is that this was a manufactured kind of IPO with a very small subset of the shares being sold. and they were underpriced based on market valuation. They came in at 51. Masayoshi Son said, I don't want to go to $52 a share. If he had gone to $52 a share, $1, it would have been $100 million more in valuation that they could have booked.
With the economics, the finance, the investment, the international relations we do, and of course with the president speaking later today, we still need an announcement on that. Bar out with David Weston here in the 10 o'clock hour. Well, guess what? We're going to delve into ARM and cloud and the rest. Mary Barr is going to do this. I know they're doing AI.
She's going to delve into ARM with us. Mary Barr, come talk about ARM.
But she's thinking about it. That's the problem. Joe Biden's going to go out and talk to the people outside Michigan truck, and Mary Barr is worried about AI.
Well,
that's like,
exactly. How do you adapt to new technologies with an infrastructure tethered to the romance of an old economy? How do you do that?
We're going to have to see. It's 8:43, Friday. We're charged. Stay with us. Mandeep Singh next.
London will stay a financial center. It will stay our EMEA hub. We'll just have a rebalancing onto the continent. And actually, the numbers of who has moved across aren't that big. So it's sort of in the 200 level. And if you think about 15,000 people, that's sort of not that material. And so I do think both will basically continue to grow and continue to be very relevant. What will change, though, and the big thing that's changing, is actually the risk-taking is what's going to move. And so we've historically had risk-taking in the UK. That risk-taking and the assets that go with it, not the people alone, but the assets that go with it, that's the next phase of what we're now moving into. And that will be a material change.
given that we have this productivity enhancing technology that is AI, that has come off the back of this transformative communications network that's the internet, and we have a fundamental shift in the way the energy system is working, so there could be the ingredients of a pivot point of a kind that we've only seen a couple of times previously in history.
But let's ask what the driving forces will be. The world is propelled forward and has been for thousands of years by great power competition. That is the thing that drives innovation right now across the board. It is a competition which is intensifying between two superpowers, the United States and a communist-led superpower. Now, is this starting to sound familiar?
It does.
So what is really significant about this historical moment is that we are in the first inning, the early phase of Cold War II.
Right.
And that is going to drive all the things that we've talked about, and it will not necessarily drive these changes in directions that are benign. The big technological advance of Cold War I was, of course, nuclear weapons. And the arms race with nuclear weapons was an extremely dangerous one that very nearly blew the world up, particularly in 1962 at the time of the Cuban Missile Crisis. Yeah. I don't believe for a minute that we can have a Cold War II without a similar risk.
The names that move markets are on Bloomberg.
There's a complete change in the labor market. There's a complete change in the energy future that we are facing.
Under tightening would be a worse mistake than over tightening because we can course correct that.
The question is whether we need to increase the pressure or just keep pushing.
We've been getting good news. We just have to keep getting good news.
Nobody covers business like Bloomberg, your global business authority.
I think they'll be inclined to deliver a hawkish pause. They have gotten good news on inflation. Yesterday, a mixed report, but if you look at the underlying trends, core inflation is moving in the direction they want. So I think what we'll see next week is a pause, but an indication that they're prepared to do more. And I would expect them, I think it's finally balanced, but I would expect them probably to get one more hike in this cycle.
Former Fed Vice Chair Richard Clarida on the Fed's next move. The September FOMC meeting kicking off next Tuesday, leading a busy week ahead for policymakers with rate decisions coming from the Bank of England and the Bank of Japan. Mike McKee has more. Morning, Mike.
Morning, John. We're all traveling next week. I get to go to Washington. You get to go check on the Bank of England. Maybe we should meet in Tokyo when we're all done, because it is a big week with three central banks who have the same problem, inflation. And the Japanese have actually joined that party. Take a look at the inflation rates in all of these countries. You can see the Bank of England's problem. They have a very large inflation problem. The U.S. has made a lot of progress, but we just ticked up a bit. So does the Fed raise rates? The betting is they probably will. And the Japanese are now above zero and have been there long enough, and the odds are they're going to keep inflation high according to the latest forecast. So they may start tightening policy a little bit as well, which leads us to what's going to happen in the markets. Well, the bet is nothing from the Fed, even though Rich Clarida was suggesting a hawkish pause. Nobody thinks they're actually going to hawk out and raise rates. About a 3.8% chance, as you can see. There is a bet, a strong bet on the Bank of England moving, and now there's a bet on the Bank of Japan. We haven't had that in a very long time. What do all three of these have in common? The U.S. dollar. The dollar has been strengthening because the Fed keeps raising interest rates, and because the U.S. is the biggest economy in the world, it's affecting everybody else. You can see the impact on the pound, and you can see the impact on the yen. I reversed the yen so you could get an impression of what it's actually doing. It's getting weaker. And that's a question for the Fed. Do they care? They care. They don't want to hurt other people, but their job is the United States. So expect the dollar to stay strong for now, and it's going to have an impact on the rest of the world. I guess you have somebody sitting with you who has a pretty good handle on cross-currency issues for people who work in two parts of the world.
That's a question for Mohammed, Mike McKee. Mohammed, have we got a dollar problem for all these central banks?
So in the past, whenever we've seen a very sharp appreciation in the dollar, it has tended to break something. What I thought was really interesting from Mike's comments is the Bank of Japan. I don't think the potential for the Fed to surprise is very large. It will keep rates unchanged, nor do I think the potential for the Bank of England to surprise is very large. It will raise 25 basis points. The big uncertainty is the Bank of Japan. And that is what I think markets haven't understood. It's not as much rates as the yield curve control. Do we get another signal that they are easing out of yield curve control territory?
Well, where do you think they are now? What is the actual policy on yield curve control of the BOJ?
So they're tolerating a 70 basis point 10-year, which was unthinkable 6 months ago. And I think they may indicate that they're willing to tolerate something more, and the rate will move immediately on that news.
Governor Wade has suggested that maybe they do raise interest rates at the end of this year and abandon negative interest rate policy. Do you think we should be paying attention to that as well?
We should absolutely be paying attention, not because of the rate spillover, but because the Japanese are very big owners of foreign securities.
Okay, so the next question is, what does that mean for treasuries? So the anchors have gone now. Bund market away. ECB is done with all of this. Bank of Japan said to follow potentially, given what you've just said. Does that mean a new floor for treasuries or a new ceiling for treasury yields?
So first, the policy anchors have gone away. Okay, the economic anchor is still holding in the US. That's really important. It's important for the US, it's important for the rest of the world. And then there are the technicals. The good news for most market participants is that the technicals are favorable. Keep a very close eye on the 10-year if it gets to 0.35, 4.35. That is a major resistance point. And if it goes through there, then people are going to start talking about 450, 475, and it's going to be a different narrative.
Interesting. 433 right now, by the way, on a 10-year treasury. Mohammed, stick with us. Coming up on the program, I'll run you through the trading diary, the calendar for the week ahead. From New York, this is Bloomberg.
Most of the large Chinese technology companies, let's say Alibaba, Baidu, Tencent, they have gigantic market values and they're very prominent in China, not as prominent outside of China as obviously in China, and certainly not that prominent in the United States. TikTok, by contrast, is not in China, but it's gigantic outside of China, the United States, and everywhere. What did TikTok do that enabled a Chinese-based company, parent company at least, to do so well outside of China?
We think it's challenging to build a global company in general, but the best ones we have seen so far are ones that take very consistent global learnings and adapt them to the local countries that they are operating in. So you need to be global and local at the same time.
Let's get to the calendar. The week ahead looks like this. At the top of the hour, UMich Consumer Sentiment Survey Plus. President Biden expected to address the UAW strike later today. Wednesday, Fed rate decision, Pound News Conference. Thursday, the Bank of England's turn. And finally, on Friday, it's the BOJ. Mohammed with us around a table in New York. Mohammed, what a week.
What a week, and next week will be also what a week.
What stands out for you this week?
4 things: U.S. growth exceptionalism. 2, the return of some inflationary pressure. 3, Europe deep into stagflationary risk. And finally, Japan likely to exit YCC much quicker than most people expect. That is quite a combination for 1 week.
Stagflation, risk or reality in Europe?
way of explaining, well, we have economic interests. We want trade to be based on fair rules, so we will ensure that the rules are the same for everybody. We don't have to fear any country. We are the EU, we are the single market, we are one of the most powerful economic continents in the world. We need to defend our economic, financial, social, environmental interests.
And is this the beginning of a bigger rethinking? Because we go into electric cars, but would you say it may not be just the EVs? Maybe there's a whole range of areas that we should take a look at what the state of that fair play is.
On all areas, we have
but
to
any
ensure.
specific?
On all areas, maybe solar panels, maybe other areas, we have to ensure that trade is based on fair rules. It is maybe the beginning of a new period, a new era, where the EU starts thinking about its own interest, starts looking at the rules that have been decided and have been applied, and start thinking about defending its interests.
And let's talk about the French economy. Well, to be fair, what you're trying to do is overtake Germany, right? That's your goal. You want to be the biggest economy in the euro area.
Our goal is clearly to have growth in France and to have growth in Germany. Germany is our first economic partner. This is not good news when you have Germany facing recession, because of course it has a direct impact on the level of activity in France. So I really want to have more growth in Europe. And this is one of the key challenges for 2024. I explained to my colleagues today in Spain that we cannot be satisfied with the level of growth that we have today in Europe and that is forecast for 2024. We cannot be satisfied by the slowdown in Europe. There is growth in the US and a slowdown in the EU. We must take decisive steps to give a new impetus and to get a solid, sustainable and stronger growth in 2024.
And that slowdown, do you think it will affect your country? Because a lot of the credibility of the French government depends on showing that there is sustainable growth now.
We have growth in 2023, 1%. We will have more growth in 2024. Our forecast is 1.4. But I strongly believe that we should define altogether a new economic and industrial strategy for EU based on cheap electricity prices, based on the simplification of the norms. And we are really fully determined with Christian Lindner to give an impetus to that idea. Third, based on innovation and investment. And fourth, based on competitiveness.
And when you spoke to Christian Lindner, there's also this, and that's your German counterpart, there's also a big debate about the European fiscal rules. The Germans are clear, they want to see benchmarks for debt deficit. Others say this is just stifling the economy. I mean, you're fixated on numbers that have not produced massive investment across the European Union. Next year, if there isn't a fiscal rules reform, you're going to see countries that could get punished for not hitting those numbers. Some will say that is just, it is crazy. It makes no sense. Is that acceptable to you?
I want to make things very clear. France wants to have sound public finances everywhere in the Eurozone. We want rules, but we want rules that will not kill growth. Rules of the Stability and Growth Pact are necessary to ensure sound public finances, but it must also provide the fiscal space to have also growth, jobs, prosperity in Europe.
And the Germans get that?
I think that the balance between investment and sound public finances is the key challenge that we have to face when we are defining these new rules for the Stability and Growth Pact. The second point, which is absolutely key, as you said, is to do our best efforts to come to a compromise by the end of 2023, because we need to give the signal to our citizens, to all the member states, and also to the markets, that we stand ready to have new, efficient rules for the Stability and Growth Pact.
And finally enough, this time it's Germany that may head into recession before anyone else. But I wonder, the market is becoming very negative on Europe, and it has done so now for weeks. Do you believe this idea of stagflation, is that a real risk, or there's too much negativity around the European story at this point?
I think there is too much negativity.
You don't believe in stagflation?
I believe that there is a necessity to give a new impetus to growth, to get a stronger and more sustainable growth. When we are talking about Capital Market Union with Christian Lindner, I've been negotiating the Capital Market Union for more than 6 years. And what is the result now? Nothing. So we need to move on. We need to decide. We need to have this capital market union to provide more funding to the innovation, to the disruptive technologies, to growth. That's the key point. I'm not an observer of the political life in Europe. I'm an actor. As an actor, I want more growth, more jobs, more prosperity, and there is a necessity to take some decisions to go this way.
And as an actor too, can I just ask you, did you get any phone calls from any French CEO this week when that probe was announced saying, how is this going to affect us? If China gets tough on us, we're going to have any problems. Did you have any sign from the French corporate sector, which we know is very strong, saying, are we sure we want to do this?
I got some phone calls, to be very frank. I got some phone calls, but my response was quite clear. What do you want? What do you want? A weak Europe or a strong Europe? I think that we need a strong Europe. And a strong Europe is a continent and a political project which is able to defend its interests.
Well, this is very important. So you said CEOs called you and they said, can we get an explanation? And you said, we want to do it for a stronger Europe.
We want to do it for a stronger Europe. We need to have a fair competition between China and the EU. And if you want a fair competition between China and the EU, you need a strong Europe.
And you're not going to tell me who was on the phone?
No.
Okay, well,
thank you so much.
So much for joining us on Bloomberg TV. Always a pleasure to see you. And Alex, of course, that was the French finance minister with us here at this Eurogroup in Spain. Thanks.
All right, Maria, thanks so much. Really appreciate it. Really interesting conversation and very timely as well, as we have the auto strike here in the U.S. So, Guy, I mean, I think there are really big issues that I don't know how you resolve quickly and easily.
Yep.
What it does seem is that the U.S. and Europe are just behind on manufacturing for EVs, and they're going to have to find ways to ramp it up and kind of all options on the table, but it is happening.
It is happening, and it's going to be interesting to see the kind of different tracks and different paths that are taking. But what I hear loud and clear is that there is a certain degree of protectionism of home turf.
Yes.
And I think that's just going to be the reality of the situation. I think the French are playing with fire, though, with the Chinese. Airbus, hugely dependent on what comes out of China in terms of the order flow. You look at the luxury industry, they're pushing this. It's interesting to hear Bruno Le Maire talking about the fact that it's not protectionism, but they are clearly in the market for some sort of help for companies like Renault. Where does that leave LVMH? Where does that leave Hermes? Where do the luxury names get left in this? What about Airbus?
Yeah.
It's a zero-sum game in some ways.
And also, then what happens when you wrap in, say, solar, for example, where so many parts are still made in China, right? So there is that trade in the energy transition, the green transition, that you still need to work with China. So, I mean, you have to wonder, too, if it needs to be more manufacturing subsidies or demand. You need to de-risk the demand side in Europe. Like, is that what you need to do rather than focus on the supply? Is it de-risking the demand? Does that mean more subsidies? Is that what that is? I mean, I feel like there's just different parts to it and if that's going to work.
But that then deals with the idea that maybe the Chinese are the ones that benefit from that. Maybe it's Europe needs to figure out the IRA side of things and bring manufacturing in.
Maybe. No, it's a fair point. Okay, we're going to discuss this much more in the next couple hours. But coming up, the UMich survey came out. It's moving markets. We'll get the latest. This is Bloomberg.
From the world of politics
We're not going to be relying upon countries whose values we don't share.
to the world of business.
It's all about corporate power in the end.
Balance of Power Live from Bloomberg's Washington headquarters.
We couldn't be more excited what's in store for you.
How long will it take? How many years?
Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join hosts Anne-Marie Hordern.
It's the one area, really, of bipartisanship.
I think we're getting more of it.
That's optimistic.
And Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee Lines.
The door was open for regulators to do more. And that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue.
He's no longer trying to run away from
that really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience will get this more than most.
This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure, with two more potentially to come.
I'm willing to have this battle.
It is vitally important.
This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority.
We're about an hour into the U.S. trading session. Here's the deal. You just kind of sell all the stuff. You're selling treasuries, you're selling a dollar, you're selling stocks. That's sort of the broad stroke for the market day. Abigail Doolittle is tracking the moves. Abby?
Yes, stocks are certainly heavy on the day, Alex. This is a 5-day chart of the S&P 500. So we do have a gain after last week's loss. Now, that said, we're well off the highs. It's triple witching day as well. So we could see anything happen. The NASDAQ 100 right now about flat on the week. So a bit of volatility and uncertainty on the part of investors. And I would say that the sector composition on the week, well, it's pretty bearish. Let's take a look at what is happening beneath the surface. Now, most sectors are higher, but the best sector is utilities. This is defense. What makes it so interesting, we also have yields higher, so it's not even as though they're higher because of competing with those dividends. It's almost like a flight to safety. That said, discretionary is the second best sector, up 2.4%, some of the mega cap tech sectors in there. But take a look at the two down sectors, industrials and then tech. Tech down 1.5%, down for a second week in a row. So again, this is bearish beneath the surface. It tells you that maybe the bears are a little bit stronger than that 0.4% of a gain for the S&P 500 might suggest. When we put this together with the weekly technicals, we have not taken a look at this chart in a while. So these lines, these are fan lines. These show the reversal of last year's downtrend, that bear market. But take a look. We are still neatly in this rising range. I would suggest that this weekly RSI coming out of overbought may suggest we could still go down toward the bottom of that range near 4,000 or so. It would clearly take quite an impetus, but the technicals price suggests that that is a possibility. As for some of the other asset classes on the week, if we take a look at oil, well, this could be one pressure. If we continue to see oil go higher, that could bring some inflation concern back into the picture in a big way and really keep the Fed alive. The dollar, the Dixie, the Bloomberg Dollar Index, because it has less of a weighting to the euro, it's down on the week. But the Dixie up for a 9th week in a row, the first time we've seen that since 2014. Yields up just a little bit. And then here's that VIX guy, a 13 handle, near the 2020 lows. Doesn't really feel like triple witching with that VIX there and also with stocks, but let's just see how all these puzzle pieces play out in the weeks ahead.
It's such a confusing market right now, and the energy story has just thrown everything up in the air. And we still don't, I think, know how it's all going to settle. Which takes us neatly to what's happening with the economic data that's coming out, particularly of the United States. The UMich numbers, top of the hour. US inflation expectations falling to their lowest level in more than 2 years as a result of what this data is showing. Let's get some instant analysis as to what is happening here. Joanne Shoup, University of Michigan Surveys of Consumers Director. Joanne, big drop in inflation expectations. Walk us through how we should read these numbers.
So consumers have absolutely noticed that the slowdown in inflation has stalled a bit, and that's part of the reason why consumers aren't feeling great with their sentiment this month. But at the same time, they do expect the slowdown in inflation to continue. And in fact, both the short term and the long run inflation expectations, as you said, have come down quite a bit.
Why?
And this is largely...
Joanne, why? Why are they so convinced?
The movement in the inflation expectations is largely attributable to consumers, a reduction in people with very high inflation expectations. So about a year ago, almost a third of consumers thought that one-year inflation would be over 10%, 15%, 20%. But that's all the way down to 15% of consumers right now. So I think consumers are broadly feeling like inflation is starting to come under control. It's not... Of course, these could still turn around depending on economic developments, but consumers are starting to firm up their expectations and feeling a little bit more optimistic about that, particularly in the long run.
Gasoline prices. Let's fold in a higher gasoline price. How will that change, do you think, how consumers feel about what they see in front of them? To what extent could these numbers change? The market's been shocked by the high oil price this week. Are consumers going to feel the same thing?
I think it really depends on how much this passes through to gas prices. Consumers continue to be concerned about gas and fuel prices. You know, that the number of consumers who spontaneously mentioned those prices in our surveys did increase over the last couple of months along with gas and fuel prices. But it didn't really affect either the short run or long run gas price expectations. It didn't pass through to that. So consumers are not expecting these increases in fuel prices to persist. But of course, if they do, then consumers will adjust accordingly. But at the moment, they are not expecting them to persist.
Joanne, how do consumers and those you poll feel about the job market right now?
Consumers are starting to show some signs of vulnerability in their labor market expectations. Unemployment expectations have worsened over the last month or so, and consumer expectations over their incomes over the next year dropped quite a bit between August and September. Now, broadly, they do recognize that that labor markets are historically strong, but we are seeing some signs of vulnerabilities emerge in the data.
Joanne, Claudia Sahm of the Sahm Rule wrote an opinion piece on Bloomberg a little earlier on today. Why are consumers still so gloomy, was the title. The answer appears to be blame COVID, that there has been a permanent shift lower in expectations. The pessimism post-COVID is just embedded at a higher level. What do you say to that?
What we see in the data is absolutely COVID continues to have an effect, or the perception of a new normal after COVID. Consumers had their all-time historic low in consumer sentiment last June. In spite of the fact that, yes, we had high inflation, but it was nowhere near the types of inflation that we saw in the late 70s and the late 80s. And with COVID, along with political polarization, along with enormous amount of uncertainty in a lot of policy arenas, have led to consumers really feeling quite dismal about the economy. And not just about the economy, but other aspects, aspects of how they view the country and society more generally. So, I mean, I do agree that this new reality that came in with COVID has shifted consumer views and consumer attitudes, but it remains to be seen, I think, whether or not this is going to be permanent. I mean, it's very possible that if we were collecting data during the Spanish flu in the early 1900s, we would have seen the same thing, but unfortunately, we hadn't started at that time.
Okay, well, that's a fair point, an interesting point, but also really fascinating to see if there is a structural shift with that. Joanne, thank you so much. Joanne Shu, University of Michigan Surveys of Consumers Director. We'll get you next time. All right, let's get more on this from market perspective. Katrina Dudley, Franklin Mutual Advisors Investment Strategist and Portfolio Manager, joins us now. Hey, Katrina, what did you make of the UMich numbers? And I say that in the context of, like, is that a Goldilocks scenario? The message in the markets is we're going to sell the dollar, sell bonds, sell stocks. What's your take?
Look, we're actually looking at some of the data on the consumer, and we're really paying attention more than just on the sentiment side, but on the job side for the consumer, because that's really the ultimate thing that drives things in the long term, and it's job security. So we've got low unemployment. We actually have a jobs opening number, which is about 50% higher than it's been historically. So there are a lot of jobs for these consumers, and I think as we look on a long-term basis, we're actually bullish on the consumer, and we're really impressed in terms of, you know, the security that they have, even going into a slight downturn.
Two words spring to mind, Katrina. Are they the right words? Soft and landing.
we've been on the soft landing camp, remember, for like at least 12 plus months, and I think everyone's swung our way. And when we were looking at the original thesis of a kind of a little R recession, the things that we pointed out to you, and I think have really played out here, is this has been a job-filled downturn. And that's very different. And it's actually the other side of the coin coming out of COVID, where in COVID, we had a jobless recovery. And we've spoken, Guy, we talk to the same industrial CEOs that you do, and they're holding on to their labor tight. And if they're holding on to the labor, that means that they're just as positive as we are. And so I think the industrial companies, even though some of the recent narrative is coming out and it's a little less mistake, we still think that they're in the same camp that we are, which is the Fed's done their job and we've navigated a soft landing. And the other part of this is that if it's not quite as soft as we thought, the Fed still does have the ability, probably sometime in 2024, data dependent, to adjust rates to kind of land the plane, as you say.
So, Katrina, we were talking about that yesterday in terms of where the ECB is, and are Powell and Lagarde on the same page? And there was some conversation that the Fed can actually cut first because the ECB is going to have a much stickier inflation issue. What do you think, and how do you express that?
So in terms of the inflation issue, the drivers of inflation that are happening over in Europe are very much energy price dependent. And, the war was the start of that. And what we're seeing, and what's been very surprising to us, is the quickness at which Europe has adapted. We've always talked about Europe as being a slower market than the US, but in this case, I have to say we've been very surprised. And, you've seen an increase in oil prices. And I think that, the inflation landscape for Europe, while it's controlled, it's maybe not got the same tailwinds that we see here. Or when I say tailwinds, the fact that we're in the camp that by the end of this year, we think we'll see a 2 handle on inflation in the US. In terms of the Fed and the ECB, let's be honest, one of the areas...
Where do bond yields go in that scenario? Because there's a lot of talk about at the moment the bond yields don't come down. They don't come down significantly. There is a significant risk they actually go higher from here. How does that feed into your thesis?
I think in terms of bond yields, we are pretty much in the camp that they stay about where they are, that the bond market is pricing in all the information that's available. As we go into next year, though, we are watching data like hawks. And I think the ECB is doing that, the Fed's doing that. And if you do see signs of slowness, we do think that the Fed is going to make another pivot. And that pivot will be, what adjustments do I need to make? And that is when we're going to see that kind of 25 basis point adjustment to the rates, and it will be in response to signs of a slowing economy.
All right, Katrina, thanks a lot. Really appreciate it. Always good to see you. Katrina Dedley of Franklin Mutual Advisors. And so, Guy, I think that you mentioned bonds, but I was kind of going to what we're seeing in the FX market, right? Does this just mean continued pressure for the euro? And again, continued upside for the dollar. The buck has not stopped. And at some point, again, we're going to start talking about China and Japan and how they defend their currency and what the aftermath of that is.
We've got some big decisions coming up next week, haven't we? We've obviously got the Bank of England we're going to be thinking about. You're going to be looking at the BOJ next week. Clearly, we're going to be thinking about what is happening with the Fed. Yet the stress that the dollar is going to create around the world, if it continues to ratchet higher from here, is significant. I was listening to people earlier on in our coverage talking about parity coming back onto the table for the euro. Dukes has a slightly different view. He thinks that there's so much pessimism already priced around Europe that actually probably that won't happen. But nevertheless, the risk of the downside has to be there. The stronger dollar ripping through Europe, ripping through the United States. But maybe that means that Alex Steele is on holiday here in Europe next year. Who knows?
Parity, for sure. Yeah, no, that's definitely happening if we go to parity. But also, to your point, I've heard that argument made about European stocks. Well, all the bad news is already priced in, so go ahead and buy, and we see how that plays out. Anyway, coming up, a $15 billion cash cow ETF is getting a cheaper rival. We're going to have a lot of puns in the next segment. Details next. This is Bloomberg.
say Alibaba, Baidu, Tencent, they have gigantic market values and they're very prominent in China, not as prominent outside of China as obviously in China, and certainly not that prominent in the United States. TikTok, by contrast, is not in China, but it's gigantic outside of China, the United States, and everywhere. What did TikTok do that enabled a Chinese-based company, parent company at least, to do so well outside of China?
We think it's challenging to build a global company in general, but the best ones we have seen so far are ones that take very consistent global learnings and adapt them to the local countries that they are operating in. So you need to be global and local at the same time.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is going to be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
Holy cow, talk about those inflows. The Amplified Cash Flow Dividend Leaders ETF began trading this week under the ticker COWS, and it aims to invest in U.S. companies with high free cash flow and dividend growth. Bloomberg's Emily Graffeo is following all the moves. My God, I love that stuff. Okay, so actually, but really, what's in it? Because if I say cow, I think we're looking at ag stocks and an ag ETF. Clearly, that's not it. What are we looking at?
So we're looking at cash cows, or cash-rich companies. Amplify ETFs launched this ETF. The ticker is COWS with an S, and it's investing in companies that have really strong free cash flows and also pay monthly dividends. And now the reason why I think they had this ticker COWS is because there's already an ETF out there from Pacer ETFs with the ticker COWS with a Z, and it's gotten a ton of inflows in the last 2 years as investors are kind of flocking to companies that they deem high quality, maybe a safer bet.
Emily, why should I be more bullish, get it?
Yeah, we get
about this one than what came before? But you've got to continue with the puns. If you're going to start off like that, I'm definitely going to carry on.
Just don't say get it. You just got to own.
Well, you could say bullish, but maybe bullish.
Bullish.
Okay, that's because I gave you some warning.
Right, but then you can't explain
Not
it
everybody's going to. Okay. We should carry on.
I think investors are maybe going to add more to these ETFs. We have seen ETF issuers launch a ton of dividend-paying ETFs and ETFs that focus on these higher quality companies. I guess if the bull market is going to turn, if we do see that economic slowdown actually come to fruition next year, investors would want to pile into this. But so far, you look at the returns, and the Pacer ETF, COWS with a Z, has underperformed the S&P 500 this year. It's up about 11%. So not awful, but investors would have been better off just buying the SPY ETF.
Is there a sector bias at all?
So the COWS with a Z ETF has a lot of energy companies in there. This new one is a little bit more broad, but the idea here is it's going to focus on monthly dividend income. And interesting here, the new ETF is going to waive the expense ratio for a year. So maybe a way for Amplify to compete with Pacer. This ETF will be essentially free for the first year that it trades.
I don't have anything funny to say to end it. I wish I thought about this more. Emily, great stuff.
Thinking that too.
Thank you very much indeed. Clearly unprepared. Thank you very much, Emily Grafeo.
Wait, did you hear her say that?
No?
She said, we're really trying to milk this.
Oh, excellent. There you go. I knew somebody had it in there. Okay, Ray Dalio. Emily, great stuff. Ray Dalio apparently potentially looking to return to the hedge fund world. We're going to talk about this next. This is a big deal if it happens. He ain't happy. Is he coming back? This is Bloomberg.
I don't think we can replicate Tesla. Tesla is a unique because when they founded and then the personality behind it, the product is beautiful, technologically very, very strong. So in many areas, Tesla is Tesla, but expand is expand. We want to focus on what we think is important for our customers. Our customers like beautifully designed vehicles, either it's large SUV or sports sedan. We believe we have a very, very appealing family look that our customers is really attracted to. They like to have user-friendly features inside the cabin that has a technology feel. It's very smart. It enables them to really utilize the vehicle that's different.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
Time now for Wall Street Beat. We take a look at what's buzzing on Wall Street and the world of banking and finance. So today we're looking at the potential return of Ray Dalio to Bridgewater Associates. So less than a year after retiring, joining us now, Bloomberg's Shanali Bassick. Okay, what's going on here?
According to the New York Times, is Rob Copeland, who I should also say is writing a book about Bridgewater and Ray Dalio coming out in recent weeks. It's very highly anticipated. He's reporting that Ray Dalio is trying to return to Bridgewater in the form of pitching a new fund that could help Bridgewater with its returns that have been slumping as of late. I will say macro funds in general have been doing a lot worse than they have been last year. But yes, it is true that this year so far, remember, Dalio has not been gone very long. This is kind of what this is all about. Now, remember, apparently, according to the New York Times, there was kind of a veiled threat that Dalio had. This idea here that he used to say, according to executives that were, according to the New York Times and documents reviewed, he used to say, "Take me out and get what you deserve." And so this idea here is that coming back to Bridgewater in his mind would help Bridgewater out. But, when he brought this idea to the CEO, Nir Bardea, apparently Bardea had brought this idea to the board and the board rejected the idea. So it just shows you the tension that still exists between Bridgewater and its kind of founder that has known to be synonymous with the firm and its principles, as we know, for so long.
There's got to be a sort of Tom Brady joke in here somewhere, which is my way of kind of pivoting back towards what is happening with the sports world, which is what I know you want to talk about. I know Alex doesn't, but I'll give you a choice.
Go.
Tennis,
I'm going to make this so much fun.
Gymnastics. Wrexham, the next series has started. Everton is being bought by the Americans, and Goldman Sachs is starting a sports franchise so that basically its clients can get access to this trade.
Yeah.
Take your pick. Which one do you want to do?
I'm going to start with Goldman just very quickly here, because Goldman was involved in that Chelsea deal, for example, and it's now one of the investment banks starting a a sports franchise within the investment bank. It's one way to capitalize. The reason I bring that up first is because there is a lot of institutional interest in teams from wealthy individuals and private equity firms, and Everton is getting another private equity firm, Miami-based 777. Now, Guy, I will get over to the Wrexham part of the equation here, because Wrexham, partly owned by Ryan Reynolds. An interesting thing about that dynamic, I think about Wrexham kind of like a distressed investor would, as a value trade, something that is maybe cheaper than a Chelsea would be. And you have this instance where, you brought in Tom Brady. Tom Brady also, and I know you would disagree with this, bought a team that was perhaps a little cheaper than Chelsea, and more of a value trade, and really trying to capitalize here on the environment around the football club that they bought. So it is interesting to see these valuations. Yes, Birmingham. Which apparently is a massive team itself. I know less about the sports and more about the billionaires behind them.
I wouldn't say it's a massive city, and it has 2 football clubs. My father used to does support Aston Villa. My uncle supported Birmingham. That's always been the tension.
Yeah, it's interesting. I guess the cultures are different with the teams too. Can you tell us more about Everton?
Well, it's Everton and Liverpool. Liverpool has dominated massively. So Liverpool Football Club has gone to the stratosphere, and Everton's been left behind. But they're going to redevelop Goodison Park, which is kind of why this deal needs to happen.
Yeah.
There's a need for money here, which is why maybe the investment is probably better placed. You haven't got a team that's flying high. You've got a team that needs investment, a stadium that needs investment. And to your point about the value trade, that's where it maybe makes more sense.
It's real estate, it's stadiums, it's property, and that was kind of behind the Chelsea deal as well when you think about why Todd Boehly initially had gotten in. For Clearlake and Todd Boehly, it's been expensive. But, there's another book. I talked about the Rob Copeland book. Also, Soccernomics. If you like Moneyball, you'll like Soccernomics. This whole idea of how maybe all of these firms should be using a little more data about how they're managing these teams to be making a profit at the end. English football has been very wasteful with their money until perhaps private equity can tighten the belts a little bit.
You guys did a really good job there.
Yeah.
Thanks a lot. Nice work. Shalini Bassick joining us there, and Guy Johnson on sports stuff. Okay, Guy, we are also on the whole topic of Wall Street. I just want to point out is on this day 15 years ago at the collapse of Lehman Brothers happened. I remember it. You remember it. It was a turning and defining moment in global economies and global finance. 15 years. It feels like yesterday in some ways.
What was amazing about that whole period is that you remember it as a very compressed period, and actually it was really stretched out.
Good point.
And that's how you've got to remember it, that it didn't all happen really fast. The Lehman moment kind of makes it sound like it happened really fast. It was in some ways an incredibly slow burn with some real periods of tension within it. Some amazing moments. I remember when TARP failed, all those kinds of things that happened, but it was actually over a much longer period of time than maybe history. History will tell us it was over a long period of time, but our memories don't. Stock 600 today up by 0.2%. LVMH is bouncing back quite nicely. The China data earlier, I keep coming back to the China relationship. Goes back to that car story. The dollar's bounced. Actually, the University of Michigan data, the euro's bounced. University of Michigan data a factor there. And Brent kind of flat, 93.75. Coming up on the European close, Hugh Gimber. This is Bloomberg.
Have you thought maybe I should go do something else? I can't do anything better than I'm already doing. I've already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
On the next episode of Hello World, meet the women driving Kyrgyzstan's tech revolution.
This is the first satellite in our country.
And some speedy horses. Watch Hello World Thursdays at 8 p.m. Eastern on Bloomberg Originals or 10 p.m. Eastern on Bloomberg TV.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question. Great question. Great question.
That's a question I get all night.
Bloomberg. Top experts. Great questions.
Friday the 15th of September, European equities enjoy a little round trip at the end of the week. We start off with a bounce driven by China. We fade that move as the day progresses. We're coming back down pretty much to flat. UK's up, that's on China. France is up. LVMH has another good day. The countdown to the close starts right now.
The countdown is on in Europe. This is Bloomberg Markets European Close with Guy Johnson and Alex Steele.
So we fade the bounce. SOX 600 now only up by 0.2%. Positive Chinese data overnight gave us an initial kick higher. We faded that move. LVMH, though, still up by 2.5%. It's been a big sell-off for LVMH, beginning to claw back some of that ground. Luxury stocks do well. Tech stocks do not do well, though, in Europe. TSMC is pushing back, apparently, lithography orders. That is going to ripple through into names like ASML, and you're seeing that stock down by nearly 7%. I think that's off a Reuters report a little earlier, Alex.
I gotta say, Guy, we have a pretty decent sell-off here within the market. The S&P is down by almost 1 percentage point. We got that UMISH data that showed the confidence is rolling over, but also one-year inflation expectations are also rolling over. So both of those like a mixed signal. Some might say Goldilocks, but it doesn't seem like the market, at least the equity market, is taking it like that. So the S&P up 1%. In part, you're also seeing because Adobe, the worst performing stock within the S&P, they had third quarter earnings that came in line, but analysts think that their guidance was a little conservative, but it also has had a really nice run. So maybe a little profit taking there. And ARM just taking a break after that IPO pop. And the 10-year yield up slightly by 3 basis points, so a little bit of a bear steepening, but nothing super dramatic that would make you kind of rethink things. And we're also having the overhang, of course, of the UAW worker strike, Guy.
Alex, let's talk about kind of how this all folds together and comes together in the foreign exchange markets, because we're watching all this week, but we're also watching the dollar continue to climb. The euro is one of the biggest casualties of this move and has been for a while. The euro is now set for its longest run of losses on record. On record. The currency headed for its 9th straight week of declines against the dollar. I always joke, when is the buck going to stop? Recently, it just hasn't been happening. And it's interesting because at the moment, Alex, we seem to be in a position where the market's beginning to focus significantly less on the rates differential. So maybe Christine Lagarde and her rate rise yesterday doesn't really matter. The market is now focusing on the growth differential. And if you look at the growth numbers that are being announced out of the United States and the growth numbers that are being announced out of Europe, that does not bode well for where the euro goes next. I've been hearing various reports today about parity. Doesn't seem that far-fetched anymore.
Yeah, no, it might not, and that means, I know, more vacations for me. But in a Bloomberg exclusive interview, French Finance Minister Bruno Le Maire spoke to Maria Tadeo and talked about Europe's inflation challenges and what the ECB did yesterday.
I think that we are at the right level of interest rates in the EU to stop inflation and to reduce inflation. And this is the goal of these interest rates, to reduce inflation we are on the right track, and I think, as Christine Lagarde said, that we should stick to that level of interest rates. It is the right level to reduce inflation.
So they're done. They're done, and the market now starts to think about where cuts come in and when they come in. But I want to come back to this idea of the growth differential as well, because I think that's going to be a critical factor, maybe more so than what happens with rates. So the question's a fairly straightforward one today. How low does the euro go? Joining us now to discuss, Marcus Ashworth of Bloomberg Opinion and Bloomberg's Maria Tadeo. Maria, I want to start with you. Christine Lagarde was at pains yesterday to point out that hikes are still possible. But while she was talking about that, the data were telling the real story. And the data were telling a story of Europe and its growth slowing down dramatically. And that's the danger. That's the risk for the euro, isn't it?
Yeah, absolutely, Guy. And again, today, because she was in this meeting today of finance ministers in Spain that has taken place just a day after, there was a lot of commentary, too, from finance ministers about this decision, which is unusual because usually they try not to comment on the actions of the European Central Bank, but it tells you just how palpable some of the tensions around this hiking cycle have been for the European Central Bank. Now, today, again, she repeated this fact, not being definitive that this is the last hike. Of course, as you say, the market believes very much they are done now, but also repeated, look, we have to focus on duration, we have to focus on the strength, and also reiterated again to a question that we asked her. The market is already praising or putting into the table the idea of cuts, and then she repeated, we have not debated this, we have not contemplated this, we don't even pronounce the word cuts, and this is the issue for the head of the European Central Bank. She may not want to hike more, but she also does not want to signal that they are done as to not precipitate this question and this debate around cuts, because they really do not want to hear this word.
No, they do not. And Marcus, it doesn't seem like, though, the market believed that they didn't talk about it or just kind of looking through it. How low does the euro go?
Well, I mean, as Salvini said, maybe she's on Mars. I don't know. I think that the definitive level of the euro is more or as much, but probably more down to the dollar than the euro economy. At certain points in any cycle, particularly if interest rates are rising sharply, you're going to have interest rates dictating the short time frame for where the currency pairing may be versus, say, the dollar. As we know, the euro, it's against all the other currencies and overall in its trade-weighted basket, it's at the highest it's probably ever been. So it's really just the euro versus the dollar that we're focusing on here, because that could definitely head down towards parity. Ever seems likely to me that even the ECB's reduced growth forecasts are not going to get anywhere near the levels they expect them to. I expect there to be the fact that Europe is in recession, and that could actually get quite a little bit worse, certainly by the end of the year into next year. So if that sense is that therefore it takes away the chances of the plateau, the table mountain, whatever you want to call it, of the ECB, they're trying so hard to get this mantra through. I don't think they'll be able to last as long as they are hoping, and I think expectations of a cut in, say, June next year are going to be pulled forward towards March fairly soon.
Marcus, isn't the other issue that the energy story is raising its head as well now? Energy prices are shooting higher. As somebody put it earlier on Bloomberg Television, the dollar is a petrocurrency now. It benefits when oil prices go higher. The euro is the exact antithesis of that. It is going to suffer potentially because the growth hit is going to be substantial.
Yeah, and this is an interesting point. It's a double-edged sword here. You've got whereby, if oil prices go up and it contracts the economy further, then it will actually weaken the euro relatively quicker, because it will become much more of a growth story, as you alluded to already, rather than a rate story. They know they can't raise rates. They're going to have to probably move to cut rates, but at the same time, inflation's getting worse and pushing the economy down. It comes a double nightmare for the ECB, and that's the situation they put themselves in. And I feel for them, but the point is it makes it very difficult for the currency to do anything other than be on a naturally downward trend versus the dollar towards parity, unless the Federal Reserve does something different and decides it too wants to definitely pause and look towards rate cuts. Until the Fed starts looking at rate cuts and the dollar does start weakening properly, the euro, unfortunately, is on a downtrend.
So, Maria, this brings us to the second part of the conversation you had with Lemaire, which was about tariffs and really pushing back on EV deliveries from China. And sort of like the other edge of this is growth. You need growth, right? And he pushed back against a trade war But this is what we're evolving into, it seems.
Yes, and Alex, if I may, just to add a final point here in this idea of cuts. For the European Central Bank, it is very clear they do not want this inserted into the debate. But I would also have a word of caution here on just ruling out they are done fully hiking, because when you speak to the German finance minister today, Christian Lindner, he still said, look, inflation should be the #1 priority, even though it is the German economy. And again, going back to your question, that is a growth story, potentially this economy going into recession. And when you talk potentially at the German Central Bank that they are fully done, I'm not sure they would be that quick to say we're fully done. The same thing happened going into this meeting. That is not to say, of course, the market is fully wrong in the pricing that they have put in, but we've seen that sometimes the story carries a little bit more nuance. Now, in terms of the growth story, yes, this is a perennial issue when it comes to the European economy. In fact, you know, there's a debate still going on over the fiscal rules, that benchmark for deficit and debt levels of the European economy. There is pushback now to some extent that the European economy is too fixated on those benchmarks, is not doing enough to trigger growth, and then now enter, of course, this idea of a trade war. The French finance minister was very clear. The European Union does have a right to look at areas where they believe is not a level playing field. And he also said, not specifically mentioning China, but he also said we should not be scared of looking into those areas and then correcting them if necessary. Although he did stress we do not want to trade, or we do not want a trade war. But of course, I wonder what the Chinese are going to think about that.
Maria, I just want to talk more about the growth story as well, and it does come back to these fiscal rules. The US economy in many ways is being driven by the largesse of the federal government, of Joe Biden's policies. The Europeans have not done that. To what extent is that now being seen as a mistake? The European economy is stuttering in a way that the United States is not. Do you think we see more fiscal, a desire, a greater political push to do more, or are the Germans going to hold us back from that?
Guy, that's a good point. But again, it also shows again just how difficult it is to manage this economy, because in the same press conference that Madame Lagarde again defended her raise decision and of course debriefed finance ministers about that hike yesterday, she was also accompanied by the head of the Eurogroup, who said it is clear now that we have to tailor our fiscal policy. So in fact, the debate around that is moving in a different direction. They still believe that fiscal policy is a drag on the monetary policy, and that makes life difficult for the European Central Bank. I wonder, however, the downturn becomes even more specific to the European economy, where this debate will prop up to the surface. What I could say, however, again, going back to this debate of the fiscal rules, is that European economies, some of them do say we have been too fixated with the debt and the deficit and not too much on the investment and growing this economy. The fundamental issue here, however, is that the Germans are still tough on inflation, and they still say debt and deficit matters, even though, and this is what is tricky about the situation, they are the ones that are suffering the most at this point.
Which is interesting, because that's one argument. Then Marcus, on the other side, we're starting to hear conversations from, say, Rich Clarida, that what matters more right now for yields is going to be fiscal policy. And that fiscal policy in the U.S. then kind of working against the Fed in essence, and that you're going to have a lot more issuance longer term, and that yields are going to be persistently higher.
Yeah, well, this is the classic European debate, because essentially the single market is one big protectionist bloc, and the only way it can defend its Das Auto is by putting up even more bearish yields and buy itself time to hopefully let the big three German auto companies create a potential price point, at least not massive disadvantages against Chinese EVs. This is very much a French-led initiative. And I think it puts Germany in an invidious situation. They're happy to go along because obviously they produce an awful lot of cars in China, and they have much more at risk than, for instance, French manufacturers have. But look, I mean, the ECB has done what it's done. It's creating a problem whereby monetary policy has gone as far probably as it can go. You switch back to fiscal policy. There's no real levers to pull. Look at where German manufacturing PMIs are. They're below 40. So something has to be done. Does that mean another next-gen EU package? Possibly. But for the moment, all they can do is whack up the tariffs and hope they can hide for as long as possible.
That's well said. I think we're going to leave that there. Hey, Marcus, and really appreciate it, Marcus Ashford, the Bloomberg Opinion, and Bloomberg's Maria Tadeo. Thank you for the interview, and thank you for joining us now. All right, coming up, more on the question of the day, just how low does the euro go? Hugh Gimber, global market strategist over at JP Morgan Asset Management, is here to help us answer that question. This is Bloomberg.
this attitude from it's an indulgence, a waste of time, almost an illness that needs a cure.
For something as universally important to human life as sleep, mysteries surrounding its necessity and utility have only just been recently uncovered.
Some of our biggest discoveries were in the 1970s or 1980s, and so it makes it a really exciting field because it seems as though we're uncovering new insights each and every day.
Some scientists are going further to find out how sleep and what happens there can be harnessed to further expand our understanding.
It's easy to memorize things. That makes you smart if you can spit back a lot of facts. But if you want to be wise, if you really want wisdom, you got to know when and how and why to use that information. And that's what your brain figures out while you're sleeping.
What do you have for skincare for men in their 70s that have a lot of wrinkles? I mean, is there any way to get rid of the wrinkles?
I have a lot of amazing things,
really?
But maybe it'll be a little bit beyond skincare.
Oh.
They'll pause. I don't think at this point they can hike, but they'll keep wide open the possibility of another hike, and they're going to push back against this notion that they'll be cutting anytime soon. The message will be, we're going a little bit higher, and we're going to stay there for longer.
That was, of course, Mohammed. Bloomberg opinion columnist Mohammed El-Arian speaking to John a little earlier on Bloomberg Television. Break takes us back to our question of the day. How low does it go? How low does the euro go? Hugh Gimberg, Global Market Strategist at JP Morgan Asset Management, joining me now on set. Hugh, nice to see you. Are we in for a bit more euro weakness, do you think?
So growth is going to give you the answer. I think when central banks are hiking, the pausing point is dictated by inflation. And when they're cutting, really it's dictated by growth. So this is all going to be about now how quickly the Eurozone can get itself out of the rut that it's found itself in over the course of the summer. I think there are two big factors holding back the Eurozone at the moment. There's the energy story, which even though you've got inventory still at strong levels, companies are still facing much higher prices prior to Russia's invasion of Ukraine. But then there's also the China story. And I think there are some signs now, if we squint at some of the more recent data, are we just starting to see a bottom? So I think if we were to see a re-acceleration, that would be something that could prevent this euro weakness from continuing. But at the meantime, it's hard to really look past the US growth story versus the euro. So hard to see it changing. I think the euro does go lower, but keeping an eye on China.
But at the same time, keeping an eye on China, but then it looks like the EU is going to be in kind of a tit for tat at the very best with China over EVs, which is going to ripple down into the luxury sector as well.
That's right, but I mean, you've seen the reaction today. Some really strong numbers coming out of the luxury players just on a small beat on retail sales. I think it tells you how pessimistic investors have got themselves now on the Chinese outlook. We've had a reaction this week in terms of a triple R cut. I think there'll be more policy stimulus to come. So let me be clear, I think the global growth outlook is pretty challenging at this point, but it all has to be anchored off investor expectations. And to my mind, investors are looking pretty pessimistically about both the Eurozone and China today.
And is that, so you think, not just with the luxury stocks, that is reflected in European equities?
So on a relative basis, yes. When you look at Europe, you're trading roughly in line with long-term averages on a 20, 25-year basis. You absolutely cannot say that about the US market. So our views generally across the board are relatively cautious at the moment. We think this growth slowdown continues everywhere, and it's necessary to bring inflation back down. But if you're looking for relative value plays within the equity market, I think you're tilting away from the US into other parts of developed markets, and Europe has to be one of those places where you're now starting to question whether there's enough in the price. And to my mind, back at long-term averages, that's fair value.
I mean, that's what Citi is saying, too, that if Europe's discounting a pretty pessimistic earnings path and that that leaves a nice buffer if something bad does happen, basically. Where in Europe, though?
Sure. So, I mean, this is all going to be not so much at a country level. This is going to be a sector story. I find it gets very confusing if you try and think through the European market on a country-by-country basis, just because you end up with so much stock-specific risk. So industrials would be one place that I'd be looking at. You look at manufacturing new orders in the Eurozone at 39. how much weaker can that really get versus where we are already today? So that would be one area. I think the banks are another place to look at as well. Clearly some bumpy times earlier this year, but if we're right that we're moving into a version of the world which is not just higher for longer looking out into 2024, but actually a decade of positive interest rates ahead in the Eurozone and much more meaningful profit margins for European banks, that would be another place to look in my view.
You take me to bonds. There is a lot of concern in the United States that actually bonds are not going to come down, yields are not going to come down that much. In fact, there is a risk that they go higher from here. You've got fiscal spending deficits to think about. You've got what's happening potentially in a few weeks' time, potentially another government shutdown to factor in. What happens in Europe? What do you think the rate trajectory looks like here? And could it be different? Are some of those factors different over here than they are over there?
I think they are different. So we've been doing a lot of work on this over the past few months, thinking about the impact of a central bank on pause. And history generally tells you that peaks in 10-year bond yields often coincide with a pause in that rate hiking cycle. Now, that's true in the US, but I think what's different in the Eurozone is that you don't have so many of those push and pull factors. It's quite easy to think through what could tilt Treasury yields higher from this point. To my mind, there's more aspects biasing yields lower in the Eurozone today. As you say, you don't have that big supply problem to deal with. You have another winter coming up. Who knows what we're looking at in terms of energy prices ahead and what that does to the growth outlook. So I think of all of the opportunities within Europe today, fixed income is the standout. This to me is a good time to be adding some European duration.
What about UK? What do you do with that, particularly ahead of the BOE next week?
Sure. So, I mean, similar story on the fixed income side. We've had a major repricing. I think that was necessary. But when you're looking at UK versus Eurozone, the one big standout in the UK is the labour market, where I think there are greater structural headwinds to bringing wage growth down. We saw that very clearly in this week's numbers. Unemployment rising, and yet wages pushing upwards towards 9% year over year. So I think the case is, more positive for global government bonds as a whole, but on a relative basis, gilts are still a little bit more fragile because the Bank of England has more work to do to get this labour market under control.
More work to do and no confidence. People apparently no confidence in the BOE, or much less. All right, Hugh, thanks a lot. Hugh Gimber, a global market strategist over at JP Morgan Asset Management. We very much appreciate it. Guy, no confidence. Did you like that one?
Yeah, I'm not sure the governor's going to like that one very much,
Not so
but
much.
the data speak for itself. The Bank of England, I think British institutions more broadly, struggling with a crisis of confidence right now.
Yeah, sorry
There's
about
some
that.
of them. This is Bloomberg.
The names that move markets are on Bloomberg.
There's a complete change in the labor market. There's a complete change in the energy future that we are facing.
Under tightening would be a worse mistake than over tightening because we can course correct that.
The question is whether we need to increase the pressure or just keep pushing.
We've been getting good news. We just have to keep getting good news.
Nobody covers business like Bloomberg, your global business authority.
Slice through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal.
Now, more to the point.
What is the lesson or the observation?
those reporters like outside an Apple store when they finally went on sale, when like the new iPhone finally went on sale. Well, not anymore, because they went on sale and it's kind of like, okay, they're going on sale. Pre-orders begin for the Apple 15. They have gone live. Now, the most expensive release of the phone yet, the iPhone 15, are going to become shipping soon and in stores from September 22nd. However, if you're looking for that Pro Max, you may be waiting as long as mid-October. I will not be getting one. My phone's relatively new, so I don't need one. Guy, what about you and your family?
This is Alex's moment to mock me. Apparently, if you are a Samsung user, you deserve to be mocked. I have two Samsungs. Apparently, therefore, I get mocked. I've always got on with Android. I find it very intuitive.
I don't know how to
know a lot of
type on
people
it.
disagree with me on that.
I can't do it. But this is why Apple sucks you in, because then you have the whole ecosystem. So even if I wanted a Samsung phone, I have Apple TV, and then we have the Mac at home. Like, how can I do it? And that like bugs me, which is the point, I guess, of the ecosystem, but it still bugs me.
Precisely. And you get sucked in and you use everything within that ecosystem, and that is part of the attraction. And that's going to be the big Apple challenge going forward from here as well, is if that form factor were to change, would we find ourselves in a situation where people would migrate away from it? Maybe not. Maybe the stickiness does work. But yeah, the team, maybe less you, but the whole team mock me actively on a daily basis for being a Samsung user.
Look, I would never mock you,
which makes me want to stick with it.
I would never, ever mock you. It's not what I do.
No. Okay.
All the time.
We all know that's not true.
That's not true at all.
Not true. You called me old earlier on this week, I think.
did.
Anyway, talking of friends, I bring news of a friend of the show.
Yes.
Mark Manduka, who I haven't seen for a while, actually. Remember The Warehouse? He's been on, obviously. Came from Citi, then went to GXO. Anyway, I hear news this morning that he is leaving GXO, which is a significant moment. And he is going to be joining, I guess, the guy that's kind of behind GXO. We all know him, the billionaire Brad Jacobs. Basically, he's going to be joining Brad's PE outfit. Now, what I think is interesting about this is that actually this is Brad's first big kind of external hire, outward-facing hire, I guess you probably put it better. And maybe it finally means we're getting closer to news that many have been waiting for, I think, over a year now. Basically, what does Brad do next? He wants to be a CEO again. He's going to be a CEO again. What kind of industry is he going to be targeting after logistics? What comes next? So we'll wait and see. But I think Mark's move, we'll get more on it, I'm sure, probably is going to be a significant factor in the timing around all of this. So watch this space. Brad Jacobs is a name to watch once again. Okay, let's talk about the European markets. They're at the 52-week highs. There's a few of them out there, a lot of them in the defense and aerospace sector. ISG is also up. We're going to hear from Peninsula. New hotel opening in London. We're going to talk about that in the next half hour as well. The close is next.
Most of the large Chinese technology companies, let's say Alibaba, Baidu, Tencent, they have gigantic market values and they're very prominent in China, not as prominent outside of China as obviously in China, and certainly not that prominent in the United States. TikTok, by contrast, is not in China, but it's gigantic outside of China, the United States, and everywhere. What did TikTok do that enabled a Chinese-based company, parent company at least, to do so well outside of China?
We think it's challenging to build a global company in general, but the best ones we have seen so far are ones that take very consistent global learnings and adapt them to the local countries that they are operating in. So you need to be global and local at the same time.
from the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets. Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacroix, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis, weekdays.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
So, we're wrapping up the day, we're wrapping up the week here in Europe for European equities. Today, positive, but we faded the move that we got earlier. Better data, slightly better data out of China a little bit earlier on, providing a nice pop for European equities, particularly in the luxury space. Some of that has remained, but some of it has definitely faded out of the system. We're still higher in London, we're still higher in Frankfurt, we're still higher in Paris, but not as much as we were. Those three markets definitely, though, the standouts. What does the day look like? What does the week look like? Let's talk about it, because I think it's been fascinating. I think there's so many overlays that come into this story as well. What's happening in the currency markets, what's happening with central banks, what's happening with the energy markets, all comes together, I think, this week. This is the 5-day. Nothing, 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 nothing. You get a bit of a pop, and then we fade that move. That's basically the story. On a 5-day basis, we're up by 0.6%. Is that the bottom? Do we go higher from here? There's a lot of negativity now priced into European equities. LVMH, earlier on this week, LVMH was down by 20% from its highs. It's clawed back quite a lot since then. Today, up by another 2.26%. Yesterday was up quite a lot as well. ASML, this is the TSMC story. TSMC apparently pushing back orders for lithography. That's a hard word to say. And that's going to ripple into ASML. That stock is down by 3.64. The rest of that sector, SMI, etc., all tracking a little lower as well. Henderson Mauritz, H&M, look at this, down by 7.3%, 7.4%. That is a really interesting story. So Hennes has basically tried to push through price rises, and consumers are now pushing back against those price rises. And as a result of which, you've seen a top-line hit. The market didn't like that today. That stock being absolutely battered to the downside, 7.4%. As I say, that's a price cut. Let's talk about what comes next week. This week has been interesting. There's plenty to come next week, though. Kind of starts midweek. UK CPI is going to be worth watching out for, because of the simple reason that on Thursday we get the BOE rate decision. We've also obviously got the Fed before that, which is going to be fascinating. Pause or hike, pause or hike. Similar question that we asked over at the ECB. We got a hike. Are we going to get another one from the Fed? If not now, are we going to get further down the road? We've also got the Bank of Japan next week. There's lots to think about here. This, as we're seeing energy prices rocket higher. This, as we see the dollar continue to track higher as well. We're also going to get some global PMI data as well. What are the PMIs telling us? Well, at the moment, the PMI data out of Europe is telling us the manufacturing has absolutely cratered. Are we at the lows there? What is happening with the growth differential? I think the PMI data is going to be really instructive in telling us kind of what we do next. And next week, Alex, huge.
Huge, definitely, 100% huge. That's why we want to take a look at a euro dollar. So I appreciate that it's up slightly today, but you're still looking at 9th straight week of losses, which, as guys pointed out, is the worst on record. So how low can it go? We're joined now by Jane Foley, head of FX strategy at Rabobank. Okay, you got it. How low does it go?
Well, you know, our target was 106, but we thought it was going to take a lot longer to get there. Instead, you know, we're nearly there now. So we're going to have to look to shift to revising that 106 target lower, because I do think it can fall down. Now, not only is the market focusing on the growth outlook, which of course is pretty dire now in Europe, but, you know, if we look at the politics, if we look at the fiscal policy, if we look at the debt, there's nothing particularly pretty about that outlook either. There's a lot of populism in Europe, people unhappy with what they've been offered, you know, happy with what incumbent politicians have offered them over the crises that we've had. And, you know, there's a lot of far-right movements. We've got EU elections in the summer, and the far right, whilst they're, you know, anti-immigration, they're very nationalistic, they often have leftist fiscal policy views which might sound like a cure if you want to boost growth, but we've got still high inflation and a huge amount of debt. So, with this debt pile really mounting, I just don't see the longer term factors looking very attractive for the Eurozone at all.
Is it too early to use the P word, parity?
I think you probably can. I mean, we're still a long way for parity. And of course, we've got to really decide what's going to happen with respect to the dollar, because this is not just, of course, a euro story. But, right now, if we look into perhaps the start of next year, what we're seeing is a very resilient US economy, and also, fears of slower growth both in China and in Europe will depress risk appetite, which actually is a dollar positive story too. So, the dollar may only begin to soften when the Fed interest rate cuts really do come onto the horizon and the market begins to think, is this a good opportunity to buy something, in the high yield space? So that may not be until we push into the spring, quite possibly. So, I think dollar strength is going to persist for a while. Euro dynamics do not look very good, and we could have euro dollar languishing at very nasty low levels for a while, which of course won't please the ECB when it's trying to get down inflation.
Well, no, and but also then there's the dollar side. So a lot of the scenario that you outline with Europe in terms of messy politics, unhappy people, right wing, polarizing, that's also describing the U.S. So I'm wondering as to what end you think that the dollar is kind of overdone.
Well, the dollar has a different link with its own domestic fundamentals. So, for instance, look at the US fundamentals. They're really not very good. You've got a nasty current account deficit. You've got a nasty budget deficit. Does it really drag the dollar down? Well, no, it doesn't. And that's because the dollar has this safe haven position. And the reason why it's got a safe haven is that, the dollar in some respects, belongs to the world. So many people, have the US dollar in their central bank reserves. The reason for that is, of course, it's a huge transactional currency. It's a big invoicing currency. So everyone needs the dollar when there's a crisis, and that allows the dollar a little bit of independence really from some of its nasty fundamentals. So I think the movements that we've been talking about are perhaps more apt really to describe the vulnerabilities of the euro rather than the dollar.
Jane, is the dollar a petrocurrency as well?
Well, you could certainly say that in terms of, the US does use a lot more oil, but also, the US is a much more closed economy relative to, say, Europe. So Europe, much more exposed to the Chinese slowdown, for instance. The US, much less. So because it's a much more closed economy, you could probably, form an argument to say it's actually a little bit less exposed to many of the crises that we're facing in terms of potentially food prices, energy prices, etc. So from that point of view, I suppose it's more or less the same thing. It is more protected from some of these crises that Europe will not be.
So let's game that out. What does Japan do? What does China do then?
Well, we had, of course, this story this week about whether or not we could see an interest rate hike in Japan. I mean, that would be great. That would be wonderful. But can they really hike in an environment when, China is pretty weak and Europe is pretty weak and the US will be slowing too? And, that means it's still quite unlikely in my view. So, yes, they want to get out of this cycle. Yes, they want to see self-sustaining, domestically driven inflation. And yes, they are a little bit closer to achieving that than they were. But if they hike too soon, then they could just put themselves back to square one, which is, of course, they don't want to do. So it's difficult. I think it's a very difficult position, for the Bank of Japan. But I still think that we can't assume that they're going to be in a position to hike interest rates by the end of the year or early next year.
If the Bank of England hikes next week, does the pound go up or down?
That's a great question, because last year, we saw a few occasions when the bank did hike and sterling fell because the bank was coming out with gloomy growth prospects. And I think the central bank in the UK, like the ECB, has got a really fine line to walk, because if it's too hawkish, the market's going to think, oh my God, we've got recession, sell the pound. And yet if it's too dovish, they're going to say, oh, interest rates, money market rates will go down, and the pound could go down too. So they've got to have this sort of enough hawkishness to try and keep the pound up and money market rates up without making the market panic about the risks of recession. Now, we all know that there's a danger that they could over-tightening, and their job, I suppose, is to try and persuade us that they won't do that. But that's going to be tough if the inflation rate remains pretty high, as it is likely to be next week, and given the gloomy growth outlook.
Yeah, I don't know. I mean, if Christine Lagarde couldn't do it, I don't know how Andrew Bailey is going to do it, particularly with the credibility there. I don't know. It feels like that's even a tougher. Is there even a tightrope to walk at that point, Jane?
Well, I mean, I suppose there's always the possibility, but it's tough. And I think we can see some of that story looking at euro sterling. And, about a month ago, we had those really gloomy PMIs from Germany, and euro sterling tested the downside, but the market didn't like it, and it bounced back. The market doesn't want to see sterling right now, or at least it's uncomfortable seeing sterling, gain ground against the euro. These two are sort of stuck in a head-to-head. So it seems, I think, that will continue, for a little while with the market sort of viewing these central banks in quite similar conundrums.
Alex, Jane is a fantastic person, and she's also a little bit weird. And the reason I say this is that apparently she has an Apple phone and an Android phone, which I really can't get my head around. It's either one or the other. She can do both. It's like being ambidextrous. It's very strange.
Wow, there's two of you right now on screen. That was amazing. That was awesome. That was way too much guy for me, man. It's true. I was actually going to ask that to Jane. Does she have an Android or an Apple? I cannot type on an Android. I don't know how it works. My brain can't do it. Kudos to you, Jane, for being able to do both.
I much prefer the Android.
The Android. Yeah. There you go. Look. I'm getting fan mail about the Android. People love the Android.
It's not getting fan mail. He's really not.
I will forward them on to you.
Okay.
Jane, thank you very much indeed for proving my points. We love Jane. Jane Foley of Rabobank. Okay, let's check where European stocks have settled. End of the week. These are the final numbers. This is where we have closed. Generally, actually, a fairly positive week, but we've been bouncing around all over the place. So many different factors coming into play here. You got the oil story, what is happening with, obviously, the China data has been huge as well. What has been coming out of the United States, the ECB, there's all kinds of factors to play. But these are the final numbers on the week. In many ways, we're still in the range. And I think that probably is the takeaway. What is going to shake us out of that? We'll see whether the growth story is enough to do that to Europe. It's going to have to be quite a big downside growth move. A lot is already priced in. Talking of luxury, let's talk about what is happening in London. There is a wave, Alex, of really super high-end, think Dubai high-end hotels about to open in London. The brand new Peninsula is certainly the first out of the block. It's going to be shaking up London's luxury lodging scene. Lodging is the word we use. Hotel scene over here. Clement Kwok, Hong Kong and Shanghai Hotels CEO, joining us next to talk about this and the competition that's coming. That's next. This is Bloomberg.
I know one of the reasons you're here in Marrakesh and in Africa because you see the enormous potential this continent has as a source of renewable power for electrolysis, right? That's the process by which hydrogen is extracted from water. Tell us about Africa's potential.
Africa's potential is the best in the world, and it's Africa's shot now. It's Africa's turn. What will stop Africa rightfully taking its turn will be lack of progress on technology. Companies and governments around the world choose Fortescue because we are the world leaders in technology, world leaders in next era electrolyzer design, cables, solar, all the tech which is moving our world on from having to rely on dinosaur era fossil deposits of oil, coal and gas to simply today's era of machines which make machines to harness all that beautiful renewable energy and give all the mobile energy, all the fixed energy this world could ever need by many times. Those countries who resist that are denying Africa their opportunity. And I'm saying, stop it. Let's get in behind Africa.
I don't think we can replicate Tesla. Tesla is unique because when they founded, and then the personality behind it, the product is beautiful, technologically very, very strong. So in many areas, Tesla is Tesla. But Xpeng is Xpeng. We want to focus on what we think is important for our customers. Our customer like beautifully designed vehicles, either it's large SUV or sports sedan. We believe we have a very, very appealing family look that our customers is really attracted to. They like to have user-friendly features inside the cabin that has a technology feel. It's very smart. It enables them to really utilize the vehicle that's different.
So I rode past it on my bicycle the other day. It is an impressive building. Buckingham Palace's new neighbour, not Buckingham Palace, the new neighbour, is now open and ready for business. The Peninsula London, a new luxury hotel, opens its doors this Wednesday. It features 190 rooms, all equipped apparently, and this is Alex Steele's input into this introduction with Dyson hairdryers. That apparently is the most important feature here. Walk-in closets, bathrooms lined with honey onyx marble. It's an impressive, impressive hotel. It's the first of many what people are calling ultra-luxury hotels that are going to be arriving in London over the next few years. And Clement Kwok, Hong Kong and Shanghai Hotels CEO, joins us now. The company, of course, behind this hotel. Welcome to Bloomberg.
Good afternoon.
This has been a long time in the planning. Talk me through what impact being in London is going to have and why we are now suddenly seeing London attracting so many, of which you are the first, of these ultra high-end hotels.
Well, thank you. First of all, I should explain that our company focuses on being a long-term owner-operator of hotels. We focus on a small number of cities around the world, which are basically the most important cities. We're in places like Tokyo, New York, Shanghai, Hong Kong, Paris. So, of course, London has been a logical extension of our group for a long time. We've actually been looking for a hotel in London for 35 years, but we're very fussy about finding the right location. And eventually, we signed a deal with Grosvenor in 2013 for this incredible location, which is right on Hyde Park Corner. So, this is not part of a wave, as it were. It's part of a long-term strategy where we want to own and operate some of the most special hotels in the world. And we don't do so many. There are only 12 Peninsula hotels around the world, but we're focused to try and make them exceptional.
So, Clement, it just feels that the UK in particular, it's losing a lot of its allure as sort of the finance capital. We've seen a lot of listing of UK companies actually come to New York. It's also being hit with growth issues, Brexit issues, and inflation issues. So I'm curious as to why now the UK makes a good place.
Yeah. Well, I believe there's always a place for super luxury. If you have an outstanding product, there will be an audience for it. And I have to say, we've only been open for 3 days, but we're seeing that, a real buzz in the lobby and the restaurants, people coming to the rooms and so on. And London, of course, the wider economy is one thing, but we're seeing very good demand for luxury in London still.
I know GP Hinduja. He's excited for Raffles going into the war rooms. You've got Six Senses coming in. You've got New Waldorf Astoria coming.
Yeah.
You're going to have competition soon. How are you going to beat them? How are you going to compete against them?
But every place in the world where it's worthwhile to have a super luxury hotel like this, you will find competition. And so rather than focus on the competition, I'd like to focus on our own strengths. As I said, we own and operate. We're investing for 100 years. We put a lot of investment, a lot of time and effort into designs and details and so on of the hotel. Love to show you around if you can come around and look at what we've done. And, we have to have the courage of our own product.
Well, to that point then, give me some insight. Okay, for 3 days it opened, that's great, and you're definitely seeing that demand and the buzz. Generally, in terms of demand, 2023 was just a stellar year for travel, that revenge travel that people thought was going to end earlier. What's your visibility into that for the next 6 months?
We believe that in terms of global travel, there is a long way to go in terms of recovery. There have been pockets of recovery here and there, But as I said, we do believe that luxury will continue to be in demand. And remember, we're investing for 100 years. If you invest for 100 years, you know there are going to be ups and downs. If you don't have the staying power to go through those ups and downs, you will not be in the business of long-term investing. So I think the most important is to have a great location, to create a really outstanding product that you maintain and improve and maintain that quality, and hopefully over time you can be very sustainable.
Sustainable is an interesting word. Has travel changed though before and after the pandemic? Has luxury travel changed before and after the pandemic?
Well, there have been changes in terms of demand in different areas.
But what people want and how people perceive the products.
To me, the fundamentals of what people want have not changed. Right. It is things like space, attention to detail, personalization, relationships with between the hotel and the customers, and just the whole service that you can provide. Now, of course, how you execute those services can change over time. For instance, it has become more digital. You do marketing in a certain way. You have devices. By the way, we're very advanced in technology in our hotels. So in the hotel room, you can control everything from the technology that we have in the hotel rooms. So these are all, if you like, how you execute that luxury. But the fundamentals, I believe, remain the same. It's the relationship that matters most.
Clement, before we let you go, where are you going to go next? Where's the next spot?
Well, we've opened also in Istanbul earlier this year. It's a fantastic location right on the Bosphorus and actually overlooking the old town as well. That's 3 historic buildings and a new one. Well. That's a special place too. So please come and have a look at that too. Beyond that, we haven't decided where to go next.
Okay. Clement, thanks so much. Clement Kwok, Hong Kong and Shanghai Hotels CEO. Now, Guy, I know you don't use hair dryers, but the Dyson one is the key, and they're quite expensive. So when you get it, when you go somewhere, it's a fun moment.
The fact that this is what makes the difference, I find incredible, but I guess it does matter. That wouldn't be necessarily what I was looking for, but now I'm going to see hotel hair dryers in a completely different way. Anywhere that is not a Dyson clearly is not up to scratch.
As you should. This is Bloomberg.
Have you thought maybe I should go do something else? I can't do anything better than I'm already doing. I've already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
This is Bloomberg.
U.S. stocks still trading heavy. Really, tech is what's getting hit the most. Yield a little bit higher. Abigail is tracking the moves for us. Abigail?
Yeah, there's a fair degree of a sell-off here, Alex.
kind of out of nowhere, too. I think that the only thing that I can pinpoint it on is perhaps the fact that it is triple witching. You don't always get this kind of volatility on a triple witching day, but today it does seem that we have some big declines. To Alex's point, take a look at the underperformance for the NASDAQ 100, down 1.5%, also down on the week. The S&P 500 hanging on to a small gain. The SOX down 2.4%, down nearly 2% on the week. And the Russell 2000, it's down 1.1%, also down on the week. So this is shaping up on today to be a bearish week. Now, one of the pressures, of course, are yields. Alex mentioning that the yields are up a little bit today. When we put it into the context, though, of where we've been over the last year, we can see that we have this 2-year yield back above 5%, climbing higher, 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 making everything look more expensive as money conceivably comes out of the system. Now, because it is triple witching day, let's take a look at a chart that has to do with options. Now, this is the skew index. Traders absolutely hate it because it's not very predictable. I happen to like it as a market observer over the last few years. Back in 2015, it spiked well in advance of the sell-off that we saw in 2015, 2016. Take a look at 2018. In the summer, it peaked, and then we had that massive sell-off that fall. In 2019, right ahead of the pandemic, it spiked. We recently spiked. We're coming off of that, guy. I think it almost begs the question of whether or not we have some more serious selling ahead this fall.
I'm hearing that more and more often from you, Abby. You've got a few little charts out there that are maybe causing the bulls a little bit of concern. Abigail, thank you very much indeed. What are we going to be watching? What's coming up? EU finance ministers meeting in Spain. They're going to be holding a news conference. We think that probably is in around an hour's time. They're always a little flexible in terms of the timing. UAW, of course, workers now going on strike. They're going to be holding a rally at the UAW Ford building in Detroit. Senator Bernie Sanders expected to be there. And we are awaiting, of course, on that note, President Biden's remarks. We think he's going to be addressing the issue of the talks between the auto workers and the Detroit Big Three. That would be of no surprise. We think that's going to come a little bit later on today. Alex, the subject of discussion this weekend, of course, is the Rugby World Cup. There's 2 opportunities to talk about sport. This is fantastic. I love the way that this show is evolving. It's taking place across France as we speak. New Zealand are going to be playing Namibia a little bit later on. We've got Japan on Sunday, I think. I have to say that this is probably going to be the kind of the most watched Rugby World Cup we've ever seen. However, the Fiji game was amazing against Wales. But the sport has been dominated, the tournament has been dominated, though, so far by head injuries. And I think this is kind of the way the story translates across the Atlantic. It's no surprise that our producer is a Kiwi, and therefore we're showing you pictures of Kiwis wearing black. But I think this is where it translates across the Atlantic. It's a similar challenge to the NFL, basically. This is a concussion crisis, and how sport deals with it, I think, is going to be a massive problem.
Yeah, oh, yeah. And then long-term issues as well, 100%. This is where we needed 2 of Guy talking about sports. This is when we needed the Guy split screen. This is the moment where it had to happen. Congrats. There you go. Oh, there you go. Beautifully done.
Look at that.
Well done. Oh, that was just, thank you for making my day, Anthony. All right, Mike Cagney, Figure co-founder, joins Bloomberg Tech with Caroline Hyde. This is Bloomberg.
So many people say the only way to really deal with climate change is kind of eliminate oil and gas and then have more clean energy. Is it realistic to eliminate oil and gas in the foreseeable future?
You actually have to at least mitigate it. I think you have to bring a lot of it down and replace a lot of it, but you can also have a huge impact by trying to do things like carbon capture and so forth, right, and around it. And it's going to take both approaches. Even today, greater than 80+% of the way the world operates around energy right now is still fossil fuels, when you kind of look at it. And probably what's more striking is the fact that the demand for it is going up every year.
Things like solar or wind, it's nice and environmentally friendly, but really it's not going to produce enough energy to really replace oil and gas in my lifetime, I assume, right?
Well, not by itself. So let me just say, solar and wind are critical components. This is going to be sort of a collective effort with a lot of different technologies that are each going to come in and take their piece. We do a breakthrough. We look at technologies that could produce remove half a gigaton of carbon a year. And the way to think about that number is we have to remove, say, 100 half a gigatons, a year in terms of what we have to replace.
From New York City,
From London, in Sydney,
from Washington,
in Tokyo,
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
From the heart of where innovation, money, and power collide in Silicon Valley and beyond, this is Bloomberg Technology with Caroline Hyde and Ed Ludlow.
I'm Caroline Hyde at Bloomberg's World Headquarters in New York. Ed Ludlow, he's off. This is Bloomberg Technology. Coming up, well, as the markets drop, we'll talk all things IPO. Arm completes the biggest of the year. Instacart gears up to go public next week. We have so much more ahead. And we'll talk the state of fintech with a former CEO of SoFi as his company joins others in withdrawing applications for banking charters. Why? Plus, how will the UAW's unprecedented strikes impact automakers and the electric vehicle market? We'll discuss that and more. Plus, let's check on these markets because it is a down day and it is a volatile day. It is triple witching, as we know, yet more volatility comes as the options expire. The NASDAQ being off by 1.3%, dragging us lower. The NASDAQ 100 as well. Feeling the pain, the Amazons on the downside, so too is the Nvidias. And indeed, this news report circulating regarding TSMC that it's asked major suppliers to potentially delay shipments of high-end equipment. We look to try and see as to whether or not Bloomberg can confirm those sorts of reports. But the chip sector is down by 2.4% on the back of those sorts of news swirling. And indeed, Bitcoin, risk assets in general on the downside, were off by almost a percentage point in face of a dollar that is basically flat on the day. Moving on, individual movers I want to get to you because we have seen, of course, the likes of Adobe, underwhelming, down by some 3.8%. Their numbers actually coming in line, but not good enough. Too conservative was the outlook, even though they did see continued strength, particularly in the digital media business. We're looking at Apple on the downside, even though it had rallied in earlier hours as we saw some strong demand for the iPhone 15. And Arm still managing to tread water. Buck the trend, we're up more than 2% after its initial public offering. And let's stick with that theme, the comeback. It's here. And of course, this week was the biggest debut of the year. We, of course, were speaking with the CEO, Rene Haas, who was confident in the outlook for his business.
We also have a very unique business model that gives us the ability to have a very, very good vision in the future in terms of when people use our products. So relative to our confidence in the outlook, we have a very, very high confidence that the growth rate that we have talked about will be sustained.
So how idiosyncratic was that event? Or how can we read across the rest of the IPOs? Katie Roof is here in New York to discuss it all. You are the person who marries venture-backed businesses as well as M&A, as well as into the public markets and the banks. And I'm ultimately interested as to how your sources are saying this read across for Arm is for the likes of Instacart, for Klaviyo and other companies that want to hit this market running.
Well, the IPO window is open. We've been talking about this for almost 2 years. You know, tech IPOs came to a halt in late 2021, and Arm has just been the first big one, and it went well. It went up 25%, which is, you know, where they often aim for these things to go. So, you know, we saw Instacart, they raised their price range, probably partly because of this. It shows that there's public investor enthusiasm. Of course, Arm and Instacart are very different companies, but bankers are still going to argue that this is, a sign of tech enthusiasm broadly. Instacart raised their range from 26 to 28 to 28 to 30. At the top of that range, they would be $10 billion on a fully diluted basis. So still lower than where they were, but better than where they were hoping a few days ago.
When we hear the reports of just how hands-on Massa was in this process and the idea that maybe he decided to undershoot in the overall price range that he could have got for the shares, leave money on the table to get that pop, are we likely to see that replicated by the others that want to come to this market? How difficult a balancing act is this at the moment?
So what happened was pretty unusual, where they thought, they could have priced, bankers thought that they could have priced the company at 52 a share, but ARM went with 51, partly because Massa just wanted to ensure, big pop on the first day. But of course, that means that a little less money was raised for the company. I would say usually companies are going to take the banker recommendation, whatever it may be. They do these pops to incentivize new investors for taking a risk on day one. Otherwise, why would you invest on day one? You'd wait and see how it went. But if you do too much of a pop, then that's more that the company could have raised. So they try to time it, but of course it's all just a guess. They do these roadshows where they're talking to all these public investors, trying to figure out what they're going to buy, how much they're going to buy, and they do some math, but it's also a lot of guessing.
And they've got an art of a guesser. You were just telling me before that, well, the CFO of Instacart knows these banking worlds well, having come from Goldman.
Yeah, exactly. Nick Giovanni, the CFO of Instacart, he used to run Goldman's TMT, their investment banking group for tech. So he was the one pricing all these tech IPOs in the past. So if there's anyone that knows how to optimize Instacart's success, it would be him.
All eyes on him, all eyes on Klaviyo as well for next week. We wait with bated breath. Katie Roof, we thank her for being here and safe trip back to LA. Meanwhile, well, let's dig into more broadly the market here and sentiment around technology names as we look for this IPO window to be back up and running with Laura Cooper, BlackRock Senior Macro Strategist for iShares EMEA. You're indeed a former strategist over here at Bloomberg as well, Laura. And I'm interested as to, you're in the world of ETFs, and what's so interesting about the ARM listing, and I know you can't go into individual names, but it's likely not going to get into ETFs more broadly, as it is an ADR, of course, a foreign company, but also very small floats. Overall, what sort of focus are you putting for your clients on these But members of, at the moment, United Auto Workers Union, they voted to strike as midnight after negotiations with Ford, Stellantis, General Motors. They all fell through. In fact, GM CEO Mary Barra weighed in earlier today on Bloomberg Television. Take a listen.
I will say we're ready for this. You know, as we've dealt with COVID and dealt with the semiconductor shortage, as well as other supply chain challenges that have, continued to persist from COVID. Our team knows how to manage these situations. They're staying agile, and we're going to do what's right for the company. We're going to make sure everyone stays safe.
We now can go to the White House. We understand where President Biden is addressing the nation.
Parties since this began over the last few weeks and over the past decade. Auto companies have seen record profits, including the last few years, because of the extraordinary skill and sacrifices of the UAW workers. But those record profits have not been shared fairly, in my view, with those workers. Just as the Treasury Department has released a report pointing out that the most comprehensive report ever dealing with how unions are good for both union workers and non-union workers and the overall economy. Unions raise workers' wages, they said, incomes, increase home ownership, increase retirement savings, increase access to critical benefits like sick leave and child care, and reduce inequality, all of which strengthen our economy for all workers. That's because unions raise standards across the workplaces and entire industries, pushing up wages and strengthening benefits for everyone. That's why strong unions are critical to a growing economy and growing from the middle out, the bottom up, not the top down. That's especially true as we transition to a clean energy future, which we're in the process of doing. I believe that transition should be fair and a win-win for auto workers and auto companies. But I also believe the contract agreement must lead to a vibrant made-in-America future that promotes good, strong middle-class jobs that workers can raise a family on. Where the UAW remains at the heart of our auto economy and where the big three companies continue to lead in innovation, excellence, quality, and leadership. Last night, after negotiations broke down, the UAW announced a targeted strike at a few big three auto plants. Let's be clear. No one wants a strike. Say it again. No one wants a strike. But I respect workers' right to use their options under the collective bargaining system. And I understand the workers' frustration. Over generations, auto workers sacrificed so much to keep the industry alive and strong, especially through the economic crisis and the pandemic. Workers deserve a fair share of the benefits they helped create for an enterprise. I do appreciate that the parties have been working round the clock. And when I first called them at the very first day of their negotiations, I said, please stay at the table as long as you can to try to work this out. And they've been around the clock, and the companies have made some significant offers. But I believe they should go further to ensure record corporate profits mean record contracts for the UAW. Let me say that again. Record corporate profits, which they have, should be shared by record contracts for the UAW. And just as we're building an economy of the future, we need labor agreements for the future. It's my hope that the parties can return to the negotiation table to forge a win-win agreement. To continue our active engagement, I'm dispatching two members of my team to Detroit, Acting Labor Secretary Julie Hsu and White House Senior Advisor Gene Sperling, both of whom have been involved up to now, to offer their full support for the parties in reaching a contract. The bottom line is that auto workers help create America's middle class. They deserve a contract that sustains them in the middle class. So thank you very much. That's all I'm going to say. Thank you.
Mr. President, at what point would you get directly involved in the negotiations? Should Hunter get a pardon, Mr. President?
President Joe Biden there speaking on the UAW workers' strike, really reiterating that the workers have his support. Nobody wants a strike, he says, but they are dispatching officials to offer support in the talks, and he wants the parties to return to the negotiating table and reach an agreement that he says would be a win-win. Let's first and foremost then go out to Washington. I think we have Kayleigh Lyons standing by just to wrap up what is quite a difficult balancing act for the president, because he wants to be pro-worker, pro-union, but also wants to be pro-EV transition.
Yeah, that's exactly right, Caroline. And you certainly see that pro-union sentiment coming through in the remarks he just made, among many other things, him saying that they should go further because record corporate profits should be shared with a record contract for the United Auto Workers, saying that auto workers help build the middle class and deserve a contract that helps sustain them and the middle class. So clearly trying to be on the side of the union here, even as he says that nobody does want to strike, because that strike also puts the other objective this administration has, or one of them at least, Caroline, which you alluded to, their desire for a clean energy economy, a transition to EVs, potentially at risk depending on how long this strike goes. Remember, this is an administration that through the Inflation Reduction Act is offering massive subsidies on new electric vehicle sales. It also has a goal of having half of all vehicle sales, new vehicle sales by 2030 be electric. So these two goals are really in conflict here for this administration. It is a very difficult line to walk, but obviously what they ultimately want at the end of the day is this conflict resolved, which is why he is dispatching both Gene Sperling and Acting Labor Secretary Julie Su to Detroit.
Perfect wrap up. Thank you so much, Kaylee Lyons on the ground in Washington. Let's get you more context from the auto perspective for a moment as well. Bloomberg's Gabrielle Coppola is with us. And Gabby, what's so interesting is I immediately think of Tesla in all of this EV race, and of course, doesn't work with unionized workers. So how much is this going to be affecting basically the competition against Tesla of this moment if Ford, if Stellantis, if GM are affected by such strikes?
Yeah, I think it does make it even harder for the Detroit Three to compete with Tesla, at least in this moment, because, they are plowing all those record profits and, these record car prices we've been paying. They've been putting that money into battery plants, into designing new electric vehicles. But they have a long way to go to catch up with Tesla. Tesla has a 10-year head start. And let's not forget about, even though we don't see a lot of Chinese automakers here in the U.S., they are, knocking on the door around the world. So they are under a lot of pressure. It's a tension because I think what the problem is that the automakers for the last 10 years have kind of, after 2008, that was it. They got the monkey off their back. They really, at the bargaining table in 2007 during the financial crisis, the workers really sacrificed a lot. And I think the automakers kind of thought that was the end of the story. We're moving on now. And I think what Sean Fain, the UAW, is doing is showing them, hey, not so fast. We're not going to agree to that. This, now or never, man. That's what's happening.
A new tactic at work, new leader too, Gabrielle Coppola. Absolutely brilliant to talk to you. Thank you very much indeed. We're going to do a hard pivot now. We're going to return back to a conversation that is much more about tech, but actually largely maybe about regulation, about an administration and its desire to be adopting blockchain companies in particular. We just want to be talking to the blockchain firm Figure and the latest fintech company actually to withdraw its application for a bank charter, a move made after years of waiting for answers from US financial regulators. Joining us now, I'm very pleased to welcome Mike Cagney. He is the former CEO of SoFi, co-founder of Figure, which uses blockchain to build financial products, such as loan origination, for example. We're also very pleased to welcome Shonali Basak to the show to help bring about this interview. And I think, first and foremost, a great article that you've helped pen in other media at the moment, Mike, just talking about the decision-making process of not becoming a bank. And it is, in large part, because of regulators.
Well, it's really around the state of regulation with blockchain. And Figure is a blockchain holding company. We have two blockchain-centric businesses, one in lending, one in markets. And we have over 200 state licenses. So you can see the appeal of having a national charter and not having to deal with the overhead of 200 state licenses. Also the ability to have liabilities to fund the assets that you generate. But Figure fundamentally is a markets business, and our lending business is more of a means to an end to build that marketplace out. And we felt without clear identification of what we could and couldn't do as a bank, it didn't make sense for us to move forward. There were other reasons as well, but that was the key one.
I'm curious what you think this means about the future of financial technology. Your alma mater, SoFi, is really leaning into the idea of being a bigger and bigger bank. You have the regional banking system that may not be the ultimate form of capital for people like you moving forward. So what role do the upstarts start to play?
So I think you're in a macro trend right now where the banks are contracting credit, and that would be exacerbated as the Basel III endgame went through. That's unlikely to happen, at least with the current regulatory or the legislative position. But you're in a situation irrespective where banks are pulling back. You're also in a situation where the asset liability ratio, where banks traditionally have, at least over the last several years, especially through COVID, have had massive amounts of excess liabilities and had to deploy that into assets. That's now flipped. Those banks are now liability constrained. They're having to sell those assets. And so I think systemically over the next 5 years, you're going to have a situation where non-bank lenders are going to be able to lean in and participate, access wholesale capital markets in a way that the banks are going to not be able to do. So they're going to fill that gap.
It's also, we'd be remiss not to talk about this idea of it being a humongous week in the IPO market after such a massive drought. We've reported that your lending business you're considering an IPO for. How has this week changed your calculus about how you're thinking about speaking to investors?
Sure. I think rather than talking to the IPO per se, I'd say that the lending business itself is a mature business, although it's still doubling every year. It's a profitable business, and it's really found an interesting opportunity in terms of lending technology. But what it is, again, is ultimately a marketplace business. And so when you think about what that vertical really looks like, it's not so much that it looks like an Upstart or a SoFi with multi-product solution. It actually looks a lot more like ICE. And that's ultimately the objective we're trying to go to, is to stand up private capital markets to take advantage of this contraction that's happening in the banking system. And we think there's a great opportunity to do that.
When you're thinking about being that marketplace, when you're thinking about intertwining TradFi with crypto and blockchain technology, how much institutional buy-in have you had of your product, of your offerings, of the way in which you want to be servicing?
Sure. So we've done over $15 billion of transactions on blockchains with banks, with institutions. And right now we're in the middle of a transaction with two very large private equity firms where we're issuing an asset-backed security, a AAA-rated asset-backed security native to blockchain. So it won't be on DTC. It'll actually be trading on the blockchain. And this is the beginning of what I think is going to be a systemic trend. I think by the middle of next year, we'll have tens of billions of dollars of native assets on chain and a true marketplace being developed out.
Serial entrepreneur. Nice to have you talking about your latest one and indeed, well, the views towards maybe even a public listing in the next year or so. Mike, great to have you in the show. Thank you very much, Mike Cagney. Of course, we want to thank Shonali Basak as well for that conversation with Figure. Coming up, look, we're going to take the pulse of the world's climate tech investments right now. We're going to be joined by Tom Steyer. His galvanized climate solutions is raising huge amounts of money, funds to help with growth equity, with startups, with trying to find real-world applications in the here and the now for climate tech into larger institutions, maybe into his own real estate. This is, of course, a discussion of cross-asset investment in climate. From New York, not from San Francisco today, Ed Ludlow taking a well-earned break. This is Bloomberg Technology.
I don't think we can replicate Tesla. Tesla is a unique because when they founded and then the personality behind it, the product is beautiful, technologically very, very strong. So in many areas, Tesla is Tesla, but Xpeng is Xpeng. We want to focus on what we think is important for our customers. Our customer like beautifully designed vehicles, either it's large SUV or sports sedan. We believe we have a very, very appealing family look that our customers is really attracted to. They like to have user-friendly features inside the cabin that has a technology feel. It's very smart. It enables them to really utilize the vehicle that's different.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
Welcome back to Bloomberg Technology. I'm Caroline Hyde in New York. Let's check in on what is a pretty volatile end to the week. In fact, we saw the S&P erase its weekly gains. We've seen the NASDAQ off by more than 1.3%. It is triple witching. What does that mean? We've got options expiring. We've got volatility, perhaps a ton more volume on the day than you'd expect on a Friday. We're seeing also a tug of war in the global geopolitical narrative and indeed the chip narrative. Now, after the successful IPO of ARM yesterday, we're still worried about perhaps TSMC reports out there that maybe they're asking some of their key suppliers just to dial back in terms of, well, offering their products. We're seeing the SOX, the semiconductor index, just down by some 2.4%. Bitcoin is off by 0.8% amid this risk-off, risk-averse kind of a world, even though we did see Chinese data, remember, coming in better than had been anticipated at the start of trade. That helped Europe, not so much carrying on into the US. Let's move on and see what's happening on the individual movers, because as I mentioned, it was a very successful IPO in terms of the actual pop they got on the day yesterday, and continuing into today's trade, they were up before trading more than 10%. Now we're up 2.3% for ARM. Looking at Apple, though, just coming off of its highs, it was rising after we saw some strong momentum into the sales of iPhone 15 and indeed the pre-ordering going on. We're now just off 0.5% in line with the rest of the market. We're seeing Adobe being tugged down. Not good enough in terms of, well, they're pointing us forward. The conservative nature of their guidance not living up to expectations. But now let's pivot into the world of where private money is flowing at the moment. And is it tackling climate? Climate tech investments may be dipping actually this year, but Galvanized Climate Solutions still managed to close its first venture and growth equity fund over $1 billion. Let's bring in co-executive chair Tom Steyer for more on how you're going to be deploying this capital. This is about startups, but with real world implications right here, right now, Tom.
Absolutely, Caroline. I mean, the need to solve the climate crisis is an immense tailwind for investment. So these companies can take advantage of an absolute necessity to solve a multitude of problems in terms of the ways we generate and use energy and build huge profitable companies as a result. So that in fact, solving a huge crisis is what capitalism is built for, to serve the needs of society, and that's exactly what we're trying to do.
And how was appetite to want to come and invest behind this at the moment, when we have seen valuations hit, we have seen a pull away from risk-taking, and particularly venture having a tough time of it?
Well, I think that there are a lot of people in the world of professional investing who are just getting educated about the need to invest in climate response. And let me say this, Caroline, in investing, when it's hard to get money and when valuations are coming down, that's a great time to have money. And, so you shouldn't feel bad for us. We think of that as this is a huge generational opportunity in general. And very specifically, this is a good time to have money and to be looking at investments and to be, looking 5 to 10 years out.
What's been so interesting is who you've been working with. You set up with Katie Hall, of course, deeply experienced way in which of managing money and cross-asset perspective. But you've brought on some real experience here when it comes to this particular fund. How are you thinking of intertwining it with Galvanize more broadly? Because you do have a cross-asset perspective. You're not only in venture capital and growth equity, but you're in real estate and you're in public equities.
Absolutely. I mean, Galvanize, the company, is very specifically trying to take a multi-strategy approach and investing behind the need to solve climate in a variety of investment areas. But specifically, this fund, Innovation and Expansion, we were lucky enough to get 3 partners to lead it. Viri Maxwell, Cliff Ryan, and Saloni Multani, who have long professional expertise, great track records, but also great experience and great knowledge about about the climate space specifically. That's very unusual. And as somebody who started a number of investment activities and investment businesses, you really don't have anything unless you have great partners to lead it. So anytime you're talking about a specific investment effort, you have to start with great people, with experience, great track records, and knowledge of the place.
I mean, you speak to your background, having led Farallon Capital Management, the hedge fund owner in San Francisco, but then you pivoted more mission-driven and indeed more political in the way in which you've navigated these waters. I'm interested, when you're thinking about galvanizing a youth voter in this moment, when we're looking at strikes within the UAW, when you're thinking of a president who has to navigate a desire for an auto industry that needs to pivot into a more responsible, climate-focused agenda, but at the same time needs to share profits with its workers. How are you seeing the administration navigate the need for climate solutions too?
Look, I think the Biden administration has done a fantastic job, actually, of trying to address our climate crisis in a sensible and economically sensitive way. And I think that one thing, Caroline, to remember, and the reason really that all of us, Katie, and the three people running this fund and everybody else in Galvanize is doing it, is we believe that we're going to win in the marketplace. We believe this is a generational investment opportunity. And then, in fact, the way that capitalism is going to solve this crisis is by producing cheaper, better, faster, and cleaner solutions. And so when we think about what the Biden administration is doing hand in hand with the private sector, it's really to come up with new technologies, new solutions that are better for consumers, so that it's not a question of asking people to sacrifice. It's a question of asking people to make sensible, smart decisions on their own behalf. That's how it's supposed to work, and that's what we're driving for.
So let's go back to the capitalism and the money being deployed. You've already invested in 11 companies. Now, I know you're not managing this exact fund. You've just talked about the three experienced people that you've got, Very Maxwell, for example. But talk about some of the companies that you are choosing to back and why. Like when I'm looking at the routing company, when I'm looking at Regrow, Pulsora, what are they doing differently?
Look, in every one of these companies, they're coming up with a need to solve an existing problem with a new technology, with progressive new ideas in ways that people are going to spend money and they're going to drive revenue in a way that produces a large company that's going to grow really fast. That's what we're looking for. Early stage companies that can grow and scale. And if you're going to address a global problem, which is our climate crisis, that means by definition, you have to have a significant, important company that's going to be very valuable. So when we look at any one of those 11 companies, we're looking at a huge existing problem that is going to create huge companies. And the question is, can you figure out which ones are the great companies? Can you have them can you be the best partner for them? And can you help them scale and grow in such a way that you create real returns for your investors and have measurable impact? That's what we're trying to do in this fund. That's what those three professionals have a history of doing and a specific long knowledge of this area in terms of how we're going to solve these different problems.
And what about companies that are sizable already in the public sector that maybe you could invest in as you go for public equities too, responding to basically, well, California, where you sit, maybe the EU taking desire for more regulation, but more transparency, but maybe broader, the US being slower than the rest of the EU? How do you see compliance affecting bigger companies going forward?
Well, I think that this has always been, solving this problem has always been a question of a public-private partnership. And if you look at the Inflation Reduction Act, which was passed by the Biden administration last year, and which I think is having a huge impact, that's really a question of saying to people, we're going to give you a carrot to get this done faster. We're going to help you get it done. If you look at what the EU is doing, by and large, they're more going towards policies and rules that insist that you get it done. In each case, what we're really trying to do is accelerate the move to make it possible for people to invest more successfully, move faster and bigger, because the crisis is very much at hand. And last thing I'd like to say, Caroline, is when you look at transparency, when we start to get real information, the old saying is, if you can't measure it, you can't manage it. We're seeing a demand for transparency about who is creating the real emissions. Because once we have that, the managers can solve it. And really, companies can look and say, okay, we absolutely have to get that down. How can we do it? And that's why they're going to look to the kinds of companies we're creating.
Tom, it's great to have some time with you. Tom Steyer, Galvanized Climate Solutions, co-executive chair on the latest funding, $1 billion. Now coming up, we're going to go global, a little bit more even so, because look, let's talk about investments in Latin America. Moto CEO Rubens Zelenelato and Bicycle Capital founder, managing partner Shunyato is going to be joining the program. This is Bloomberg Technology.
Could be that given that we have this productivity enhancing technology that is AI, that has come off the back of this transformative communications network that's the internet, and we have a fundamental shift in the way the energy system is working, so there could be the ingredients of a pivot point of a kind that we've only seen a couple of times previously in history.
But let's ask what the driving forces will be. The world is propelled forward and has been for thousands of years by great power competition. That is the thing that drives innovation right now across the board. It is a competition which is intensifying between two superpowers, the United States and a communist-led superpower. Now, is this starting to sound familiar?
It does.
So what is really significant about this historical moment is that we are in the first inning, the early phase of Cold War II.
Right.
And that is going to drive all the things that we've talked about, and it will not necessarily drive these changes in directions that are benign. The big technological advance of Cold War I was, of course, nuclear weapons. And the arms race with nuclear weapons was an extremely dangerous one that very nearly blew the world up, particularly in 1962 at the time of the Cuban Missile Crisis. Yeah. I don't believe for a minute that we can have a Cold War II without a similar risk.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is going to be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
Today's VC Spotlight moment, and we're going to be talking about Motu. It's a Brazilian motorcycle rental company, but actually more than that. It's last mile delivery marketplace as well. It's just announced a $50 million Series C, co-led by QED investors, and also Bicycle Capital, new venture firm by former SoftBank executive Marcelo Clare, and of course Shunyato. I'm pleased to say that joining us now is Shunyato, as well as Motu CEO Rubens Zelenelato, coming all the way from Brazil, and we thank you very much, gentlemen. Both of you coming in from Miami, Brazil, to talk about the global VC opportunity here, and just paint the picture, Rubens, about exactly what Motu is doing, how it's disrupting, because it's not just a cleaner way of doing motorcycles.
Yeah, actually, the problem we're trying to solve, there is high unemployment in Brazil, in Latin, and people don't have access to credit either. So We are providing them a tool to work by renting motorcycles out to people without any requirements of credit. And we started about 3 years ago. Just 50 bikes. In the first year, we deployed 1,000 motorcycles, and now we are deploying 1,000 every 10 days. Very excited to be here.
You're looking across Brazil, across Mexico. I mean, that must be what drew your attention, the growth. But is it also the opportunity, Shu, here, in terms of it being more about delivery as well and engagement in the population?
Yeah, there are two things that got us really excited. First is the metrics. The numbers always speak for themselves, and Motu has incredible numbers. They're growing over 300%. They're not just gross profit profitable. They're not just EBITDA profitable. They're net income profitable, which is very rare for a startup. And they're very capital efficient. So that caught our attention. But then the opportunity is huge. Brazil is dominated in the motorcycle industry by one company, Honda, that has 70% of the market. And it's ripe for someone to come in and offer something different. So you put those together and you have the chance to create something really big and meaningful. And then you just export that playbook to Mexico and do the same thing.
Do you export it to elsewhere? You've just raised money. Is the idea about geographical reach? Is it more about building up the engineering, the talent? How do you deploy the money?
We are focusing on Brazil and Mexico now. All our growth from the assets comes from debt investors. So the way we were able to build a profitable company with very good economics is a very safe investment for debt investors as well, the capital markets. And the money now is just to bring global talents for the company. We got huge companies like Nubank, Gympass in Brazil that were able to bring top talents, and we want to do the same.
It's interesting that you went for equity financing, but you have taken debt financing in the past. Is that something you analyze and look to?
We are all about doing that. We raised more than $70 million in debt so far. 100% of our capex is done with the capital markets with debt.
Shu, this moment when you're looking at writing these sorts of checks and seeing this sort of growth, how competitive is it? And I mean, there's Tiger Globals on this round as well. There's plenty of other big name VCs, and I'm interested as to what valuations you're currently looking at and how you're talking amongst other venture partners.
Yeah, the growth equity market globally has been in a bit of a coma.
Yeah.
I'd say the patient's toes are twitching. So opportunities are starting to come up, but it's only the ones with really exceptional numbers that are getting people's attention, and those are getting people's attention. We're co-leading this with QED, which is a firm we respect, we've worked with before. The existing investors are all investing. So a company like Motu will never struggle to attract capital. The valuations are much more reasonable, though. So nobody's overreaching when it comes to the number that they want. And I think that's healthy for everybody. It's healthy for the company. The other thing that's different is the time that these deals are taking to get done is slower. And that's also good for everybody. The companies get a chance to have investors really dig in, give them some feedback. Investors get much more comfortable with the companies. So I'd say we're entering a fairly healthy moment in the market, but only the best companies are able to attract capital right now.
And you do your due diligence. You also look at the landscape of Latin America, the countries you know and how to invest in so well. How does that regulatory landscape look for a company such as Motu? How do you look at other players in the space?
Yeah, the nice thing about tech in Latin America, in Brazil, is it's inclusive. The government is very supportive. It doesn't matter if it's the right or the left. The tech opportunity is about bringing more people into the economy. They're so deeply underserved, consumers and businesses both, so deeply underserved. So in the US, we tend to think of technology, AI is the latest boogeyman, as a threat to livelihoods. In Brazil, technology is often a key that unlocks livelihoods. And that's a fundamental difference. And so the governments get very behind that kind of idea. It's what makes tech in emerging markets so attractive. It's inclusive, it's not disruptive. And that tailwind helps all kinds of companies, especially like Motu, that are so obviously bringing opportunity to people.
Rubens, what you've done is you're saying you're able to provide these motorcycles, this way of making money to do deliveries to people who have either bad credit, no credit, but you must be using technology to understand what the risks are there. How have you managed to build out a credit company, an insurance company, a maintenance company out of basically a motorcycle company?
Basically, we know that we need to be the best option for people every day. So we use technology in everything and to do a no-touch experience. And our team also have this frugality mentality to do more with less. So this is where how we were able to build such a good economics net income company in these 3 years. I believe that very few companies got to really net profit company. And We are all about serving people, and if we need to help them, we need to do a product that's cheap and better than they have their own motorcycles.
Many would think Brazil, political instability at times, economic instability at times. How do you push away from that narrative? How do you ensure that big, great, successful businesses can be built out in emerging markets in Latin America?
We are really a social business. We are pushing to help people and be a way of Latam to make a better place to people thrive and people have an opportunity to work. And doesn't matter who is the government in place, we are there to be part of the good.
Shu, you and Marcelo have really shone a light on Latin America. That's what Bicycle Ventures is all about, and the idea that people aren't seeing the opportunities. But are people seeing them more when you're having QED alongside you, when you're seeing repeat investors in the space? Is that starting to grow in consensus?
Not really. QED are unique. They've been in Latin America on the ground for quite a while, which is unusual for a global firm. We respect them for doing that. They have people in Sao Paulo, people in Mexico City. So they see what we see, which is markets that are ignored by global capital markets. They're side notes compared to the US and China, maybe even Europe, but the opportunity is much bigger than the capital available. So our fundamental view is there's just a dislocation in the market. People don't have the appetite or the patience to look past the headlines that you just called out, political instability, crime, inflation, and see the opportunities beneath. But if you look, there are great opportunities. So Nubank is the latest stunning example, probably the most valuable digital bank in the world, $40 billion market cap. There are many other companies coming that'll go public in the next couple of years that'll keep proving that Latin America can create a lot of equity value. And we like the situation where people are not paying as much attention because it's better for us.
Mm-hmm. When you're doing your due diligence. It's great to have some time with you. Motu, of course, CEO Rubens Zanalato, who I say flying out for this, and we appreciate it very much.
Just for that.
Back to, yeah. Lovely to have you over here to fly back to Brazil. And Shuniata, as always, flying in from Miami. We really appreciate it. Meanwhile, coming up, look, initial talks for the sale of Disney's ABC are heating up. We'll have all the details next. This is Bloomberg Technology.
Have you thought maybe I should go do something else? I can't do anything better than I'm already doing. I already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
On the next episode of Hello World, meet the women driving Kyrgyzstan's tech revolution.
This is the first satellite in our country.
And some speedy horses. Watch Hello World Thursdays at 8 p.m. Eastern on Bloomberg Originals or 10 p.m. Eastern on Bloomberg TV.
Slice through the noise
Forget the noise. Ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal. Now, more to the point.
What is the lesson or the observation?
Here is what has been going viral. Disney holding initial talks, we understand, about selling its ABC network and TV stations to local broadcaster Nexstar. That's according to sources. But then media mogul Byron Allen, who owns a string of TV outlets, Weather Channel as well, also has discussions with Disney, we understand, about acquisition of the network and its stations. It's all according to sources familiar with the matter. Let's get more familiar with it, because Disney is saying in a statement that the company still has made no decision with respect to the divestiture of ABC or any other property. Nexstar, meanwhile, declined to comment. Let's bring in Chris Palmieri, who's been really managing to cut through what feels like sometimes noise in the media industry, but the noise had always been for a little while that maybe this would be an asset for Disney to dispose of.
Right. Well, if you remember, this started in July when Bob Iger said that, maybe these traditional channels were no longer core to the business. And that set off a frenzy of people looking at the assets who might be interested. And I think that the fact that there hadn't been any progress really since then got people thinking, well, maybe we can start a fire here. If you read the public comments that Nexstar executives have given, they said, hey, we're interested, Disney, but, what's the real terms here? Because there are a lot of complications with buying a network like ABC. For example, how do you handle the sports that ESPN sometimes simulcasts on ABC, or all the shows that presumably Disney would still own that air on the networks? So there's a lot of questions, but I think we're starting to see people starting to raise their hand and say, yes, I might be interested in this, and it puts a little pressure on Bob Iger to do something.
What about at this moment when he's also trying to navigate strikes, writers' strikes, actors' strikes? How is that sort of conversation progressing?
Well, again, it's part of this situation in media today where everyone knows it's shifting towards streaming, but the streaming business isn't profitable, and there are issues with labor. There's issues with how do you produce the content, and the traditional TV networks are losing viewers, and so that's a long-term drag on the business. So do you keep them because they're making money now and you can sort of run shows across the different platforms, or do you sell and cash out? And that's what Disney management and lots of other managements are wrestling in the media business with right now.
We'll see how those conversations progress next week. Chris Palmieri, we thank you. Meanwhile, that does it for this edition of Bloomberg Technology. Don't forget about our podcast. This is Bloomberg Technology. See you soon.
Is crucially important, and I think we've moved from this attitude from it's an indulgence, a waste of time, almost an illness that needs a cure.
For something as universally important to human life as sleep, mysteries surrounding its necessity and utility have only just been recently uncovered.
Some of our biggest discoveries were in the 1970s or 1980s, and so it makes it a really exciting field because it seems as though we're uncovering new insights each and every day.
Some scientists are going further to find out how sleep and what happens there can be harnessed to further expand our understanding.
It's easy to memorize things. That makes you smart if you can spit back a lot of facts. But if you want to be wise, if you really want wisdom, you got to know when and how and why to use that information. And that's what your brain figures out while you're sleeping.
offer skincare for men in their 70s that have a lot of wrinkles. I mean, is there any way to get rid of the wrinkles?
I have a lot of amazing things,
Really?
but maybe it'll be a little bit beyond skincare.
Wall Street is waking up. Europe is already trading. And starting Monday, Manus Cranny and Danny Berger will make sure you have the news, data, and analysis you need to set your agenda. Micro, macro, and everything in between. Manus in New York and Danny in London follow the money around the globe. Take a daily deep dive into risk and help you make informed decisions for your trading day. Watch Bloomberg Brief, weekdays at 5 a.m. Eastern, premiering Monday, only on Bloomberg.
A big catalyst next week for markets when the Federal Reserve's FOMC meets on Tuesday for that two-day meeting. A big decision on Wednesday, followed by the press conference. And, of course, coming among rate decisions from the Bank of England as well as the Bank of Japan. Our own international economics and policy correspondent here at Bloomberg, Michael McKee, joining us right now to talk a little bit more about this. And, Mike, let's talk about the setup going into this. The setup, of course, about inflation. We got some inflation reports this week. And while there was some concern about a reacceleration in certain pockets, overall, we're still trending in the right direction.
Overall, all of the banks are trending in the right direction, although you have to break it down by individual bank. In the U.S., we saw the consumer price index come in hot on the headline number because of energy prices, but the core dropped, and that is good news for the Fed. But they still have to decide whether they have done enough to keep inflation falling. And that'll be the question for them on Wednesday. For the Bank of England and the Bank of Japan, the questions are similar in that the Bank of England has a real inflation problem, which you can see on the screen. They just probably, the betting is they're going to have to do more.
I love this chart, too, because it really just sort of illustrates, I think.
Well, the great part is the blue line there is Japan. And they finally have inflation above their target, which is where they want to be. So now they're beginning to talk about the possibility of doing some tightening. And when you look at the odds that our WIRP function produces, nobody thinks the Fed will do anything. They do think the Brits will raise rates, but now there's like a 22% chance that the Japanese will do something that will push rates up.
It's partially because Ueda spoke, right? He told Yomiuri that there might be some kind of light at the end of the year, let's say, on yield curve control or something like that, and he's not, dismissing negative rates entirely. But the Bank of Japan is the one that thinks that inflation is too low, right? The underlying part is not good enough.
Yeah, it has really changed. Their story is starting to change now, and that's what they've been hoping for years and years and years. So the question for them is, can they keep inflation kind of where it is? Or does it get out of control? And so they should start raising rates again, doing something to tighten credit.
All right, Michael McKee, our Bloomberg International Economics correspondent. We're going to let him go early because he's going to have a very busy week next week here, of course, as we head into a consequential Fed meeting. Before we continue our coverage here on The Close, we do want to take a moment to look back. Back on September 12th, we had a segment about Smurfit Kappa's purchase of WestRock. A Bloomberg reporter said that the Smurfit family wanted to take money off the table through that deal. We now know that that statement was incorrect, and we apologize to Smurfit WestRock, and we regret the error. Fani?
Well, coming up, we'll hear from our interview with GM CEO Mary Barra, her take on the UAW walkout, and what could happen next. This is Bloomberg.
thought maybe I should go do something else? I can't do anything better than I'm already doing. I already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
Let's turn now to the strike by the United Auto Workers Union against Detroit's big three car makers. Earlier today, Bloomberg's David Weston asked GM CEO Mary Barra for her reaction to the walkout.
I'm extremely disappointed and frustrated that we're even on a strike. We didn't need to get here. General Motors has an exceptionally strong offer on the table. It's historic. It's the largest increase from a wages perspective in our 115-year history, along with world-class health care benefits and many other provisions, job security, et cetera, and a COLA adjustment. So when you look at the strength of the agreement we have on the table, we really don't need to be here. Yes, they have one plant down right now, and it'll impact three very important products. Two brand new, our Chevrolet Colorado and our GMC Canyon, both mid-size pickups that are in strong demand, as well as our Chevrolet cargo van that does exceptionally well in the market. So this is having an impact, and we'll have to see where they go next. I will say we're ready for this. As we've dealt with COVID and dealt with the semiconductor shortage, as well as other supply chain challenges that have continued to persist from COVID, our team knows how to manage these situations. They're staying agile, and we're going to do what's right for the company. We're going to make sure everyone stays safe. But this is a strike that didn't need to happen.
Mary, as you say, you've made an offer already for a rather substantial increase in wages. It's not what the UAW wants. Implicitly, you've agreed that they do need and deserve some increase in wages. But is this about more than that? Is this existential in a sense for the auto companies in terms of your need to move into electric vehicles, and from the UAW's point of view, that they believe that, in fact, moving to EVs will actually cut the workforce by as much as 40%?
Well, you're absolutely right. This is a once-in-a-century transformation we're in the middle of moving from internal combustion engine vehicles to electric vehicles. And at GM, we're at a very pivotal point because we have so many electric vehicles ready to launch, in the process of launching. And this is important to securing all of our futures. We need to get these vehicles out. They're wonderful vehicles. We've got waiting lists for most of them, or orders already in place. So it's important that we meet that demand. And one thing from a General Motors perspective, from job security, we have jobs for all of our people as we make this transformation. More than 2 years ago, we started planning for this. And one of the reasons General Motors invested in doing our own power units, which is a component that's very important on an electric vehicle, we designed them internally, and we are now allocating that production to the plants that build internal combustion vehicle engines right now. So we have worked very carefully to have a job for everyone so we can make this transformation together.
And that was the CEO of General Motors, Mary Barra, speaking a little bit earlier today about the strike. Let's continue this conversation right now about the potential impact here on the automakers. David Weston joining us right now, U.S. Autos equity analyst over at Morningstar Research. And David, we talk about the idea of how long this strike could go on, and more importantly, how long these automakers can, I guess, muddle along without a full production capacity, if you will, here. But I'm taking a look at balance sheets here, and you're talking, $25 billion or so sitting on the balance sheet of GM in cash, something similar for Ford, and I believe Stellantis is something like double that. How far does that get them?
Yeah, that's a really important point here, because I think, generally speaking, when there's a strike, personally, it seems like labor ultimately has the upper hand, but what I don't think people realize who aren't following the industry, this negotiation is incredibly different. This is not just about wages or just about a plant that's being closed. There's so many issues because the union basically wants to go back to how things used to be in the glory days when GM had as much as 50% market share or 29% market share at the start of this century. So when you look at the liquidity, I only cover for GM and Ford, so I'll just speak to those. I know Stellantis disclosed, I think, something like 63.9 billion in industrial liquidity at June 30 in euros. But on the GM and Ford side, they have ample cash, around 25 billion for GM, and total liquidity of around 39 billion. And then Ford has over 51 billion in total automotive liquidity as of June 30. So what I think will happen if this strike goes on a long time, the automakers will have to take on more debt, which they can do through their credit lines, and this is assuming they don't even issue any other bonds or anything. And that's you get obviously a little bit. That's one thing. A lot of debt starts to really hurt the stock prices, but we just don't know how far this is going to go. But it looks like I think the automakers could outlast the union.
Well, that seems to be, and you see that kind of reflected in some of the stock prices today with most of the automakers and auto suppliers, for that matter, higher on the day here, David. I am curious with regards to Ford and GM specifically and their ability to continue selling new cars. What does it look like right now in terms of the inventory that they have available to sell? And I guess how much time would have to elapse before there basically would be nothing material on the lots?
Yeah, so there's a lot of layers to that question because right now we're only talking about, in GM's case, for example, we're only talking about an assembly plant shutdown, and it's primarily a mid-sized pickup truck plant in Wentzville, Missouri. Where you can get this to hurt a lot is if you start hitting powertrain plants and stamping plants. GM's Romulus powertrain plant, for example, it supplies V6 engines, 10-speed transmissions to 5 plants in North America, 4 of which are in the United States. So from the UAW's perspective, it would be more efficient to actually shut down the powertrain plants because then you can, in turn, shut down assembly plants without calling the assembly plant workers on strike, which preserves your strike fund. And that math is something the union's not acknowledging to their members publicly in the videos they're doing. There were a lot of upset members in the comments online on Wednesday night. Why aren't we striking everything at once? And the union President Fain is saying, well, it's to maintain flexibility and to keep the automakers guessing. Yeah, that's true. But the real reason is it's very risky to do that because depending whether or not the union pays health care, it's 6 to 11 weeks is what the strike fund would last if you struck everything, all 3 at once.
Right, and you're estimating about $500 a week per worker from that strike fund, David, and that's not sure whether healthcare is involved or not. What happens if the strike fund runs out?
Well, that's a very good question. I mean, can the union get more money? I don't know. I'd have to plan on, even if they could, it wouldn't be a lot. And then I don't think the union wants the strike fund to go to zero. The union is more than just the auto workers. The auto workers are the biggest piece. There are 146,000 of a nearly 400,000 strong union, but they have other members who are on strike right now. About 1,000 workers at Blue Cross Michigan, for example, or at West Rock. There's a few hundred workers on strike. So you can't have the strike fund go to zero because you've got other strikes going on too. And then once it does go, even if you get a little bit back, you're not going to get something probably close to the 825 million roughly that it is now.
Yeah, it's going to be interesting to see how this plays out. Maybe at some point these two sides do actually come to the table. David, great stuff here. David Whiston, a U.S. Autos equity analyst over at Morningstar Research. And Bonnie, I think everybody right now is trying to put a price here on what this could mean in terms of the cost, whether it's to the workers themselves and lost wages, whether it's to the automakers, and also to the economy.
Yes, exactly. And we're seeing more power with the labor movement, but for how long does this last, Romain? I mean, take a look at California right now, and we have the franchise model workers also deciding that, they deserve to be paid a little bit more, and franchisors and franchisees need to be treated differently.
And it's interesting, too, because we talk about what's going on, Cal. Some of that, of course, is being spurred by the government there itself, the state government sort of pushing for higher minimum wages for fast food workers and others here. But this came out of this is an outgrowth of a strong labor market, right? And we know that labor market might be starting to soften. So how much leverage do these unions still have in this environment?
Exactly. And when you think about it, franchises are around the country, right? So if you're talking about a McDonald's or a Yum Brands, do you have, a $20 minimum wage eventually in California, but then much less than that in New York? And how does that all work? How does it change where franchisors open franchises?
Yeah, absolutely. Certainly a bit of an inflection point when it comes to the labor market and what people pay and, more importantly, what they demand. Kicking you off to the close here on this Friday afternoon, Romaine Bostic alongside Bonnie Quinn. A look at the equity market still camped out around session lows. We'll be back in a moment. This is Bloomberg.
Is crucially important, and I think we've moved from this attitude from it's an indulgence, a waste of time, almost an illness that needs a cure.
For something as universally important to human life as sleep, mysteries surrounding its necessity and utility have only just been recently uncovered.
Some of our biggest discoveries were in the 1970s or 1980s, and so it makes it a really exciting field because it seems as though we're uncovering new insights each and every day.
Some scientists are going further to find out how sleep and what happens there can be harnessed to further expand our understanding.
It's easy to memorize things. That makes you smart if you can spit back a lot of facts. But if you want to be wise, if you really want wisdom, you got to know when and how and why to use that information. And that's what your brain figures out while you're sleeping.
The names that move markets are on Bloomberg.
There's a complete change in the labor market. There's a complete change in the energy future that we are facing.
Under tightening would be a worse mistake than over tightening because we can course correct that.
The question is whether we need to increase the pressure or just keep pushing.
We've been getting good news. We just have to keep getting good news.
Nobody covers business like Bloomberg, your global. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
That's a question I get all night.
Bloomberg, top experts, great questions.
This is the countdown to the close. A look at the broader market with equities at session lows here on this Friday afternoon. Meanwhile, a lot of activity in the commodity space. Abigail Doolittle, she's standing by right now with our commodities close.
There certainly is a lot of action in the commodity space. Unlike stocks, not down quite as much, down, but down modestly. But here are some of the more interesting mixed moves within the commodity space. European natural gas getting a bid up 2.7%. Of course, the LNG strikes continue in Australia. Natural gas here in the U.S., though, it's down a little bit. We've seen this kind of divergence a lot recently based on those strikes. Other factors, supply and weather. Speaking of weather, we do have orange juice hitting a new record high today. I believe some of the recent storms hitting both Florida and California at play there in terms of the recent spike. And then wheat, a rare up day for wheat, up 1.7%. Apparently dry weather is causing some traders to think that wheat supplies could be constrained. But the big commodity this week, of course, is oil. Let's take a look at oil back above $90 per barrel. The first time that we have seen that going all the way back to June of 2022 over this time period. My gosh, what a round trip. But over the last few months, up and away for oil. And it won't be surprising, Romaine, if we soon see oil over this time period higher as opposed to slightly lower.
Yeah, a momentous week here for crude oil as it now back to those November highs. Also a momentous week for the IPO market. We, of course, had the biggest IPO of the year so far, ARM coming to the market. And now everyone's looking to what comes next. Instacart said to be raising the price range for its initial public offering, and it's now seeking to raise as much as $660 million at a target of $28 to $30 a share. That new issue could actually come to market as soon as next Tuesday. Bloomberg's Ryan Gould joining us right now to talk a little bit more about that. And Ryan, I guess the big question people want to know off the bat is how much does the success of the ARM IPO maybe feed into the potential success for an Instacart IPO?
Yeah, Romain, it's been quite the week. People are saying that ARM has been a shot in the arm for the rest of the IPO market at large. There are quite a few people who are looking on, thinking about this week as, are the floodgates opening? I would caution and say that maybe not quite yet. We are looking to be sort of constructive through the end of this year at least, and then maybe by the first quarter of next year, we could be in a position where we're seeing, quite a few marquee names come and think about, testing the waters if they're not already. But as far as this week has gone, I don't think ARM could have got off to a better start. It closed yesterday at 25% higher than it opened, and I mean, people are looking on and thinking, well, is it, isn't it? And maybe we're sort of on the better side of things for that. So yeah, I mean, Instacart. Sorry.
Well, I was just going to say Instacart is such a totally different company to ARM. Is it wise, just having seen the evidence of the ARM IPO, to now increase, what Instacart is looking for? It's something like a 7% increase. It's quite large, Ryan.
It is, but I think, people said at the beginning when Instacart went out and said its range last week that, it was always attractively priced. It looked fairly, nice on paper. I think when they put it out initially, they were being pretty conservative. So now, they've obviously seen what's happened yesterday and said, okay, well, we're not going to bite off too much more than we can chew, but we do think there's probably a little more room for us to, adjust things. So, that $2 hike in the initial range is enough, probably. Again, in a market where there is still so much price sensitivity, particularly around valuation, Instacart is probably, still being pretty conservative on this. I wouldn't be surprised next week to think about when we get to trading on Tuesday, bearing in mind this is pricing on Monday, that we'll see another good a good pop, so they might hope at least.
So what comes after this, Ryan? We've heard a lot of chatter about other companies that might come to market, like Birkenstock, like Klaviyo.
Yeah, so Klaviyo is already out there. They had set a range. They're working pretty much the same schedule as Instacart. Klaviyo is set to price on Tuesday to trade Wednesday. So in the early part of next week, we'll look pretty busy for down at the exchanges. Beyond Klaviyo, I mean, Klaviyo itself is a very different business to Instacart, but beyond Klaviyo, we obviously have Birkenstock, the marquee name in German footwear. Probably, a lot of us might have worn them. People are looking forward to that as, again, another big household name coming to, the US exchanges. Looking a bit further on towards the end of this month, we've got VNG, which is a Vietnamese internet company that we expect to file. And then, of course, there are some more sort of going into that maybe might creep out before Thanksgiving.
Ryan, thank you. We'll be looking to your reporting on all of those. That is Bloomberg's Ryan Gould, and thanks for that. And Romain, it's interesting because even with this price boost, Instacart is still valued at about 25% less than it was about 2 years ago.
Yeah, and I mean, it's a pretty big drop, but this was kind of necessary, right? We talk about this idea that you need an exit strategy, and even if that exit strategy means some pain here with regards to the down round, then I guess you have to take it. The question, though, is how much activity is there going to be in the secondary market for it once it comes to market?
Exactly, and if you actually look at ARM's trading today, was really fascinating. At one point, it was up 5%, and now it's down 2%, so it's been like a 7% swing for ARM itself today. So still sort of a little bit of price discovery going on. Yeah,
I mean, we should point out ARM too. I mean, that float they have is it's tiny too. So you're going to have some big swings here because they only really sold a small portion of the company.
Exactly, exactly. Can't wait for Birkenstock and Instacart and Klaviyo. We'll see if this is just symptomatic of the wider capital markets or particular to these companies, this price action. Well, still ahead, we'll dig deeper into ARM with the biggest debut of the year, obviously. We'll talk to one of the analysts that started coverage of the stock next. This is Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
Slice through the noise. Forget the noise. Ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal.
Now, more to the point, what is the lesson or the observation?
Most of the large Chinese technology companies, let's say Alibaba, Baidu, Tencent, they have gigantic market values and they're very prominent in China, not as prominent outside of China as obviously in China, and certainly not that prominent in the United States. TikTok, by contrast, is not in China, but it's gigantic outside of China, the United States, and everywhere. What did TikTok do that enabled a Chinese-based company, parent company at least, to do so well outside of China?
We think it's challenging to build a global company in general, but the best ones we have seen so far are ones that take very consistent global learnings and adapt them to the local countries that they are operating in. So you need to be global and local at the same time.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority. The markets countdown in Europe from the financial centers of the world. Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
All right, let's get a view from the sell side with our top calls, the big movers on the back of analyst recommendations. And we start with Unity Software, the maker of graphic tools for video games, causing some controversy among developers with the announcement of a new fee for games using its platforms. The developers, they hate it, but investors and analysts, they actually like it. Bank of America upgrading the stock to buy because of what it says is the improvement in monetization. Those shares up fractionally on the day. Next, let's take a look at Cava, the Mediterranean restaurant that went public back in June. Loop Capital starting coverage with a hold rating and a street low price target of about $40 a share. Now, while the analyst says he loves Cava's investment story and comp sales growth, he's not a big fan of the stock's valuation, arguing that Cava's positive attributes are already priced into the shares. Those shares down 2.5 on the day. And finally, the talk of the NASDAQ, ARM. Needham launching coverage of the chip designer with a hold rating. The analyst says that the world is entering a post-smartphone era, which was highly attributable to ARM's past success. And while the company can grow beyond that, it might not be enough to support upside from its IPO valuation. Those shares on the back foot today after yesterday's 20% plus gain, and those are some of our top calls. We do want to stay in the sell side space and in the ARM space, and well, with that call that we just gave you. Charles Shi joining us right now. He is Needham's senior analyst covering the semiconductor industry and has that hold rating on ARM. And Charles, let's start off here with the valuations. I mean, we knew the valuation was going to probably be, at least in the eyes of investors, more comparable with an NVIDIA, more comparable, I guess, with some of the more sizzling AI names. But you're saying it should be valued maybe more along the lines of a Cadence or a Synopsys.
Yes, that's correct. I think the whole idea about ARM, NVIDIA being a COM to ARM is kind of is a misperception about where ARM actually sits in the semiconductor supply chain. NVIDIA is a hardware company, and ARM, they actually provide the IP, which is actually the easiest way to understand. There's a bunch of software codes. So they actually sit at the same place as Cadence Design Systems and Synopsys, which happen to be number 2 and number 3 in the IP space for semiconductors. ARM is number 1.
But when you listen, but I am curious. I mean, when you listen to what executives have said, at least publicly, particularly with the interviews we had yesterday with the CEO, the discussion about artificial intelligence, how integral that is to their growth plans here. Do you not buy into that?
Well, I think technically they are part of the semiconductor industry. AI is going to be a very important driver for the next phase of the semiconductor growth. I think you already mentioned smartphone probably drove the semiconductor growth over the past decade or so. Going forward, it has to be coming from AI, high-performance computing space. They are playing a role there, but what I'm trying to argue here is what we are seeing is more like NVIDIA type GPU AI accelerators that's driving that next phase of growth. ARM is in the CPU space, more importantly, mostly in the smartphone space. That's not the same generative AI demand we are talking about today as it relates to NVIDIA. So what I'm trying to say is, yes, AI demand will eventually, that will trickle down to ARM, but it's probably not coming at the rate this kind of valuation is justifying. So I think investors probably need to be a little bit more patient when it comes to how AI is going to drive ARM's growth in the next 1, 2, 3 years.
So, Charles, what it will depend on then for growth is increasing royalty rates. How much room does it have to increase royalty rates on, say, Qualcomm?
Yeah, that's an excellent question here. It's actually one of the key things we kind of want to be a little bit cautious on some of the outlook people are envisioning to justify the current valuation. We know that the units of smartphones, that's the biggest source of the royalty revenue, is not going to have a very strong double-digit growth. Smartphones already reaching the saturation. I would argue actually probably 5 years ago, we are already at that saturation point. So the lever they can pull is royalty rates. But the royalty rate, where they are at, roughly 2 to 2.5%, is already where I think it's probably closer to the ceiling than to the floor. What that means is you already see the dispute between Qualcomm and ARM. I'm not getting into the details, but I think it boils down to the royalty rates.
All right, Charles, great stuff here. We got to get you back on maybe in a few weeks' time when we have a little bit more investor reaction to the latest issue here. Charles Shi over at Needham, starting coverage on ARM with a hold rating and a street low price target of $40 a share. Meanwhile, we go back to one of the other big stories of the day, and that is the strike by the United Auto Workers Union here in the U.S. against the 3 major automakers. And we're now learning, Bonnie, in just the last few minutes that the UAW president is saying that he expects to be back at the bargaining table tomorrow.
Well, you have to wonder if this hasn't got something to do with President Biden speaking earlier and saying the negotiations had broken down, because Fain is disputing this and saying, no, negotiations didn't break down. But what the president did do was give them some support and suggest to the big 3 that perhaps if they were making record profits, that there should be a record contract.
Yeah, walking a fine line here, of course, between trying to get what he thinks he is due, at the same time trying to appease a very diverse worker base that he has to represent there. We're going to pivot from that story to the other big story that we learned this week, and that's about the potential sale of Disney's ABC assets. We're already learning that media mogul Byron Allen is set to offer $10 billion to buy those assets, and learning that there are some other potential buyers lining up as well. We're going to check in with Chris Palmieri out in Los Angeles after the break. This is Bloomberg.
I don't think we can replicate Tesla. Tesla is a unique because when they found it, and then the personality behind it, The product is beautiful, technologically very, very strong. So in many areas, Tesla is Tesla. But Xpeng is Xpeng. We want to focus on what we think is important for our customers. Our customer like beautifully designed vehicles, either it's large SUV or sports sedan. We believe we have a very, very appealing family look that our customers is really attracted to. They like to have user-friendly features inside the cabin that has a technology feel. It's very smart. It enables them to really utilize the vehicle that's different.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Well, Disney is said to have held initial talks to sell its ABC network and other stations. The company writing in a statement, quote, "While we're open to considering a variety of strategic options, at this time we have made no decision with respect to ABC or any other property." Joining us now is Tim Nolan, who's Senior Media Tech Analyst over at Macquarie. Tim, thanks so much for joining us. So Disney obviously saying it's going to drum up interest. It's been saying that for some time. Bloomberg Intelligence is calculating that its TV portfolio might be worth between $19 and $23 billion. But ABC is only a little part of that. Does Disney need ABC when it comes, for example, to its next carriage negotiations?
Yes, this is a very interesting question because, the value of Disney's TV assets has been in the bundle to date. And now as the bundle is shifting toward more streaming options and including streaming bundles, as we saw with the Charter deal, which got done earlier this week, that's streaming plus linear. The question becomes, where does Disney really want to go with its TV assets? We know that ESPN is a very valuable asset within Disney, and they've made a number of signals that they intend to keep it and put it completely over the top and into a streaming standalone service. So that raises a few questions about ABC. One of the values of ESPN, obviously ESPN is about sports. One of its most important properties is the NBA, and the NBA finals are on the ABC network. So you have to wonder how this will play in, for example, to the value of the sports rights and what Disney's willing to pay for over time. You also have to wonder what the value is of ABC for Hulu, because as we know, Disney is quite likely to buy the 1/3 stake from Charter that Charter owns in Hulu in fairly short order. And so what will the content on Hulu be? And if Disney sells ABC, then what happens to the content on Hulu? There's a lot of questions around all of this. $10 billion is an interesting price. The value of the linear networks is certainly higher than that with ESPN, but it's a very confusing landscape given the linear shift towards streaming.
It really is, and you calculate that the ABC broadcast network and stations may have generated, less than $600 million in EBITDA in 2022. So what is a good valuation for ABC? How much should somebody pay for that asset? And is it big enough of an offset for Disney to actually move the needle for Disney?
Again, difficult question to answer. I don't have a specific valuation for the ABC network or stations. It's the national network, and Disney owns, I believe it's 8 stations, ABC affiliate stations around the country. The value of the linear network business, which includes ESPN, includes some Disney cable channels, includes a lot of international channels, we think is at least $50 billion. Could be quite a bit higher depending how you split out ESPN, and we'll get a split out of ESPN from Disney quite soon. So ABC would be a component of that 50. ESPN would be the majority. So that's why I say $10 billion is an interesting number. I don't know if it's the right number. I don't know if it's a bit higher, a bit lower than that, but it's sort of in that right ballpark.
Tim, there's a broader question here, I think, about the strategy that Iger has taken, or maybe some folks out there, investors, are trying to force his hand on this. But the whole sort of conglomerate nature of what Disney became and that sort of template, is that kind of over? I mean, is there not value in maybe having an underperforming division like the linear television network, but still finding value as it complements some of the other areas of the business?
Yeah, definitely. I mean, the trends in linear TV may very well be negative, maybe permanently negative on the subscription side in linear. The affiliate fees, the retrans fees that ABC gets. Advertising, could be positive, but let's call it zero growth business. But it still is a decent, margin business. It still generates cash, which is funding the transition to the streaming world. And as we just saw with the Charter deal that got closed, just earlier this week, that is a combined linear and streaming deal, and it's kind of a stepping stone toward a more completely streaming future. So we're still very much in the middle of that transition now. That Charter deal did accelerate that, did push it 10 yards further down the field, let's say. But it's a very open question. It's been about bundling thus far. Separating out ABC from the other Disney networks is questionable. And remember, ABC is a broadcast network. What a lot of people forget is you can get ABC for free. You can get CBS, Fox, NBC, and ABC for free if you have a broadcast antenna. So if you figure in the number of potential households that ABC broadcast network can reach, it's practically 100% of U.S. households. That's why there is value in it. The local news in the stations is valuable, and that maximum household reach for sports distribution is still valuable.
So this gets into the idea here then. Where do you see Disney going? I know Iger has tried to articulate the strategy to a certain extent, but there's so many parts. When we talk about the dispute with Charter, the dispute over the ESPN and the carriage fees there, obviously now the potential sale of ABC here, and then he's rolled back a lot of initiatives that Chapek made with regards to the parks business here. What is he trying to create? Is it just a leaner company?
A leaner company would be nice, but I'm sure it's not just for the sake of being a leaner company. Clearly, streaming is the present and very much more so the future. And Bob Iger has made quite clear, I think even more so in recent weeks and months, that there is a streaming future for ESPN. He said in so many words, it's a question of when, not if. So a completely streaming ESPN over-the-top service, in a way it's a compliment to, what could be a very completely over-the-top Disney Plus service. I mean, This is why some of the longer tail networks, Disney Junior and I forgot which other ones, have fallen off of the new Charter offering, because so much of that content and so much other exclusive content is available on Disney Plus, and you can now get that as a Charter TV Select subscriber. So we're moving very much toward a streaming future. It's been kind of trying to enact a transition and try to protect the old while building for the new. We're getting closer to a breaking point. We're not there yet. ESPN going completely over the top will be a much bigger breaking point. Maybe that's a year or two or three away, but it is definitely coming. Streaming is the future.
All right, Tim, great stuff. Tim Nolan, Senior Media Tech Analyst over at Macquarie. Let's go out to Los Angeles right now, where Chris Palmieri is standing by right now in our bureau. A big focus right now on Iger, but I think everyone really got a lot of attention when we had the breaking news yesterday that Byron Allen and his media company is apparently willing to pony up $10 billion for these assets.
Yeah, I mean, Byron Allen, look, you got to hand to the guy, former stand-up comedian who's become a media mogul, owns a Weather Channel, a couple of dozen TV channels across the country, local stations. It'll be a big lift to get to this $10 billion number that we reported. He'll have to bring in a lot of big banks and private equity partners. His track record is not 100% in terms of being able to close some of the deals that he's bid on in recent years. But it really does highlight some of the value potentially in Disney, and maybe lights a fire under CEO Bob Iger to do something.
Yeah, and it's interesting. Do you think we're going to hear other potential bidders step forward, Chris?
Absolutely, yeah. I don't think you can, when you see a number like that and you see the response from Disney that we're still considering it. I think a lot of people are now excited.
All right, Chris Palmieri out there in Los Angeles. And we should point out we did reach out to Byron Allen and his company here for comment, at least right now. Not really willing to speak publicly about this. But this is a huge, I'm interested in this too because it also shows you the divergence in terms of how people view this type of asset, right? If Iger doesn't see value in it, but then someone else willing to pay $10 billion for whatever reason thinks that he might see value in it.
It's fascinating. And also, where did it come up with the $10 billion, as we heard from the Quarry analyst earlier on, Tim Nunn, you know, and does that include the games, the Monday Night Football games? Does it not?
A lot of questions here, and something I think we're going to be talking about a lot, Vani, here. 1 hour in the tank here on this Friday afternoon. Stick with us. Full coverage coming up here as we round out into the final hour of trading.
I know one of the reasons you're here in Marrakesh and in Africa because you see the enormous potential this continent has as a source of renewable power for electrolysis, right? That's the process by which hydrogen is extracted from water. Tell us about Africa's potential.
Africa's potential is the best in the world, and it's Africa's shot now. It's Africa's turn. What will stop Africa rightfully taking its turn will be lack of progress on technology. Companies and governments around the world choose Fortescue because we are the world leaders in technology, world leaders in next era electrolyzer design, cables, solar, all the tech which is moving our world on from having to rely on dinosaur era fossil deposits of oil, coal and gas to simply today's era of machines which make machines to harness all that beautiful renewable energy and give all the mobile energy, all the fixed energy this world could ever need by many times. Those countries who resist that are denying Africa their opportunity. And I'm saying, stop it. Let's get in behind Africa.
From New York City,
in London, in Sydney,
from Washington,
in Tokyo,
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
Almost 3 p.m. here in New York. This is the countdown to the close. Let's get you a view from the top here. Romaine Bostic alongside Vonnie Quint, the final trading day of the week. And it looks like we're actually wiping out almost all of the gains that we were trying to cling to a little bit earlier here. A big downdraft here right now in the equity market.
It's, as you said earlier, triple witching as well, so that's making some kind of a difference. Also, of course, it had been anemic trading all week, but we do have another hour left, so we'll see if we can make some of those gains good before we get to the closing bell.
Yeah, absolutely here. And of course, the volume will pick up as we get closer to those closing bells because of the options expirations. But right now, you're looking at stocks pretty much around the lows of the day with the NASDAQ 100 down almost 2% here right now. Remember, we came into this week, Vonnie, there was a lot of talk here about all these different moving averages and whether we were going to break to the upside or downside. And then ARM was supposed to be that catalyst. It had a great day yesterday, not doing much today.
Up 25%. Although I will say, just after the open today, we saw it spike up 5-6% again. And, you know, it took a little while for it to turn negative, but indeed it has turned negative, as have most of the stocks in the NASDAQ. Not so much the S&P 500. We still have about 100 stocks positive there.
Your 2-year yield still camped out about above 5% here as we head into a Fed meeting next week. And, of course, a big story here with WTI crude, $91 a barrel. barrel, highest levels we've seen going back to at least November. I want to flip up the board just a little bit here because the other big story of the week is that UAW strike, and just kind of puts into perspective, I think, why the union is asking for so much here. This is actually the share of U.S. employee compensation, or the U.S. employee compensation as a share of the total value of business added. So basically, how much people are getting paid out of the profit that corporations make. And that trend has been down. We know that as a percentage of corporate profitability, the amount that flows to the employees has been going down here, now at about 58 on the nose right now. And this is exactly what the UAW has talked about, how they're not just thinking about the future. They want to sort of make up, I guess, for what they say is a past wrong.
Exactly. And I think somebody probably showed that chart, that very chart, to the president, maybe Gene Sperling, who's been appointed to try and sort of move this thing along, because that's exactly what he said earlier, right? That if their car companies are making record profits, then they should be seeing record contracts for their workers. But from one strike to another, and this for a good reason, Paramount is higher. It's at 1.7%, and this is because Hollywood studios will hold talks with striking writers next week. Now, obviously, it's just the very, very beginning, but it could lead somewhere, and it would be a relief to a lot of workers out there in many different industries.
Yeah, it'll be interesting to see if that can get resolved. I saw you had Schwab on there. They're under pressure once again.
Once again, this keeps happening this year, right, Romaine? Down about 2.2% now, but they were down a lot more earlier on in the session after saying they were temporarily affected by attrition from clients still integrating TD Ameritrade. I thought that was done after Labor Day.
Yeah, I mean, they've obviously got a lot to sort out here. It'll be interesting to see what they do. I think they kind of got caught in that downdraft with the regional banking crisis, even though they weren't really directly sort of affected by it.
Exactly, but they did have to come out and defend themselves, and we know that that's always not a good thing to have to do if you're a bank or a brokerage. And then, of course, you mentioned all of these earlier, Romaine. It's the chips, the chip makers, the chip suppliers. I've just picked Applied Materials from all of them, but KLA, Lam Research, they're all down 4 or 5%.
All right, we are less than 1 hour away from the closing bell. Our cross-platform coverage, counting you down to those bells, it starts right now.
Countdown to the close. Bloomberg's comprehensive cross-platform coverage ahead of the U.S. market close starts right now.
This is the countdown to the close. Romaine Bostick alongside Bonnie Quinn. We're joined right now by our colleagues, Jess Menton and Simone Foxman. Together, we welcome our audiences across all of our Bloomberg platforms, television, radio, originals, as well as those folks streaming us on YouTube. An interesting day, guys, in the market today. And of course, obviously, a big focus right now on economic conditions.
Definitely. And I know y'all are probably missing Carol Masser and Tim Stinovic today, but you do have Simone and myself here. And obviously, when we come back for the closing bell later on, but looking more broadly in the market and seeing things, especially stocks jeopardizing those weekly gains, Romaine, especially when you're thinking ahead to the Fed's next week Federal Reserve meeting.
Yeah, not to mention all that focus that we're paying on what's happening in Detroit with the first UAW strike against 3 automakers at once, certainly.
And of course, Simone and I were taking a close look when it came to what's going on in the housing market, and especially when you're looking at some of these cancellations that are happening there as well, and some of the dynamics, because when you think of the backdrop and just think of where mortgage rates are at this moment, especially doubling just over the last couple of years, and then when you think about the issues when it comes to low inventory, obviously a big thing coming out of the housing crisis, but really was exacerbated by the pandemic, Simone. And when you're thinking, when you're vying for all these options and how competitive the housing market is at this point.
Yeah, look at it. 60,000 homes nearly, home purchase agreements canceled in the month of August. That's about 15.7% of homes that went under contract that month, according to Redfin. Big numbers.
Yeah, big numbers here, and it gets, I think, to the broader point about whether we're at some sort of inflection point in the economy, in the markets, and the cycle itself here. And I'll be remiss in not mentioning that here on this September 15th, 2023, it's actually, well, the anniversary of the collapse of Lehman Brothers. Remember, this was a pretty big week. Of course, Lehman actually filed for Chapter 11 on September 15th. But remember, that same week, you had Merrill Lynch being sold off, and then you had Fannie Mae, Freddie Mac being put into conservatorship. So you had just a huge shift in I guess our financial system, if you will. We should point out, 25,000 people or more lost their jobs just in the Lehman bankruptcy alone, Bonnie.
It's sending chills down my spine, Romaine, because I was working in here that whole weekend long. We finally got this resolution, and I had to pass Lehman Brothers on my way home, and I saw people carrying cardboard boxes out of there, and there's nothing worse than seeing that.
And it's amazing. We talked to a lot of folks who unfortunately managed to find other jobs on Wall Street.
of the larger sectors, well, it's a disaster of a day, particularly information technology. And of course, we know why. It's on that Reuters report that TSMC has asked some chip suppliers and chip companies to delay delivery. So not a great looking picture, but it has been an anemic week and not the best month in the world.
Yeah, but of course the catalysts are starting to pick back up. We had that ARM IPO yesterday, second trading day for the company, and a bit of a down day, only down 1%. Of course, put that against the backdrop of the 20+% gain that it had yesterday, and I guess some folks will take it. Amazon also on the back foot, as are most of the Magnificent Seven. A big part of the reason why you're seeing the NASDAQ and the S&P significantly lower on the day. But keep an eye on the automakers. Ford up on the day. GM at one point was up more than 1%. A lot of those investors in those stocks really taking in stride the latest strike news that we got with the UAW overnight walking off the job at several key assembly plants. This won't affect all of the production at these companies, but certainly some potential for disruption there. So keep an eye on that space, and keep an eye on Planet Fitness having its worst day since May. A surprise departure of its CEO. Now the CEO is going to stay with the company in an advisory role and sit on the board, but some concerns here about why he's leaving, and more importantly, who's going to replace him. Of course, that brings us back to triple witching here. We should point out volume as of right now already about 20% higher than the 30-day average. That's expected to pick up significantly here over the next 30 minutes as we get to the close here. Of course, this is always a volatile time for the market. And of course, it comes against the backdrop of a big rebalancing of the S&P 500. Don't forget, starting on Monday, you're going to have two big entrants into the S&P 500 with Blackstone and Airbnb taking their position in the S&P. Fani.
There's always something going on, Romain. Thank you. Well, Disney is one of the stocks that is higher today. It's up 1%. And the initial talks to sell its ABC network and TV stations behind this move, most likely. Joining us now with his insights is Ross Gerber, President and CEO of wealth investment firm Gerber Kawasaki. I'm reminded a little bit of, how do you value Waystar Royco? How do you value ABC? What should somebody pay for it, Ross?
Well, it's interesting because you're like, who would actually want, sort of like a network at this point? But there are still people who watch network television, and it drives a pretty decent amount of revenue and profits. And although it's a declining number, it still has value to people in the TV business. So I think it's a real smart move for Disney to divest ABC, because I think it's sort of like a non-core asset at this point.
What would happen to Disney if it did divest ABC? What would be the next for the chopping block?
Well, in my mind, ESPN is like the big piece that they could get like a ton of money for, and really is synergistic with a lot of companies that want to be in the sports business and the gambling business. They just did this deal with Penn Gaming to now be a gambling app, ESPN, Bet ESPN. And so they're making these steps that I think are very attractive to many in the tech industry that are wanting to be in sports, which is really Apple, Amazon, and Google. Apple's had a lot of success with the MLS, but they typically don't take big, bites out of companies. But ESPN is a piece that's extremely valuable that I think they might end up just keeping anyways, but certainly is a sellable asset.
Well, what has he said, though? I mean, Iger is I felt when he first took over, there was all this talk about, okay, you got to spin off ESPN or do something with it. And he kind of made clear that ain't happening. And then he seemed to at least leave the door open to that.
Yeah, I prefer them to keep ESPN, because I think ESPN and the ESPN Plus app, and with the gambling, is actually a wonderful asset to grow, especially as the contracts change with the cable companies, where ESPN content will be able to be, more dedicated specifically for the app as the years go on. So there's a lot of value to be gained in ESPN over time. So I prefer if they keep that asset and sell off other assets personally.
I know there's a lot of talk about kind of the quote unquote dead weight that the ABC network, at least the linear television networks, had on the company here. But is there any sense here that they would still need some sort of exposure to the broadcast television market in some way or another?
I mean, I think the big question is, people are still watching broadcast television, but I just don't know who. And so, I'm sure you haven't been watching ABC lately. So, it's like, I don't know who watches broadcast television, but somebody does. My mom probably
people,
still
Ross.
watches
Yeah, I didn't want to say that out loud, but yes, my mother still watches it, and I guess there's still a generation.
It's our moms, right?
Yeah. But there's a younger generation, the folks much younger than us. I don't know. I couldn't name a single one. So.
But
nobody, zero.
Yeah, curious though as to what Disney would do without news. Does it not need news whatsoever?
Well, what is news today? It's changed dramatically. So companies that are very focused on news, like Bloomberg, for example, have done very well because of that focus. But when you look at ABC and the network news, I don't think anybody watches it anymore except our moms. We were just talking about. So young people today don't like the news. They don't watch the news. A lot of people are getting their news off social media, basically. And so I think that actually the news business is the first thing I'd get rid of.
Ouch, Ross.
No, because you guys are doing such a good job.
No,
it's because of you.
No, I always appreciate your candor and playing it straight. And in all seriousness, though, too, this gets to the idea, though, of how much runway Iger has left. I mean, in theory, at some point he'll leave, maybe. But at some point, he's trying to really set this company up, I guess, for whatever the transition is going to be to the new leadership here. I mean, I know maybe it's too early to kind of give a report card, but are you generally happy with the progress that he's made?
Yeah, I am. And he's doing exactly, what he's setting out to do and cutting costs and making strategic decisions. He's brought back Kevin Mayer, Tom Staggs, which I think are great, they're advisors, but I think great addition, from a management perspective. And they're doing what needs to be done. It hasn't been that long of a time, and it's been an extremely challenging time in the entertainment industry with the strikes and what's going on. And so, Iger's taken on a big challenge, but I think he's doing what needs to be done. And, Disney here at $85, $86 a share with the assets that it has seems, awful cheap to me as an investor. It's a top holding at my firm and in my fund GK. I think as an investor, you look at Disney, hasn't gone up in 8 years. It was the last time it was at this price. There's a lot of value that they can create if they make the right moves here.
Well, I guess it's patience that's called for, Ross. Thank you so much, and thanks for joining us. That is Ross Gerber of Gerber Kawasaki. Coming up, the Dow's exclusion of Amazon and Alphabet went from a blessing to a curse in the span of a year. Now, some are speculating that the duo's day has come again. More next. This is Bloomberg.
Most of the large Chinese technology companies, let's say Alibaba, Baidu, Tencent, they have gigantic market values and they're very prominent in China, not as prominent outside of China as obviously in China, and certainly not that prominent in the United States. TikTok, by contrast, is not in China, but it's gigantic outside of China, of the United States and everywhere. What did TikTok do that enabled a Chinese-based company, parent company at least, to do so well outside of China?
We think it's challenging to build a global company in general, but the best ones we have seen so far are ones that take very consistent global learnings and adapt them to the local countries that they are operating in. So you need to be global and local at the same time.
On the next episode of Hello World, meet the women driving Kyrgyzstan's tech revolution.
This is the first satellite in our country.
And some speedy horses. Watch Hello World Thursdays at 8 p.m. Eastern on Bloomberg Originals or 10 p.m. Eastern on Bloomberg TV.
here's the story that caught my eye. The Dow Jones Industrial Average has been trailing other indexes by double-digit percentages so far this year. And one big reason for that is because the benchmark has some really notable absences. Alphabet and Amazon, two of the biggest companies in the world, not part of the average. After splitting their stocks in 2022, many are calling for a rebalancing of the 127-year-old average. For more, let's bring in Isabel Lee, who wrote this story for us here at Bloomberg. And I kind of forget, I mean, we make fun of the Dow all the time because, you know, the whole debate between market cap weighting and price weighting here. But you have Apple in there, you have Microsoft. But other than that, as far as the biggest names, the names we talk about so much, Amazons, Alphabets, Teslas, even Metas of the world, they're nowhere to be found.
Yes, they're nowhere to be found, and that's why people are asking, what is up? Like, in this year, they're clearly the big laggards, but here's one thing that we realized also. Last year, they were the big winners compared to the S&P and the NASDAQ. And this is why Chris Harvey of Wells Fargo told me that it's okay to be unfashionable at times. I mean, the Dow is unlike other indexes. It rebalances on an as-needed basis. So our team covers rebalances. Every quarter, we have this routine. We're like, okay, here we go. What are the biggest additions or deletions? But not for the Dow. It's been 3 years since they last rebalanced.
When will they rebalance again? Are they considering it perhaps now, given, you know, the price action?
They're very mum on that, but 3 years actually. For others, it's been a while, but if you look at their history, they've had really few and far in between. In fact, 3 years, if you look at it based on their history, is quite recent. So they don't really do that. They just add companies that they deem are excellent. I read their methodology, and it's very vague, as you could probably tell. And I tried to talk to their people, befriend them, but they're like, listen, we're completely separate. We're the index committee. We also only know when something is added or subtracted on the day itself.
So they don't reveal that methodology at all, really?
It's just like we add companies that are excellent in reputation, that represent American society. It's kind of a secretive club. Maybe I want to be part of it someday.
It feels like a jury or something like that. Like you can find out afterwards, but not before or during. So Isabel, you know, when you were going about this, did you also figure out who actually sort of takes notice of the Dow? I mean, we all look at it every day, right? But what does it mean to anybody?
So that's a great question. When I asked two of the sources that I talked to, they said they don't even look at the Dow. Again, to quote Chris Harvey, he said only his dad asks him about the Dow. Stephen DeSantis of Jefferies said, our clients don't look at the Dow. I asked him, will you read my story? And he's like, I'll read it because he wrote it. But like, no one really looks at the Dow. But I want to say that the Dow is still kind of this litmus test of the industry. Like people still clamor, not people, companies still clamor to be part of the Dow. It's still a venerable index. It's the oldest. It's 127 years old. So I don't want to like shove it away and make it appear like it's not important. But let's just say that when you look at ETFs, not a lot of ETFs track it. In fact, just one track it compared to the S&P.
I'm curious. I mean, it obviously has prestige. I mean, one of the big limitations, obviously the price weighting, but also the fact that it's only 30 stocks. So you have to be much more selective as opposed to the S&P 500, which can, you know, sort of put things in and out because it's got, you know, 500 plus names to choose from. But when I go through the names in the Dow, it is kind of representative of the economy, isn't it?
It is kind of, yes. That's why someone said maybe the blue chip stocks of yesterday isn't the ones today. That could be true, but we also know that this year is just an extraordinary year. I mean, who saw NVIDIA rally like that? Who saw all these big tech companies powered by AI? I mean, if you remove all of them, the economy is still looking kind of shaky. So maybe it is still the best reflection of society, to your point. So
I mean, how many of these remain were even in it back when Lehman went away? Never mind, you know, the last 50, 60 years. And can you still call it the Dow Industrials?
That's questions. I know.
You'd have to do a multi-part series, Isabel.
Interesting stuff. And we should point out we're getting an S&P rebalancing overnight, I guess into Monday here. Just some minor additions, Airbnb and Blackstone.
Airbnb and Blackstone, don't forget.
Yeah, Blackstone. So it'll be interesting to see how that shakes out. A great reporting here by Isabel Lee. Look, a deeper dive into the Dow Jones Industrial Average. It is still industrial, Fania Quinn.
I was just looking at Salesforce, but yeah, I mean, it's all industrial.
Is that an industrial?
They're in industries, right?
Yeah.
I mean,
all right, a lot more coverage.
Define industrial.
A lot more coverage coming up here as we round out to the closing bells. Just about 15 minutes to go here. Tom Galvin over at National Rockdale, Chief Investment Officer. He's going to be joining us after the break. Stick with us. This is Bloomberg.